TDS and TCS, the last portion in segment 2. So TDS is applicable under section 51 and TCS is applicable under section 52. So whenever we are making supplies to notified recipients, the notified recipient will be deducting 2% towards TDS on the amount that they are remitting. Who are those notified recipients? That notified recipient is government, that is central government, state government, local authority, then government agency or public sector undertaking or government body where equity participation of government is greater than or equals to 51%. So this is the notified recipients. If we are making supply to these notified recipients, then they will be remitting some money to us now. On that money that they are remitting, they will be deducting 2% towards TDS. If it is interstate supply, 2% towards IGST. If it is intrastate supply, 1% towards CGST, 1% towards SGST. So see the rates. So notified recipient at 2%. Okay. Then, so what is the non-applicability of TDS? Suppose if the supplier is unregistered, what is the reason behind this TDS? So mainly to identify how much is the value of supply of the supplier. So because that notified recipient, when they are deducting TDS and they are remitting it to the government will know how much is the value of taxable supply of the supplier, so that he cannot suppress his turnover and he will be paying GST on the entire amount. For example, your government, from you I am receiving somewhere like 1 lakh. So now in that 1 lakh you are deducting 2%. So 2000 you have deducted. So now 2000 you are remitting against my GSTIN. Those 2000 rupees will come into my electronic cash ledger. Now government will come to know, GST department will come to know. So 2000 rupees deducted means 2%. If it is 2000, then what is the value? 1 lakh. If I show a transaction with less than 1 lakh, so using this TDS, they will be asking me, why are you declaring a value less than whatever money that you have received. So mainly for the trial only they are bringing this TDS concept. So when they want to recover GST from the supplier only, TDS is required. Supplier himself is unregistered, he is not having GST liability, then what is the need of having that TDS? So therefore TDS is not applicable if the supplier is unregistered. Our supplies are exempted or non-taxable, again no GST on that, so no need to have any TDS. And if the value of supply under the contract does not exceed 2,50,000 rupees, so total value of supplies under the contract does not exceed 2,50,000 rupees, then TDS is not applicable. If it exceeds 2,50,000 rupees under the contract, TDS is applicable. While determining the value of supplies under the contract, we need to include GST or exclude GST? Exclude GST. And then one more point here it is, once TDS is applicable, so we need to compute not on the contract value TDS, on the amount that is remitted. For example, I entered into contract with state government, your state government, I entered into contract with the state government for supply of face mask of 8 lakh face mask over a period of 3 months, and each face mask is 50 paise. Okay, so therefore total 8 lakhs into 50 paise is 4 lakhs. What is the total value of supply under the contract? 4 lakhs, which exceeds 2,50,000. But entire 8 lakh mask I am not delivering in once. So first month I am delivering 2 lakh mask and I receive 2 lakh rupees from you plus GST. Now now TDS is computed only on 2 lakhs. So now TDS is computed only on 2 lakhs. But 2 lakhs does not exceed 2,50,000, that we should not see. The value of supply under the contract is total 4 lakhs, which exceeds 2,50,000. So TDS is applicable, but what you are remitting to me now is only 2 lakhs. So on that only TDS you will deduct. Second month I will deliver, so 2 lakh masks. So the 2 lakhs worth of masks. So on that, you understood or not? So therefore it is depending upon the payment that you are sending. For example, first month you are giving me 1.5 lakh, second month 1.5 lakh, and balance amount in the third month, like that. So depending upon the money that you are remitting to me, depending upon that only TDS will be deducted. Please keep that in mind. Okay. Then supplies between notified recipients, that is between these recipients, if there is any supplies, then also TDS is not applicable. Okay. That is supply by other than notified recipient to this notified recipient, then only TDS. Between them, if there is any transaction, TDS not applicable. Then recipient liable to pay GST under RCM, also TDS not applicable. Then location of recipient and place of supply not in the same state. So what does it mean? So it means that say location of supplier is located in Tamil Nadu, who is an architect. Supplier is located in Tamil Nadu, architect. And recipient is Andhra Pradesh government, and so place of supply, immobile property, okay, place of supply is property, that place of supply property is in Tamil Nadu. Now in this case what has happened, it is a intra-state supply, as location of supplier is in Tamil Nadu and place of supply is also in Tamil Nadu, it is an intra-state supply, chargeable to CGST and Tamil Nadu SGST. So therefore recipient is in Andhra Pradesh, so they cannot deduct 1% towards Tamil Nadu SGST because they are not registered in Tamil Nadu. Due to that reason, TDS is not applicable. So when TDS is not applicable, if it is a intra-state supply, and location of recipient and place of supply is not in the same state, okay, it is an intra-state supply, location of recipient and place of supply not in the same state. So then in that case, so TDS is not applicable, because simple logic, here AP government cannot deduct 1% towards SGST of Tamil Nadu and remit due to that reason. So TDS itself is not applicable. So what you need to remember, location of recipient, not supplier, location of recipient and place of supply not in the same state, different states, then TDS is not applicable. So these are the non-applicability of TDS. TDS computed on amount remitted to the supplier by the recipient. It is computed on the amount remitted. TDS not applicable if it is a intra-state supply and recipient is in another state. That is the point we have seen. Next, look into the computation. So TDS is computed on the value of supply excluding GST, and whatever TDS that is deducted needs to be remitted to government by when? 10th of the month following every month. And they need to file one return. What is the return to be filed by TDS deductor? GSTR 7. And they also needs to give one certificate in GSTR 7A. And that certificate, previously there was a time limit, now there is no time limit. And if there is any delay in remitting the TDS or not deducting TDS, etc., then there is a late fee for delay in filing return. First, there is a interest also. Interest on our auto account, so that is the TDS not deducted or deducted but not remitted. For the delay in paying TDS, interest will be payable at 18% per annum from the first day after due date till the date of payment. What is the due date? 10th of the month following every month is the due date. Till the actual date of payment there is interest. Plus late fee is also applicable for delay in filing return. What is the return? GSTR 7. So for GSTR 7 return, late fee is what? 25 rupees per day subject to maximum 1000 under each act. And are they required to file any annual return? No, they are not required to file any annual return. So these are the points related to TDS. Now TCS you see, so that like a comparison you will be able to understand. So TCS is under section 52 and TCS is to be deducted by whom? E-commerce operator. Means whenever I am making supplies through an e-commerce operator, is it notified services or other transactions? Other transactions. Because for notified services TCS is not applicable. So other transactions through e-commerce operator will be deducting 1% towards the TCS and will be remitting in my name under my GSTIN. So it will come into my electronic cash ledger which I can adjust against my liability. Now again, what is the reason for TCS? That is, e-commerce operator will report say 1%, 5,000 rupees is reported as TCS. 5,000 rupees is 1%, means what will be the value of the supplier. So now the supplier cannot suppress the turnover. So for that reason this TCS has been brought, just like TDS only. But TCS is deducted by e-commerce operator and non-applicability of TCS. So when TCS is not applicable, if the supplier is unregistered, same point. Or if the suppliers are exempted or non-taxable, same point. And notified service under 9.5 already we have seen in 9.5. Extra you need to remember, payment is not collected by e-commerce operator, means payment is directly collected by the supplier. Then in that case TCS is not applicable. And so what is the time limit by which the TCS has to be paid? Same time limit, 10th of the month following every month. And are they required to give any certificate? No, but they need to file one return. What is the return? GSTR 8. Time limit of filing GSTR 8, same, 10th of the month following every month. And while computing TCS, we need to reduce the sales returns. So sales during the month through e-commerce operator minus sales returns. So payment towards contract value minus returns during the month. And is there any interest payable for delay in paying TCS? Yes, same interest provision is applicable, that is 18% per annum from the first date after due date till the date of payment. What is the due date? 10th of the month following every month. And the late fee, there is a difference, you please see. In case of TDS, the late fee will be 25 rupees per day subject to maximum 1000 rupees under each act. But in case of TCS, it is 100 rupees per day subject to maximum 5000 rupees under each act. And TCS deductor, that is e-commerce operator, is required to file an annual return in GSTR 9B by 31st December of the succeeding financial year. And there is a general penalty, that is 25,000 up to 25,000 under CGST and up to 25,000 under SGST for non-compliance. And there is a specific penalty also for the default, TDS TCS default under 122 subsection 1, which is 100% of the TDS or TCS or 10,000, whichever is higher. So this is the provisions related to TDS TCS, and this TDS TCS deducted by notified recipients or e-commerce operator is reflected in the supplier in which place? GSTR 2A, not 2B, GSTR 2A, and that amount will be going into the supplier's electronic cash ledger, not credit ledger, which means it can be used for payment of any liability, because a balance in credit ledger can be used only for payment of tax, but the balance in cash ledger can be used for payment of tax, interest, penalty, fee and others. And time limit for rectification of TCS return. TDS return, there is no time limit, like no rectification of return. But in case of TCS return, GSTR 8, we can rectify. What is the time limit for rectification? There are total 5 time limits. Now it has been streamlined as the same time limit. So that is the time limit for availment of ITC, section 16 subsection 4. Then time limit for issuance of credit note, section 34. And the time limit for rectification of GSTR 1, time limit for rectification of GSTR 3B and time limit for rectification of GSTR 8. These 5 time limits is same. 30th November of the succeeding financial year or date of filing annual return, whichever is earlier. So what are the 5 time limits which is same? Time limit is same. Time limit for availment of ITC, issuance of credit note, rectification of GSTR 1, rectification of GSTR 3B, rectification of GSTR 8. So the time limit is 30th November of the succeeding financial year or date of filing annual return, whichever is earlier. Now this is an illustration on TCS. There is a supplier who is making supplies through an e-commerce operator to the buyer. First, supplier will enter into contract with e-commerce operator to sell the mobile, and for each and every mobile sold by Flipkart e-commerce operator, Flipkart will receive a commission of 1000 rupees plus GST 18%. Now, buyer is placing an order with Flipkart for the mobile. Now, supplier delivers the mobile along with the invoice. So, invoice is for what value? 10,000 plus 28%, 12,800 rupees. Now, e-commerce operator will make delivery of the mobile and buyer will pay how much? 12,800 rupees. Now, out of this 12,800 rupees received by e-commerce operator, they have to first pay GST on the commission. So, what is the GST on the commission? Commission is how much? 1000. On that GST will be 18%. So, 1000 into 18%, first they need to pay GST on commission 180 rupees and they need to even pay TCS. TCS will be how much? 1%. While computing TCS, remember, don't include GST. So, TCS is computed on the value excluding GST. What is the value excluding GST? 10,000. So, 10,000 into 1%, that is 100 rupees. So, this 180 rupees which is paid by e-commerce operator and 100 rupees which is paid by e-commerce operator as TCS will be reflected in the supplier's electronic credit ledger and cash ledger respectively, correct or not? So, this 180 rupees whenever e-commerce operator is paying GST, e-commerce operator will raise invoice to supplier and in that invoice 1000 rupees plus 180 will be mentioned. So, ITC on the commission paid will be 180. Then whenever they pay TCS 100 rupees, this 100 rupees will be taken as credit by the supplier, okay? Under which ledger they will take this TCS credit? Cash ledger. And this 180 rupees will be coming in which ledger? Credit ledger. Now, what happens is that what is the amount to be remitted by the e-commerce operator? E-commerce operator has got 12,800. In that, they will deduct their commission 1000 rupees. Correct? And then they pay GST on the commission also, that will be deducted. Then TCS they will deduct 100. So what is the remaining amount that they will remit? 11,520. And now the supplier has to pay GST 2,800, correct? Gross. So 10,000 into 28%, 2,800. But while paying the 2,800, they can take this 180 and 100 rupees as adjustment. So 2,520 will be the net liability. Done. So this is about TCS. So mainly here this supplier may suppress the value. Supplier will say that he got only 11,520, and what he will do, 11,520 into, so 28 divided by 128. So that is 2,520 he will take. From the 2,520 he will reduce minus 180 minus 100. So 2,240 he will pay. He will say, so this much only I received, because in my bank account also this much is only there. So therefore this is only my value. Like that he may suppress. Due to that reason only they brought the TCS to identify as to what is the value of that particular supplier. Is it clear? Next. In this segment 2, the last area is circulars related to supply. So there is one query here. So general penalty 25,000 rupees under section 125 and specific penalty TDS TCS default. So is both applicable at the same time? No, not both applicable at the same time. That is, if TDS TCS is deducted but not paid, not deducted, then it will be specific penalty, that is 100% of the TDS TCS or 10,000, whichever is higher. But for compliance means what? Returns. For return filing, there is late fee as well as general penalty. So many people are of the opinion that for delay in filing returns, only late fee we need to pay. No, not only late fee, there is even general penalty under section 125. That is up to 25,000 under CGST, up to 25,000 under SGST. That's the reason why clearly I mentioned there, for non-compliance means what? Return related non-compliance. Okay, that is if they are paying, like if they are filing the return late, etc. But if there is a default, when there will be default, not at all paid, not at all deducted, or deducted but not at all paid, then there will be a default. Then only this penalty will be coming into picture. Time of supply in case of section 14, change in rate. That is, whenever there is a change in rate between 3 dates. What are the 3 dates? Date of completion, date of invoice, or date of payment. Between these 3 dates, if there is a change in rate. And is section 14 applicable in case of both goods and services, or only in case of services? Only in case of services. But when you see section 14 Bare Act, section 14 is actually applicable for both goods and services. But why it is applicable only for services? Because of notification 66/2017. That notification 66/2017 says that even in cases when there is a change in rate with respect to goods, the time of supply needs to be determined based on actual date of invoice or due date of invoice, whichever is earlier. So because of that reason, even in study material this point has been given, but fully they gave for both goods and services. Last in one corner they gave only for services, like that. Okay, and student will read that fully and he will think, okay, for both goods and service it is applicable. In exam they will apply for goods also. No, don't apply. Only for services section 14 will be applicable. In case of goods it will be section 12 only, section 12 only. And in case of services, when there is a change in rate, between which dates there is a change in rate? Between 3 dates. What are those 3 dates? Date of completion, date of invoice, or date of payment. So now suppose if date of completion is before change in rate, service is completed before change in rate, then we need to take invoice or payment, whichever is earlier, as the time of supply. So completion is before change in rate, then we need to take invoice or payment, whichever is earlier, date of invoice or date of payment, whichever is earlier, as the time of supply. Suppose if completion is after change in rate and both invoice and payment comes before change in rate, then whichever is earlier. If one is before, one is after, then whichever is later. Okay. For example, say if the date of completion, if the date of completion is 15th March and change in rate is from 1st March, change in rate is from 1st March, date of completion 15th March, date of invoice is 25th March and date of payment is 31st March. So what will be taken as the time of supply? So time of supply, first of all, will it be determined under section 14? No. Time of supply will not be determined under section 14 because between these three dates the rate is same, because change in rate is 1.3 and after that only all these events have happened. Means between these 3 days there is no change in rate. So don't apply section 14. So you need to determine normally either 12 or 13. So now suppose if there is a completion which is before change in rate, that is 25th of February there is completion and change in rate is from 1st March. Now time of supply will be determined under section 14, yes or no? Yes. And what will be taken as the time of supply? So supply is before change in rate or after change in rate? Completion is before change in rate or after change in rate? Before change in rate. So therefore invoice date or payment date, whichever is earlier, will be 25th of March. Are you understanding this? Suppose if completion is after change in rate, say 25th of March completion, and invoice is raised on 20th of February and payment is made on 31st of March. Now we need to apply section 14 or not? Yes, section 14. And completion is before change in rate or after change in rate? After change in rate. Whether both are before change in rate? No, one before, one after. So whichever is later. Which is later? 31st March. So that will be taken. Just 3 points you need to remember. Completion before change in rate. Invoice or payment, whichever is earlier. Completion after change in rate. Both invoice and payment before change in rate, whichever is earlier. Invoice or payment, whichever is earlier. One before, one after, whichever is later. And what should be taken as the date of payment? Generally, what is the meaning of date of payment? Date of entry in the books or date of credit in the bank account, whichever is earlier. However, if the payment is credited within 4 working days from the change in rate, then only we will take this for section 14. For section 14, we have a different meaning of date of payment. If the payment is credited within 4 working days from the change in rate, then we need to take date of entry in the books or date of credit in the bank account, whichever is earlier. If the payment is credited beyond 4 working days from the change in rate, only the date of credit in the bank account will be taken as the date of payment. So these 4 working days you should always be observing. So carefully when you are applying this section 14. So date of payment is date of entry in the books or date of credit in the bank account, whichever is earlier, provided payment is credited within 4 working days from the change in rate. If payment is not credited within 4 working days from change in rate, don't take entry date, just the credit date. The date on which the bank account gets credited, that only will be taken as the date of payment. Place of supply, we have total 4 sections. Section 10 deals with place of supply in case of goods and that too domestic transactions, and section 11 deals with place of supply in case of goods import and export, and section 12 will be in case of services where both supplier and recipient are located in India. Any one in India and the other outside India, then the place of supply will be determined under section 13. Now if both supplier and recipient are located outside India, can we determine the place of supply? No, because if both are in India, section 12, if one in India, outside India, then section 13. If both are outside India, place of supply cannot be determined. In that case, all the services will be exempted except one service, that is transportation of goods by vessel from outside India to India will be taxable, and in that case who will be GST? So GST is payable by importer of such goods. Now we are discussing section 10 and 11. Section 10 is domestic transactions related to goods. Section 10(1)(a) is supply involves movement of goods. In case when supply involves movement of goods, so then ending point will be taken as a place of supply. That is, supply involving movement of goods means under the contract of supply, goods are taken from one place to another place. So ending point should be taken as the place of supply. Then what if supply does not involve movement of goods? 10(1)(c). Then in that case, location of goods at the time of delivery will be taken as a place of supply. That is, for example, if there is a ship which is located in Mumbai and the seller of the ship is located in Tamil Nadu, buyer of the ship is located in Karnataka. So now the seller is transferring the document of title to the buyer, but the ship is located in that place only. So therefore, in that case, supply does not involve movement of goods. So therefore, location of goods at the time of delivery will be taken. So therefore, Mumbai will be taken as the place of supply, location of goods at the time of delivery. Suppose if supply involves movement of goods, then ending point will be taken. If it is bill to ship to transaction, bill to ship to transaction means we will be raising invoice to one person but sending the goods to the other person. Now what should be taken as the place of supply? Billing address should be taken as the place of supply. Say for example, A Limited and B Limited is there. A Limited places the order to me to deliver the goods to B Limited. Now for me, billing address is A Limited, so A Limited's location only will be taken as the place of supply, and again between A Limited and B Limited there will be another supply. So in that case it will be 10(1)A, supply involving movement of goods, ending point will be taken. So in bill to ship to transaction we need to observe that there will be two supplies possible. Not necessary that always there will be two supplies, but two supplies will be possible, one between the original supplier and the billing address, and the second between billing address and the shipping address. Then 10(1)D, goods assembled or installed at site. In case when goods are assembled or installed at site, so we need to take location of such assembly or installation as the place of supply, and 10(1)D will override 10(1)A or 10(1)B or 10(1)C as the case may be, because whenever the goods are coming into existence only upon installation, we should not see ending point of the goods or location of goods at the time of delivery, etc., because this is a specific provision. So we need to take as per 10(1)D only, that is location of installation or location of assembly only will be taken as the place of supply. Then supply of goods on board a conveyance, that is during the journey, whenever the supply of goods takes place during the journey. So then in that case we will not see, so where the sale has taken place, we will see the starting point of the goods, which means location where the goods are taken on board. So therefore in the first case it is ending point of the goods, in the last case it is starting point of the goods. So that will be taken, and in this aspect here one point we need to understand that supply of food on board a conveyance, so that food whether it is cooked in the pantry car in the train or is it cooked outside and loaded into the train, we need to check. If it is cooked inside the pantry car, then it will become supply of services, then we should not apply 10(1)E. So because 10(1)E is only in case of goods, okay. And then if the food is already cooked outside and it is packed into packets and then it is taken into the train or etc. vehicle, so then what will be taken as the situation? Yes, it is goods. So even though supply of food is services, but only cooked food will be coming under services, whereas packed food which are sold inside the conveyance will be coming under supply of goods. So we need to apply 10(1)E, supply of goods on board a conveyance, starting point of the goods. Then in case of section 11, import of goods, we will take location of importer as the place of supply, not the place where it is imported. For example, I am located in Andhra Pradesh and I am importing the goods in Chennai, Tamil Nadu. So now what will be taken as the place of supply? Location of importer, Andhra Pradesh will be taken, but not location where the goods are imported. What is the purpose of determining place of supply in case of import of goods? Anyhow it is interstate supply, then why we need to determine place of supply? In order to give 50% of the IGST to the consuming state, so for that reason only we need the place of supply. Then in case of export of goods, what will be taken as place of supply? Location outside India will be taken as place of supply, and both import and export are always deemed as interstate. And in case of conflict between 10(1)A, B, C versus 10(1)D or E, so which will prevail? 10(1)D or E will prevail, because these two are specific provisions and that will prevail over the general provisions. Then whenever place of supply is determined under section 13, and if the place of supply is in India, it will be always deemed interstate supply, which already we have discussed. So that is the point which you need to always keep in mind, that is place of supply, it is in India, supplier also in India, same state, let it be, but the place of supply is determined under section 13, then it will be deemed interstate supply. Then we are moving on to place of supply in case of services. In case of services, so 12 and 13 parallelly we need to remember. So when 12 will be applicable? If both are in India. If one in India, other outside India, section 13 will be applicable. First we need to see the general provisions. So as per general provisions, in case of section 12, B to B, location of recipient; B to C, location of recipient in the records of the supplier; in the absence of that information, location of supplier. Whereas in case of section 13, it is location of recipient in the records of supplier, otherwise location of supplier. So this is the general provisions, and in the absence of specific provisions, so then general provisions will be applicable. Then next one, service in relation to immovable property or accommodation services, etc. So what should be taken? So if property is in India, then location of property. If property is outside India, then location of recipient should be taken. But in case of section 13, always it is location of property only. Let the property be in India or outside India. Then performance based service in relation to individuals. So here performance, like the previous point, immobile property services, we have renting, accommodation service, construction service, real estate agent service, works contract service, all those will come there. Whereas in here performance based service in relation to individual, there is a individual, to that individual you are providing some services. So then in that case, for the purpose of section 12, so we have three divisions. Number one, food and beverages, beauty treatment, etc. So related to food and related to beauty. So we will take location where services are actually performed. Whereas in case of second one, training and performance appraisal. So in case of training and performance appraisal, we have B2B versus B2C. So B2B location of recipient, B2C location where services are actually performed. Performance appraisal refers to evaluating the performance of the participants in reality show, like a judge acting as a judge, etc. Training refers to workshops, conducting any training, seminars, all this will come under training. And all other services we will take general provisions only. Then in case of section 13, we need to see whether physical presence of the individual is required, physical presence of the individual is not required. If physical presence of the recipient is required, location where services are actually performed. If physical presence of the recipient is not required, then we will take general provisions. Then next, performance based service in relation to goods. For the purpose of section 12, we don't have any specific provision. So we need to apply general provisions only. Whereas in case of section 13, we need to check whether physical presence of the goods required or not required. If physical presence of the goods is required, we will take location where services are actually performed. If physical presence of the goods not required, location of goods. But in this case, when physical presence of the goods required, location where services are actually performed, we have 4 exceptions. In these 4 exceptional cases, we will not take location where services are actually performed, but we will take location of recipient as the place of supply. What are those 4 cases? Goods temporarily imported for carrying out repairs or any other process and exported after repairs without being put to use. It can be for repairs or it can be for any process. If some raw diamonds are being imported for the purpose of cutting and polishing, and after cutting and polishing, if it is exported without being put to use. So whether it will qualify for this exception 1, yes, it will qualify, because it's not just for repairs, any purpose. So goods are temporarily imported for carrying out any repairs or process, and once the process is completed or repairs is completed, these goods are being taken outside India without being put to use in India. Just for testing purposes it can be used. Then it will not be location where services are actually performed, but we will take location of recipient. And second thing is with respect to pharmaceutical industry, if any drugs are being imported for the purpose of testing in a laboratory in India, so after testing, these goods cannot be exported back, because these drug samples which are imported gets destroyed during the testing process. So due to that reason, second exception says that, so then also location of recipient will be taken. The difference between the first point and the second point is that in the first point, after it is imported, after doing process, it should be exported back. But in the second point, no need to export it back. But second point is applicable only in case of drug samples of a pharmaceutical industry. And then number 3 and 4 is connected, repairs and maintenance in relation to aircrafts. But in case of 4, it is repairs and maintenance in relation to vessel, ship. And that vessel or ship or aircraft should be used for what purpose? Business purpose. If it is used for personal purpose, then it will not be coming under location of recipient, but we will take location where services are actually performed. Say for example, one celebrity is coming from outside India in one flight, and one aircraft, one chartered flight, and that particular chartered flight has got some issue. So therefore one aeronautical engineer is providing services to the chartered flight. Now in that case, whether we will take location of recipient as the place of supply or location where services are actually performed. Location where services are actually performed, because that aircraft is not used for the business purpose. Suppose if that aircraft is say Lufthansa Airlines, which is bringing the passengers, and for that aircraft if this aeronautical engineer is providing the services, then what will be taken as a place of supply? Location of recipient will be taken as place of supply. So the point here is that if it is performance based service in relation to goods, location where services are actually performed. And if physical presence of the goods is required. However, 4 exceptional cases, it is location of recipient. If it is not those 4 exceptional cases, then the regular provision only will be applicable, that is location where service are actually performed. Whereas in case where physical presence of the goods is not required, means through remote means we are inspecting the goods. So we are taking the IP address of the goods, and through remote means we are able to see, or laptops, computers and all, any desk we will take and we will do the repair services, etc. So then in that case, what will be taken as a place of supply? Location of goods. Location of goods, it's not location where services are actually performed, and we don't have any exceptions with respect to this. Then we have event related services. Event related services, so if it is admission to an event, always section 12 or 13, location where the event is held or the place is situated. For all entry tickets, it is a location where the event is held or the place is situated. For 12 or 13, it is common. For organizing an event, in case of 12, we have some little bit different provision. That is, in case of organizing an event, B2B, we will take location of recipient, B2C, location of event. If the event is held outside India, then again location of recipient. But in case of section 13, always it is location of event. We don't have any different provision. So therefore, for the purpose of section 13, let it be admission or organizing, always event location will be taken as place of supply. Whereas here our admission, it will be event location, and for organizing, B2B, location of recipient, B2C, event location. If the event is outside India, then location of recipient. Then transportation of goods. For transportation of goods, section 12, we have one point. First we need to see, is it from India to outside India? If it is India to outside India, it will be ending point, let it be B2B or B2C. So there is no change, let it be B2B or B2C, because generally we see that B2B means location of recipient, B2C means location, like different provision. But in case if the goods are transported from India to outside India, always it will be ending point that will be taken as the place of supply. However, in other cases means what? Outside India to India or within India, etc. Then we will apply B2B versus B2C, B2B location of recipient, B2C starting point of the goods. Whereas in case of section 13, it is other than mail or courier or mail or courier, other than mail or courier, ending point of the goods, and mail or courier, it will be general provisions. So this is in case of transportation of goods. Then transportation of passengers. So in case of 12, simple, B2B location of recipient, B2C starting point of passenger, 13 also starting point of the passenger. And anyhow in case of 13, we don't have B2B, B2C classification. So starting point, literally both are same. So starting point of the passenger, here also starting point of the passenger. But when it comes to goods, starting point of the goods, ending point of the goods. Correct? Section 12 is starting point of the goods, section 13 it is ending point of the goods. And here in one place it is ending point of the goods. What is that? If the goods are transported from India to outside India, then it will be ending point of the goods. Then next, services on board a conveyance. We don't have any difference in the provision. It is same between 12 and 13. It is starting point of the conveyance, not starting point of the passenger. So any service provided during the transit in a conveyance, we should not see. So what is the starting point of the passenger? Starting point of passenger should be seen only for the transportation services. But for the purpose of this, conveyance, services provided on board a conveyance, we need to see starting point of the conveyance. Then OIDR services. In case of OIDR service, section 12, we don't have any specific provision. So general provision. In case of section 13, it is location of recipient. Banking and other financial services. For the purpose of section 12, it will be general provisions. We don't have any specific provisions. But 13, remember, if the service are provided to account holders, then it will be taken as location of supplier. If the service are not provided to account holders, then we will take general provisions only. So that is important. If the services are provided to account holders of the bank, then only location of supplier, otherwise general provisions. Then intermediary services, again in section 12 we don't have any specific provisions, so general provisions will be applicable, whereas section 13 location of supplier will be taken. What is the meaning of a intermediary services? So there is one supplier and one recipient who is providing services or supplying goods. I am facilitating or arranging that particular transaction, means I am not doing any transaction, I am just connecting these two people. So mine is not a recurring activity, activity, mine is only one-time activity. So connecting the supplier and the recipient. So my job is done. Suppose if you are required to do some work and if you outsource that work to me, and if I do that outsourced work, I am not called as intermediary. I am called as a regular supplier to you. You understood or not? For example, BPOs, will they come under intermediaries? No. BPOs, KPOs, etc. will not come under intermediaries because they are doing the outsourced activities and they are not just connecting one supplier and one recipient. For example, you have got one service contract to provide to do the development of one software. So now you got this contract through me. I just identified a client for you. For that you have given me commission, intermediary services. Now you got one client who is doing the software, like who is asking you to develop the software. Now that software development you have outsourced it to me. Now in that case, am I intermediary? No, I am not an intermediary. So remember, outsourced activities will never be treated as intermediary services. So that intermediary services will be taken. An intermediary is someone who arranges or facilitates the supply of goods or service or securities between two or more persons, wherein two of them transact in the supply of goods or service or securities. So means there is a main supply. So that main supply is between two people, and the one who is arranging or facilitating the main supply. So the one who arranges or facilitates the transaction, therefore outsourced activities will fall under intermediary service or not? No, it will not fall under intermediary services. Example of intermediary services will be, we have commission agent services, consignment agent services, or any brokerage or tour operator services, travel agent services. So these are all examples of intermediary services. Then hiring of a means of transport, next one. So in case of intermediary, we completed section 12, we don't have any specific provisions, so general provisions. In case of section 13, location of supplier. Then hiring of a means of transport means renting of motor vehicles. In case of section 12, we don't have any specific provisions, so again general provisions, whereas in case of section 13, divide that into two. Is it aircraft or vessel or others? So if it is aircraft or vessel, then it will be general provisions. If it is others, then is the rent for 1 month or beyond 1 month, that is up to 30 days or beyond 30 days. If it is up to 30 days, then location of supplier. Beyond 30 days, it will be general provisions. Then finally, telecommunication service including broadband, DTH, etc. So in case of section 13, we don't have any specific provisions. So therefore, we need to check section 12. So section 13, it will be no specific provision. So general provisions will be applicable. In case of section 12, so it is divided into two, fixed line or mobile. If it is fixed line, location where it is installed. If it is mobile, we need to again check whether it is postpaid or prepaid. If it is postpaid, billing address. If it is prepaid, we need to see how the prepaid will be done. Online recharges. Online recharges means location of recipient in the records of supplier. Or if it is through a dealer or any distributor, etc. So then location of such dealer or distributor will be taken. See this. So if it is fixed line, equipment location, mobile postpaid, billing address, and mobile prepaid, dealer address. Online recharge, general provision, that is location of recipient in the records of supplier. So these are the various place of supply provisions in case of section 12 and 13. Now if you see, this B2B versus B2C classification is applicable only in section 12, that too in three places. What are they? TOT, correct? Training and performance appraisal services, organizing an event, transportation of goods or passengers, correct? So only in these three places we have B2B versus B2C classification. Training and performance appraisal, organizing an event, transportation of goods or passengers. So therefore don't get confused. Like, you have to remember only section 12, that B2C provisions only, because you know where B2B, B2C will come. So therefore wherever B2B comes, there it will be location of recipient. So when you are trying to remember, don't remember the B2B provision, B2C like that. Just remember B2C. So because B2B is applicable in which places? Three places. Training and performance appraisal, organizing an event, transportation of goods or passengers. There only we need to check B2B or B2C, and B2B means location of recipient. B2C means whatever provision you remember that you apply. Okay. Then next, location of supplier is taken as place of supply in case of section 13 only in three places. What are they? In case of intermediary services, location of supplier is place of supply. In case of banking and other financial services to account holders, then also location of supplier will be taken as place of supply. And number 3, in case of hiring of a means of transport other than aircraft or vessel up to a period of 1 month, that is 30 days, in that case also we will take location of supplier as the place of supply, correct? Then between 12 and 13, the provisions are same in 2 places, ditto same. That is, in case of admission to an event, location of event will be taken as place of supply, common between 12 and 13. And even in case of services on board a conveyance, it will be starting point of the conveyance. And in case of transportation of passengers, correct? Transportation of passengers, except B2B, B2C, so it will be starting point of the passengers, okay? So like that you try to summarize things and remember, but this you have to keep in mind, okay? Somehow you have to keep in mind, and directly the questions will be there. So directly by the moment you see that question, you will be able to answer with respect to that, okay? So just for the purpose of confidence sake, so we are discussing one question now. So that is related to Jan 21. So one 9-mark question is given. So just because as we completed this and you might be thinking that it will be difficult, etc. and all, that's why. So to the point only they will be asking. So this question number 2A they have asked in Jan 21 exam. So Mr. X, an architect, Kolkata, provides interior decorator service to Mr. Y of New York, USA in relation to his immobile property located in New Delhi. So in this case, whenever you see this, first you need to check whether it is 12 or 13. It is section 13. So in case of section 13, service second, first you need to see 12 or 13. Second, you need to see what is the service it is. Service is service in relation to immobile property. And what is the place of supply? Location of immobile property. What is the location of immobile property? New Delhi. So New Delhi will be taken as place of supply. That's it. Then Mr. A, chartered accountant registered in Kolkata, supplies service to his client in Bhubaneswar, registered in Bhubaneswar. Both are in India. So section 12. In case of section 12, and we don't have any specific provision with respect to CA services. So general provisions. As per general provisions, B2B. So location of recipient will be taken as the place of supply. Then number 3, ABC, what is the location of recipient here? Bhubaneswar, Orissa will be taken. Then ABC Limited of Patna imported certain goods from XYZ Incorporation of USA. The goods were imported through vessel and delivery of goods was taken at Kolkata, whereafter the movement terminates and the goods are stored. So import of goods, section 11. Section 11, import of goods, we will take location of importer. So what is the location of importer? Patna. Even though goods are unloaded in Kolkata, but Patna will be taken as the place of supply. Then number 4, Mr. X registered in Guwahati has availed landline service from BSNL. The telephone is installed in residential premise in Kolkata and the billing address is office of X in Guwahati. So in case of, this is section 12, telecommunication services, and it is fixed line location where it is installed. So where it is installed, Kolkata it is installed, so that will be taken as the place of supply. Then number 5, Mr. X residing in Chennai is traveling with Indian Airline aircraft and is provided with movie on demand service for 100 as onboard entertainment during Delhi Chennai leg of Bangkok Delhi Chennai flight. So now in this case, first it is 12 or 13, 12. So in case of 12, services on board a conveyance, we need to take starting point of the conveyance. Even for 13 also the provision is same. Starting point of the conveyance is Bangkok. So even though he is starting, that person is starting in Delhi, but the starting point of the conveyance is Bangkok. So Bangkok will be taken as the place of supply. Then Mr. X of Kolkata purchased online tickets for Aquatica Water Park in Mumbai. So Aquatica Water Park location is Mumbai. So this is section 12, admission to an event or place. Location of that event or place will be taken as place of supply, that is Mumbai will be taken as place of supply. Then Mr. Z, an unregistered person of Kolkata, sends a courier from New Delhi to his friend in Chennai, Tamil Nadu while he was on a trip to New Delhi. So section 12. Section 12, transportation of goods. Is it India to outside India? No. Other cases, B2B or B2C? B2C. So B2C, starting point of the goods will be taken. What is the starting point of the goods? So from where to where? New Delhi. So New Delhi will be taken as place of supply. Then point number 8. Mr. X, a registered person in Ranchi, Jharkhand, buys shares from a broker in Patna on NSE Mumbai. Determine the place of supply of brokerage service. Section 12. Section 12, intermediary services. We don't have any specific provision, so general provisions. So we will take location of recipient. What is the location of recipient? Ranchi, Jharkhand will be taken. Then 9. XYZ Limited, New Delhi, entered into contract with Indian Airline for supply of biscuit packets for further supply by airline to the passengers in Kolkata Guwahati route. The biscuits were loaded on board in Lucknow. So section 10, 1E. So supply of goods on board a conveyance, loading point of the goods. What is the loading point of the goods? Lucknow will be taken as the place of supply. Okay. And suppose if they are asking what is the place of supply in case if the goods are sold to the airlines, airlines selling it to passengers, location where the goods are loaded. Suppose if it is goods sold to airlines, what is the place of supply? In that case, 10-1A ending point, then also Lucknow, because we are ending, goods are ending in Lucknow. So Lucknow will be taken as the place of supply. So that is with respect to this. And so it's not difficult. Only thing, it requires little bit of revision, and a number of times you need to revise this, easily you will be able to remember. But I don't think so. No questions will be that much asked on place of supply directly on these provisions, because already it is tested. But rules are not yet tested. So on rules there are chances. So rules are basically requiring apportionment, because in rules what we basically determine is that, so whenever there is some value and which is common between two more states, 2 or 3 states, we need to apportion that value between these 2 or 3 states, because the place of supply is more than one state. So for that purpose, and first we will start with rule 3. So when rule 3 will be applicable? Rule 3 is applicable in case of advertisement services provided to government. In case of advertisement service provided to government, so in case of section 13 we don't have any specific provision, so general provisions. In case of section 12 it says each state where the advertisement is provided will be taken as place of supply. And what if the advertisement is provided in more than one state via a single contract? So then in that case the contract amount needs to be apportioned between the states. Suppose if the advertisement is in railways, so train, then we need to take it on the length of the track in each state. So then suppose if it is on the tickets, railway tickets, then we need to see number of stations in each state and we need to apportion that. And suppose if it is on TV channel, we need to make 2 apportionment. First we need to apportion it between the channels. And after apportioning between the channels, how we will apportion between the channels? Based on BARC viewership data, and that data of the previous quarter last week should be taken for the purpose of apportionment. And thereafter, so if the particular channel is being telecasted in more than one state, how will you apportion? Based on population census. So therefore first apportionment is between the channels based on BARC data. Second apportionment is between the states based on population. Okay. And then suppose if the advertisement is on internet, so and there is no separate, see all this rule 3 will be applicable only when we don't have separate information in the contract as to how much amount is for which state. Suppose if we have clearly the amount 4 lakhs for this state, 10 lakhs for this state, like that, we will not apply rule 3. So for that amount mentioned in the contract, that particular state will be taken as a place of supply. Only when we don't have state specific information in the contract, then we will apply this rule 3. Advertisement over internet, so deemed to be across the country, and we need to apportion across all states and union territories on what basis? Internet subscribers databases. And then we have through SMS. In case of SMS, so how the apportionment will be? Based on telecom subscribers data. Who will be giving telecom subscribers data? TRAI will be giving telecom subscribers data. Based on that we need to do the apportionment. So that is this 5. Apart from this, any other mode of advertisement, that is advertisement in cinema theater or advertisement in FM channel or advertisement in hoardings, advertisement in newspapers or any other mode of advertisement, we need to take the expenditure ratio. Suppose I am getting money from the government, contract revenue. So now my revenue I need to recognize based on my expenses. For example, so for the purpose of keeping some hoardings, I am receiving money from the government. Now, what is the cost of each hoarding? To keep each hoarding or to place advertisement in that hoarding, what is the cost? So in my cost ratio, I will apportion my revenue. So therefore, on what basis we need to apportion? In any other case, it is amount payable ratio, that is expenditure ratio. Then rule 4 and rule 8 is applicable in case of service in relation to immobile property, and that immobile property is in more than one state. Suppose if it is accommodation services, we need to take number of nights stayed in each state. That should be taken as a ratio for apportionment. And suppose if it is accommodation in a houseboat or vessel, time spent in each state. So that is, you are boarding a houseboat in one state and you are getting down in another state. So time spent in each state, standard time will be taken for apportionment. Suppose if it is any other service in relation to immobile property, for example, now say you are providing some repairs and maintenance services. That repairs and maintenance service in relation to some chain of hotels, and they have hotel in different states. So now what we need to do, we need to see the carpet area. We need to take the carpet area for apportionment and we need to divide that. And suppose if it is, one hotel which is located in such a highway wherein partly it will come in one state and partly it will come in another state. So again we need to apportion based on the floor area. So that is this. Next, in case of rule 5 and rule 9, so that is organizing an event. Organizing an event, we need to take expenditure ratio. That is, for example, wide a single contract if I am organizing event in more than one location. Now say I am organizing event in 4 locations: Karnataka, Tamil Nadu, Andhra Pradesh and Kerala. So now what I need to do, I need to take my expenditure ratio. For conducting one event in Karnataka, how much expenditure? For conducting one event in AP, how much? Tamil Nadu, how much? Kerala, how much? So therefore my revenue I will apportion based on my expenditure. So that is generally accepted accounting principles, that is expenditure ratio. Then rule 6. Rule 6 will be applicable in case of this fixed line services, telecommunication fixed line services. So location where the equipment is installed. What if wide a single service? So if it is a lease line service and the equipment is installed in multiple locations, so then we need to take number of circuit points in each state and we need to apportion, because lease line connects multiple branches of a particular company. So then in that case, in each state, how many circuit points are there? So based on that circuit points, we need to apportion. Then in case of rule 7, rule 7 is performance based service in relation to goods and individual. So in relation to goods, section 13, what will be taken as a place of supply? Location where service are actually performed. What if it is performed in more than one state? So then in that case, check whether the goods are same goods or different goods. For example, I have provided one AMC services to one company, to one foreign company in relation to their computers in different offices in India. So then in that case, all offices I am doing AMC with respect to what? Same product, that is computers. So therefore my AMC revenue I will equally divide between all the states. Is it clear? For example, they have offices in 3 states. Now I have got 9 lakh rupees as AMC charges. So 9 lakhs divided by 3, that is 3 lakhs will be taken as each state. You understood? Then suppose if it is different goods, which means that in one branch I need to do AMC with respect to computers. In another branch I need to do AMC with respect to ACs. And in yet another branch I need to do AMC with respect to data center. So now in that case, what I need to do? Invoice value of computers is to invoice value of air conditioners is to invoice value of data center. So based on that, my AMC revenue 9 lakhs needs to be apportioned between these 3 states. So therefore, if it is on different goods, invoice value ratio. Services, performance based service in relation to individuals. So what will be taken as the apportionment? So like generally in case of performance based service in relation to individual, location where service actually performed. But what if it is in more than one state? So then we need to apportion again GAAP ratio, that is expenditure ratio. Then, so these are the rules related provisions that we have, and definitely I am expecting at least in MCQ somewhere it should be tested, so that rules related. And if possible, if your time is good, so they can ask a question on practical question also, and it is like a jackpot only, like just like overhead apportionment or ABC kind of question only. Everything will be there in the question itself. You need to know what is the basis of apportionment. You need to just take the data, do the calculation and arrive at the answer. Okay. Then clarification through circulars. So we have some circulars related to place of supply. Say this, that is related to export of services. So generally what should be taken as the value of export of service? Concentrate. You are located outside India. I entered into contract with you to provide the services, and What is the contract price? $5,000 is the contract price. I entered into contract with you to provide the service. Where you are located? Outside India. Where I am located? In India. Okay. Now, either I can do the services completely to you, or I can get it done through a third person also. Now, I identified one third person who is outside India, and the third person has provided the third person has provided some services to you, and I provided some services to you. So, therefore, whatever the third person has provided services to you is to the extent of $2,000, and I provided services to you to the extent of $3,000. So, total contract price is for what? $5,000. Now, what you did is that you paid me $3,000 and you paid the third person $2,000. Okay. So, for you it is $5,000 cash outflow and $5,000 you have paid. So, but the problem came here with the GST department that, so I have raised invoice to you for how much? $5,000, but how much I received? Only $3,000. So, GST department is asking me that you realized only $3,000, so the value of export of service is only $3,000. But my argument is, had I received 5,000 and then I have given $2,000 to the third person, so then also I will have $3,000 only in my hand. You understood? So, rather than doing it, I directly asked my recipient to pay the $2,000. So, for that, CBIC gave a circular in favor to that person stating that yes, export of service is $5,000. However, the $2,000 which the third person has received will be like a import of service. How? First I am exporting service to you and I am receiving service from the third person outside India, which means $5,000 is export of service, provided on $2,000 you treat it as import of service and pay IGST under RCM. Okay. So, that is this circular. Then next, cargo handling services. In case of cargo handling services, whether we need to treat it like warehousing services or we need to apply the general provisions. If it is warehousing service, it will become service in relation to immovable property. Then location of immovable property will be taken as place of supply. But cargo handling services, even though custodian of the goods, after import of the goods will keep the goods in his place, but he is not providing any cargo handling like storage services, but he acts as a custodian of that goods. So, therefore, it should not be treated as service in relation to immovable property, but rather it should be general provisions. So, therefore, location of recipient will be taken as place of supply. That is this. And next, number 3, in case of testing on the sample prototype, say there is one product and that product has been imported into India and that product works on a software. So, now you are doing the testing on the software. So, testing on the software, that software is used for working of this product. Okay. Now, is it performance based service in relation to goods? No, actually we are not doing anything on the product, but we are testing the software. Testing the software means it will not come under performance based service in relation to goods. Therefore, it should be again general provisions only, because we do not have any specific provision. Suppose if you are doing any work on the product that is imported, you are not doing any work on the product imported, you are doing work on what? On the software with which the product will work. So, therefore, product also imported, software also it came along with the product, but you are testing on the software only. So, therefore, it should be general provisions. Then this fourth point already we discussed. In case of cutting and polishing activity in relation to diamonds etc., which is imported and exported after cutting or polishing. So, we will apply performance based service in relation to goods, exception number 1. Therefore, location of recipient will be taken as the place of supply. Then section 13 subsection 6 overrides other provisions of section 13. That is, there are total 4 cases you take. That is service in relation to immovable property, performance based service in relation to goods, and performance based service in relation to individuals and organizing an event. In all these 4 cases, place of supply, if it is in India, then India entirely it will be taken. Suppose if for entirely if it is provided outside India, place of supply will be outside India, because in case of service in relation to immovable property, location of immovable property is place of supply. In case of performance based service in relation to goods, location of performance will be taken. Even for individuals, location of performance. Organizing an event, location of event. Suppose if it is fully outside India, then outside India will be taken. What if it is partly in India, partly outside India? Void a single contract. Then for entire amount, the place of supply is deemed to be India. Okay. So these 4 services, partly in India, partly outside India, entirely it is deemed to be provided in India. So that is with respect to place of supply we completed, and section 14, like that one section is there. That section 14 is related to OIDR services, which already we have seen in exemptions. That is, in case of import of OIDR services, liability to pay GST is on supplier under FCM if it is imported by non-taxable online recipient, and who is taken as the supplier outside India for payment of GST. It is the original supplier or the intermediary through which the supply is being made. For example, Netflix. And Netflix, thereafter we have Play Store or App Store through which you have downloaded the Netflix app and you are streaming the videos. So now in that case, who is the intermediary outside India? Play Store or App Store. And who is the supplier outside India? Netflix. Who will be paying GST? So liability to pay GST is on, primary liability is on Play Store or App Store, intermediary outside India. But if they are not collecting the money, money is directly collected by the original supplier, then the original supplier will be having liability to pay. Otherwise, who will have the liability to pay? Intermediary. Why they kept it that way? Because it is easy to identify and tax the intermediary rather than the original supplier. You are downloading a game. When you are downloading a game, there is a game developer outside India and Play Store or App Store also outside India. Now you make some payment of charges. So these charges are collected by App Store or Play Store, yes. So then who is liable to pay GST? That App Store or Play Store only liable to pay GST because they collected the money. So primary liability is on whom? Intermediary outside India. If intermediary outside India is not collecting money, but original supplier is only collecting, that original supplier only will pay GST. Because FCM only, both cases FCM only, but in FCM also, who is that supplier who will pay GST is what is given in section 14. Then we have rules related to valuation. So when rules will be applicable? Transaction value is not applicable. When transaction value is not applicable, price is not sole consideration, supplier and recipient are not related. If price is not sole consideration, then rule 27. If supplier and recipient are related, then rule 28. But we have distinct persons also in rule 28. In case of distinct persons, won't the transaction value be applicable? Applicable, but even then we need to determine the value as per rule 28 only, because section 15 subsection 5 says that, so whenever there are some notified transactions for which valuation is specified, so we need to determine the value as per rules only as prescribed. So therefore, because 15 subsection 5 starts with notwithstanding anything contained in 15.1 and 15.4. So which means that 15.5 says, for example, distinct persons, we have a rule. Means distinct person, that rule only will be applicable even though transaction value is applicable. Same way, rule 29, principal agent transaction. Even though transaction value is applicable for principal agent transaction, we need to apply rule 29 only. So 27 is price is not sole consideration. 28, related party transaction or transaction between distinct persons. 29, principal agent transactions. So in case of 27, when price is not sole consideration, so whether it is applicable for both goods and services? Yes, both goods and services. First we need to take open market value. If open market value is not ascertainable, money received plus money value of non-monetary consideration. If that is also not ascertainable, then like, kind and quality. If that is also not ascertainable, then cost plus 10%. What is the difference between open market value and like, kind and quality? Open market value is between two unrelated buyers on the two unrelated persons on the same date. So you can see there comparable time. Comparable time should be open market value same day. Means, for example, I am selling one product to you and in exchange of an old product, and you are giving me some price differential. Okay. So now in that case, open market value today, same day. So today between two unrelated parties, this product is sold at a price. So that will be taken as the open market value. And suppose if the open market value is not ascertainable, then only we go for money received plus money value of non-monetary consideration. If that is also not ascertainable, then LKQ. LKQ, the comparable time can be any nearest date, not necessarily the same date in which the transaction happens. Comparable value, open market value should be transaction value, but like kind and quality can be transaction value or value determined under rules. Last month also some transaction happened like this. At that time we determined the value as per rules. Can that be taken as value for this month? Yes, we can do. That is a meaning. And number 3, comparable supplier. In case of open market value, it is the same supplier or any other supplier, but LKQ it will be same supplier. Comparable goods, in case of open market value, same goods. In case of like and quality, same goods, but minor differences is also acceptable. For example, color differences or little bit of feature differences, etc. that is acceptable. Then, so we need to first take open market value, if not money received plus money value of non-monetary consideration. Why open market value not possible? Because on that particular date between two unrelated buyers we are unable to identify the price. So that's why open market value not ascertainable. Okay. Money received plus money value of non-monetary consideration. Why this is not ascertainable? Because this money value of non-monetary consideration cannot be determined. If we will go for like kind and quality. Like kind and quality also why not available? Such kind of goods are not sold at any nearest date. So then in that case finally cost plus 10%. Cost plus 10% is given under rule 30. Rule 30. And what should be taken as cost? If you are a manufacturer, we need to take cost of production. If you are a trader, you need to take cost of acquisition. If you are a service provider, you need to take cost of providing the service. And in the second point will be missing. So second point will be missing, correct? So open market value, like kind and quality, cost plus 10%. Okay. So what is that second one? Transaction between related parties and or distinct persons. So we don't have money received plus money value of non-monetary consideration, just 3. Open market value, like kind and quality, cost plus 10%. Again in the third point will be missing. Okay. So that is open market value, cost plus 10%. Understood or not? So first 4 points, what are they? OMV, money received plus money value of non-monetary consideration, like kind and quality, cost plus 10%. Second point is rule 28. In that rule 28, second point will be missing. Open market value, like kind and quality, cost plus 10%. In third point, that is rule 29. So LKQ, third point also missing. So open market value, cost plus 10%. And then in case of 28, open market value, what should be taken as open market value? So if the recipient is eligible for full ITC, open market value is deemed to be the transaction value. So that is when recipient is eligible for full ITC. If you are the recipient, your outward supplies are exempted. Are you eligible for full ITC? No. Your outward supplies are partly taxable, partly exempted. Are you eligible for full ITC? No. Means your outward supply is fully taxable, then you are eligible for full ITC. So then in that case, whatever value that I declare, that will be taken as a transaction value. Even 1 rupee also can be declared as transaction value. That itself will be taken as the open market value. Is it clear? Suppose if recipient is not eligible for full ITC, then open market value needs to be ascertained. Then alternatively, that is without applying this, for rule 28, we have alternatively one point, that is 90% of the resale price. That is, I am selling to you, you are my related person, I am selling to you. You subsequently sell to an unrelated buyer. That subsequent sale to an unrelated buyer into 90% will be taken as my value. Means the logic is what? You will be adding 10% profit and you will be selling. So therefore, whatever is the resale price into 90% will be taken. But this resale price into 90% is applicable only in case of goods. Only in case of goods, and that too you are not selling it after processing. Means you are selling it as such. You are selling it as such. Recipient should not process those goods but should have been sold it as such. And this rule 28 is applicable in case of both goods and services. Next, principal agent transaction. Principal agent transactions is applicable under rule 29, and here it is OMV or 90% of resale price at the option of the supplier. And principal agent transaction is applicable only in case of goods. And OMV or 90% of resale price at the option of the supplier. If this is not possible, then only cost plus 10%. Suppose if this value is not possible, even cost plus 10% also not ascertainable, then value will be determined by GST officer, that is residual value, rule 31. And in rule 30, for cost we will be taking cost of production in case of manufacturer, cost of acquisition in case of trader, and cost of providing service in case of service provider. And this open market value is deemed to be the transaction value. I told you that even 1 rupee invoice also can be taken. In such case, invoice can be generated for any value, even 1 rupee invoice can be considered. Then in case of services, we can skip rule 30 and can proceed to rule 31, because cost of providing the service will be difficult to determine. Then this is the GST implications on debit note and credit note. Already we have seen that in time of supply. So it's a continuity point. So whenever debit note is issued, who will be giving debit note? Supplier to recipient. Whenever recipient has to pay an amount extra than the invoice value, and invoice value increases, so then debit note. So because of debit note, what is the consequence to the supplier? Increase in liability. So where supplier has to report this? GSTR 1 and GSTR 3B. And what is the consequence of debit note to the recipient? Increase in ITC. So where recipient has to report that? Only in 3B. Only in 3B he will take the ITC based on debit note. Then credit note. Credit note, who will be giving to whom? Supplier to recipient when there is a reduction in the invoice value. And is there any time limit for issuance of credit note? Yes, 30th November of next financial year or date of filing annual return, whichever is earlier. What is the consequence of credit note to the supplier? Decrease in liability. And where the supplier has to report it? In GSTR 1 and GSTR 3B. And what is the consequence of this to the recipient? There will be reversal of ITC. If he has ITC balance, it will get reversed. If he is don't having ITC balance, it will be added to the liability, and it will be reported in 3B under reversal of ITC. Then we have rule 31A, that you see rule 31A. So up to rule 31 we have seen. Rule 27, in case of price is not the sole consideration. 28, related party including transaction between distinct persons. 29, principal agent transactions. 30, cost plus 10%. 31, residual value. 31A, value of supply in case of lottery, betting and gambling transactions. So see page number 55. In case of lottery, betting and gambling, so we need to take face value of the ticket or price notified by the organizing state, whichever is higher, and this particular price should be assumed to be inclusive of GST. So into 100 divided by 128 is value, into 28 divided by 128 is GST. So price printed on the ticket or price notified by the organizing state, whichever is higher, should be taken. In case of betting and gambling transactions, the total bet value should be taken as the value, and on the GST will be payable on inclusive basis, not the commission earned by the totalizer. Say for example, if 1000 people are placing the bet, and so in that 600 people place the bet in favor and 400 people place the bet against, okay, odds in favor, odds against. Now in that case, so all 1000 people will pay the money, so on the total bet value GST will be payable, and thereafter commission will be deducted and remaining amount will be given to the people who win the particular bet, okay, understood. So therefore total bet value means whether you are winning or losing, you pay money on the GST will be payable, so government will be winning, you understood or not. So how much will be the GST on that? 28%, and that 28% will be computed on a inclusive basis, okay. So that is this 31A. Now 32, come back. So 32 is applicable in case of 5 notified transactions. So what are those 5 notified transactions? In case of money changing, foreign exchange transaction including money changing, rule 32 sub rule 2 will be applicable, and air travel agent, rule 32 sub rule 3, and in case of life insurance business, rule 32 sub rule 4, and second hand dealer in goods, rule 32 sub rule 5, and in case of vouchers or coupons, rule 32 sub rule 6. These are the five cases: foreign exchange transaction including money changing, and then we have air travel agent, life insurance business, second hand dealer in goods, and vouchers or coupons. And these 5 cases we have a simplified valuation methodology, and this is optional, not necessary that we need to follow this only. This should be compared between transaction value, either transaction value or value under this rule at the option of supplier. For each supply, each invoice they can decide. You understood? And therefore in exam also be careful, whenever they are asking the question on rule 32, they may give the transaction value information also. Now you need to check the transaction value information and this rule 32, whichever is beneficial only we need to select as the value of supply for payment of GST. Okay, first, in case of foreign exchange transaction, what will be taken as a transaction value? Transaction value is nothing but the currency conversion fee or the markup fee that will be taken as a transaction value. That is, whenever you are giving some $100 and getting into Indian rupees, they will be deducting some amount as currency conversion fee or currency markup fee. That currency conversion fee or currency markup fee will be taken as a transaction value. So what will be taken as transaction value? Please write there. Currency conversion fee or currency markup fee. Currency conversion fee or currency markup fee, that will be taken. Okay, currency conversion fee or currency markup fee will be taken as the transaction value as per section 15. Whereas what will be taken as a value under rule 32? In rule 32, again we have rule 32 2A option 1 and rule 32 2B option 2. Rule 32 2A says that one of the currency exchange involves Indian rupee and RBI reference rate is available on that day. For example, rupee per dollar is 80 and 83, and so $100 exchanged for rupees, $100 exchange for rupees, and RBI reference rate is 82 per dollar. Now what will be taken as the value? So simple, value will be, this is as per rule 32 2A. As per rule 32 2A, value, what will be taken as a value? First you need to determine which is the exchange rate. So they are exchanging $100, means they are selling dollars. Then what bank is doing? Bank is buying dollars. So then bid rate will be relevant, 80. 80 and 82, the difference is what? 2. So ignore that negative, ignore that positive or negative. So exchange rate is 80 and RBI reference rate is 82. So that is 2 into how many units of currency? 100. So therefore it will be coming to 200 rupees will be taken as the value. And suppose if RBI reference rate is not available, if RBI reference rate is not available, then what will be taken as a value? Then gross amount exchanged in Indian rupees. So $100 into rupees 80 per dollar into 1%. So that will be taken as a value. That is 80 rupees will be taken as the value. This is when if RBI reference rate not available. Then if RBI reference rate not available, so we will be taking this. Then if both the currencies exchange involves foreign currency, then what we will do? Convert both the currencies into Indian rupees using RBI reference rate, multiply with 1%, whichever is lower. What if RBI reference rate is not available here? We cannot determine the value as per rule 32 2A. Then in that case what we need to do? We need to take transaction value. What is a transaction value? Currency conversion fee or currency markup fee. Then rule 32 2B is following a slab rate model. So what is that slab rate model? First we need to see the first slab up to 1 lakh. So up to 1 lakh it will be 1% of gross amount. 1% of gross amount or 250 rupees, whichever is higher. Okay. And say for example 80,000 rupees. 80,000 into 1%, 800. 800 or 250, whichever is higher, 800. If it is 20,000 rupees, 20,000 into 1%, 200. 200 or 250, whichever is higher, 250. And exactly 1 lakh. 1 lakh into 1%, 1000. So 1000 or 250, whichever is higher, 1000. So therefore when you are into the second slab, what is the fixed amount? 1000 rupees. And the second slab is up to 10 lakhs. So 1000 rupees plus 0.5% of gross amount exceeding 1 lakh. Gross amount exceeding 1 lakh. Say for example 8 lakhs. First 1 lakh it is 1000. And remaining 7 lakhs. 7 lakhs into 0.5%, 3,500. 3,500 plus 1000, 4,500. And suppose if it is exactly 10 lakhs. For first 1 lakh it is 1000. Remaining 9 lakhs. 9 lakhs into 0.5%, 4,500. 4,500 plus 1000, 5,500. So when you are into the third slab, the fixed amount will be 5,500. 5,500 rupees plus 0.1% of gross amount exceeding 10 lakhs. Exceeding 10 lakhs. Say for example, if the amount is somewhere 400 lakhs. For 400 lakhs, 10 lakhs it will be 5,500. Remaining 390 lakhs. So 390 lakhs into 0.1%. That will be 39,000. 39,000 plus 5,500, that is 44,500 will be taken. But this is subject to maximum of 60,000. Subject to maximum 60,000. Say for example 800 lakhs. For 10 lakhs it will be 5,500. For remaining 790 lakhs into 0.1%, 79,000 plus 5,500, 84,500, subject to maximum 60,000. 60,000 will be taken as the value. That is the answer for this. So that is about 32(2)A and 32(2)B. This 32(2)A and 2B, option 1, option 2, to be decided in the beginning of the financial year. So transaction value versus this rule 32, each invoice. But once you go for rule 32, in this case, 32(2)A or 32(2)B is to be decided in the beginning of the financial year, which shall be applicable throughout the financial year. Then next, air travel agent. In case of air travel agent, what will be taken as a transaction value? Transaction value is the commission. Whatever is the commission that the air travel agent gets, that will be taken as the transaction value. Commission earned. Commission earned will be taken as transaction value. But in case of rule 32, we need to take domestic bookings and international bookings. In domestic bookings, we need to see what is the base fare. So 5% of the base fare in case of domestic bookings and 10% of the base fare in case of international bookings. Then in case of life insurance business, what will be taken as a transaction value in case of life insurance business? It will be premium collected. Transaction value is nothing but premium collected. And this rule 32, we have policies. Life insurance business policies are divided into 4. Risk premium or risk cover policy. In case of risk cover policy, it is like a term insurance. So entire premium will be treated as income to the insurance company. So therefore that will be taken as a value. Whereas single premium annuity policy, only one premium will be paid. So therefore 10% of that single premium. And if it is reinvestment policy, where amount allocated for investment is communicated to the policy holder, then how much is the premium collected minus amount allocated for investment. For example, 85% allocated for investment, the remaining 15% will become the value of the insurance company. Then if it is other policies, 25% of the first year premium and 12.5% of the subsequent year premium. Means those who took the policy this year, their premium into 25%. Those who already took the policy previous years, they will pay premium this year. On that it will be 12.5%. That will be taken as value. Then in case of purchase and sale of second hand goods, so the person is not purchasing new goods and selling old goods. So they are purchasing second hand goods, they are selling also second hand goods. Then in that case, what will be taken as the value? So the value, transaction value, if you see, the transaction value is nothing but the sale value will be taken. Transaction value is nothing but sale value should be taken. Say for example, if there is a person, second hand dealer in car, so that second hand dealer in car will be purchasing one car, second hand car, and will be selling cars, purchasing second hand car for 1,50,000 and selling the car for 2,50,000. Now what will be taken as the transaction value? 2,50,000. On the 2,50,000 GST payable, but under rule 32 we have a margin scheme. So under that margin scheme we need to take price as what? Selling price minus purchase price. So value will be selling price minus purchase price. That is margin scheme. But for example, in this case, 2,50,000 is the price at which it is sold. And what is the price at which it is purchased? 1,50,000. So 2,50,000 minus 1,50,000. 1 lakh will be taken as a value for payment of GST. But important condition is that ITC should not be availed on purchase. What if the margin is negative? For example, they are purchasing for 1,50,000 and it is sold for like say 1 lakh. Then in that case, purchase for 1,50,000, sold for 1 lakh. Should they take any value addition there? No. So therefore negative value addition, and that will be taken as 0. And even this margin scheme is applicable in case of repossession. So that is a financier who gives finance for a particular asset and he repossesses that asset. If the installments are not paid, that asset he will sell it off. In that case also margin scheme will be applicable. So selling price will be taken as the price at which the repossessed asset is sold. But what will be taken as the purchase price? Purchase price is like he did not purchase it, so he did not buy it, he repossessed it. So we need to take the original purchase price of the defaulting borrower as reduced by 5% for every quarter or part thereof, means we need to give depreciation 5% for every quarter or part thereof from the date of purchase till the date of disposal of the repossessed asset. Okay, original purchase price minus 5% for every quarter or part thereof from the date of purchase till the date of disposal of repossessed asset. Then next, in case of vouchers or coupons, what will be taken as the value? So transaction value in case of voucher or coupon, so we have value equals to, so redemption, that is actual amount paid, So transaction value will be actual amount paid. For example, now I am purchasing one voucher. I am purchasing one voucher by paying 500 rupees, and that voucher, if it is redeemed, will get goods worth rupees 1000. I purchased that voucher for 500, and this voucher, if I am giving to you as gift, and you go and redeem that voucher, you can redeem it for what value of goods or services? 1000 rupees worth of goods or services. So therefore, what will be taken as the value under rule 32? Money value of the supplies redeemable against such voucher or coupon will be taken. Okay. So this transaction value, actual amount paid, or actual value of actual amount paid or payable for goods or services, supplied, against voucher. Here transaction value as well as rule 32 value more or less the same. So how much ever is the actual amount paid or payable for the goods or service supplied against the voucher, or the value, money value of supplies redeemable against such voucher will be same. So more or less transaction value or rule 32 value will be same in this case. And this actual amount paid is not known today. That will be known only at the time when you are coming and redeeming. So, but I have to pay GST today itself. That's the reason why they have given rule 32. In case of identifiable vouchers, the time of issuance of voucher will be taken as the time of supply. So means today itself I have to pay GST on that voucher. But you will come and redeem this voucher in future. But until that point of time, if I wait, unnecessarily there will be interest burden on me. Why there will be interest burden on me? Because the time of supply is at the time of issuance of voucher. So today I have to pay GST, but I don't know what is the value of this voucher. So what is the product or service mentioned in the voucher? So that money value of the product or service mentioned in the voucher will be taken as a value of voucher for payment of GST. That is this. Is it clear? Then, in case of rule 32 sub rule 7, actually rule 32 sub rule 7 is not applicable at present because services are not notified for this purpose. That is, in case of services between distinct persons without consideration, the value will be taken as nil, but we don't have this rule 32 sub rule 7 right now. So we have only these 5 cases. So that is about rule 32. So we have completed rule 32 also. 33 also we have seen. 33 is what? Pure agent, and 34 is exchange rate. In case of, so look into page number 56, in case of goods or services which are being denominated in foreign currency, so we need to convert it into Indian rupees. For the purpose of converting into Indian rupees, we need to take, in case of goods, CBIC rate, and in case of services, GAAP rate. What is the GAAP rate? Average of the buying rate and selling rate should be taken. And CBIC rate for goods and GAAP rate for services. On which date? On the date of time of supply. First we need to determine the time of supply for goods under 12 and time of supply for service under section 13, and in case of goods CBIC rate, in case of services GAAP rate. GAAP rate is average of buying rate and selling rate, and by recognizing this rate we pay the GST. But actually there may be an exchange gain or loss. Again on that, whether we need to pay any GST or not, no need to. So we should ignore that actual exchange gain or loss. For example, we recorded the transaction at 80 rupees per dollar and paid GST, but actual realization is 83 rupees per dollar. On that 3 rupees again should we pay GST? Not required. Then rule 35 is, whenever the amount is collected without charging GST separately, the amount so collected shall be assumed to be inclusive of GST. That is rule 35. Up to rule 35 only we have. Then look into this circulars. Two circulars are there. One is related to TCS. So TCS not to be included in the value. That is TCS under Income Tax Act. Generally as per section 15 subsection 2 clause A, any taxes, duties and cess by whatever name called other than GST should be included in the value. But this TCS which is deducted by the recipient, collected by the recipient along with the price of the goods. For example, so say I am seller, you are my buyer, I am collecting some TCS from you, and that TCS should be included in my value? No, because this TCS is an interim levy, not having the character of tax. This TCS I will collect and pay it to the income tax department, which my recipient, you, will be able to take it as credit in your income tax, correct? That TCS is not a tax on income, that TCS is tax on expenditure. So due to that reason, this TCS should not be included in the value because it is an interim levy, not having the character of tax. What about TDS? Whether TDS deducted by the recipient should be included in the value? Of course yes, because TDS is nothing but my income tax, correct or not? So when you are deducting, that is also part of my income, and TDS deducted by the recipient should be included. Then in case of banking company, they will appoint business facilitators or business correspondents. These business facilitators and correspondents receive the service charges from the customer and remit them to the banking company. Now in that case, on that service charges, it should be included in whose value? Business facilitator correspondent value or the banking company value? Banking company value. Then what should be included in the value of supply of business correspondent or business facilitator? Only the commission. Only the commission that they are earning should be included. In that also, business facilitator, GST is payable under RCM by banking company. Business correspondent, it will be FCM. Okay. With this, we completed value of supply also. So rule 42 talks about manner of availment of ITC with respect to inputs and input services. What is the procedure to be followed for availment of ITC? And rule 43 is in case of capital goods, and rule 42 is simple here. First, we need to see total invoices. Okay, so we have to take what are all the total invoices that we have. In the total invoices, we need to segregate that invoices into 4. What are those 4 boxes? So non-business purpose, non-business, exempted supplies, blocked ITC, taxable and business purpose. Like that we need to segregate. That is, we have some invoices, that invoices we need to segregate into these 4, and after segregation into these 4, still if we have some invoices, so that invoices will be called as common ITC. Okay. For example, we have some invoices worth rupees 10 lakhs ITC. Okay, 10 lakhs of ITC worth invoices we have in this. Okay, GST paid invoices 10 lakhs. Now this 10 lakhs invoices, so what is the 10 lakhs? ITC component, that is GST component. Okay, so in that, how much is the ITC with respect to these invoices used for non-business purpose? Say 1,50,000 non-business purpose, exempted supplies 1 lakh, and blocked credit 50,000, and used for taxable and business purpose 4 lakhs. Still there is some balance left, correct? What is that balance that is left? 10 lakhs minus 1,50,000 minus 1 lakh minus 50 minus 4 lakh. The remaining is what? 3 lakhs. That 3 lakhs is known as common credit. Now this 3 lakhs we need to reverse proportionately. To what extent? To the extent of exempted. So we need to take the exempted turnover and taxable turnover, total turnover. Say exempted turnover is 400 lakhs and total turnover is 1000 lakhs. Okay. So now what we need to do? 3 lakhs into 3 lakhs into 400 divided by 1000. So we need to do the proportionate reversal. So 3 lakhs into 400 divided by 1000 means 40%. That is 1 lakh. 1,20,000 we need to reverse with respect to exempted supply. Same way, in this common credit, there could be some invoices which are partly used for business and partly used for non-business purpose. Then how we need to segregate that? So it is difficult to apportion. That's the reason why total common credit into flat 5%. So 3 lakhs into 5%, that is 15,000 rupees will be taken out as non-business purpose, which means what is the ITC availed in 3B? What is the ITC availed in 3B? Listen. So ITC availed in 3B already I told you. You take the total ITC. Total ITC is 10 lakhs minus blocked credit. We should take out, correct? Blocked credit. Three things we should take out. T1, T2, T3. T1 blocked credit. T1 non-business purpose. T2 exempted. And T3 blocked credit, that should be taken out. Okay. Then, so this once we are taking out, the remaining is known as ITC availed in 3B. So what is the ITC availed in 3B? 10 lakhs minus 1 lakh 50 minus 1 lakh minus 50. So therefore 7 lakhs. 7 lakhs we will be taking as ITC in 3B. In that 7 lakhs, 4 lakhs fully you can enjoy. Remaining 3 lakhs fully you cannot enjoy. Proportionately you can take ITC. So therefore, what is the ITC availed in 3B? ITC availed in 3B is 7 lakhs. How we got 7 lakhs? C1 T minus T1 minus T2 minus T3 will be called as C1. And then, so this credit we avail minus ITC reversal under rule 42. What is the ITC reversal under rule 42? 1,20,000 and 15,000, that is 1,35,000 we will reverse. So remaining is known as the ITC available for set off. Therefore 7 lakhs minus 1,35,000, that is 5,65,000 will be taken as the eligible ITC for set off. So therefore this format you need to remember. So T refers to total ITC on inward supplies and minus T1. Out of these inward supplies, how much is used for non-business purpose? T1. Same way, out of this inward supply, how much is used for exempted outward supply? T2. Then out of this inward supply, how much are blocked credits? That is T3. So once we take out this T1, T2, T3, the balance is known as C1. That is availed ITC. Where we will avail this ITC? Availed in GSTR 3B. Availed in GSTR 3B. So from this we need to reduce T4. Means out of this total ITC, how much are used for taxable outward supply or for business purpose? That is T4. Now the remainder is known as C2. So C2 is common credit. So but this common credit is already availed, correct? Common credit is already availed. So now we need to do the reversal. So minus D1. So D1 is common credit attributable to exempted supply. So C2 into E by F. So E is exempted turnover, F is total turnover, minus D2, that is common credit attributable to non-business purpose, that is 5%. So these two will be called as reversed in 3B, reversed in GSTR 3B. So availed in GSTR 3B is C1 and reversed in GSTR 3B is D1 and D2. So that difference is what we can take as ITC for set off. Okay. So this template you need to remember, and in the question whenever you get, so follow that, and the logic is very, very simple here. Because anyhow T1, T2, T3 you will not be taking the credit, because inward supply is for non-business, inward supply used for exempted, inward supply used for blocked credit, you should not take the credit. So you will not take the credit, and T4 fully you can take, but common credit you cannot take fully. So common credit proportionately you should be taking the credit. What is that proportionately means? You need to reverse with respect to exempted supply and non-business purpose. Please respond there, you are understanding this or not. So non-business purpose, how should we take? total common credit, means even if that one invert supply is used for non-business purpose, but the entire common credit we need to reverse 5%. I don't want to do that. Super. Then segregate here itself. You could segregate here itself. For example, you have renting of immobile property. 1/3 of the immobile property used for non-business purpose. 2/3 is used for business purpose. You know now clearly how much is non-business purpose. Then 1/3 you put it under T1, so that it will not come in common credit. If it is not coming in common credit, this 5% reversal is not required. Suppose you are not able to segregate in T1, so then only it will be coming into common credit, and then only you need to multiply with 5%. Then this computation should we again do at the end of the financial year? Yes, again we need to do at the end of the financial year. And this computation when we do at the end of the financial year, we need to again compute D1 and D2. So D1 and D2 monthly D1 and D2 for all months versus D1 and D2 computed at the end of the financial year. If there is any differences, the differences may arise because of change in the ratio, change in the turnover or etc. Then in that case, suppose if the final D1 D2 is greater than monthly D1 D2 computed, means what we have reversed is 10 lakhs, what we need to reverse is 12 lakhs. Then the extra 2 lakhs needs to be reversed by 31st March, because by end of that financial year we need to do. Otherwise, from April 1st of the succeeding financial year, we need to pay interest at 18%. Say this. So the differential amount will be added to output tax liability, and interest will be payable at 18% from the 1st April of the succeeding financial year till the date of payment. Okay. Suppose what we have reversed is 12 lakhs, what we need to reverse is only 8 lakhs, means excess reversed 4 lakhs. That excess reversed 4 lakhs can be availed as ITC. What is the time limit within which this reversal or availment should have been done? By September end of the succeeding financial year. Not November end, September end only. There is no amendment here. By September end of the succeeding financial year, either availment of ITC or reversal of ITC should have been done. Okay. If this amount is less than the amount added to output tax liability, then the additional amount paid has to be claimed back as credit in the return of any month till the September of the succeeding financial year. Okay. Now, so yes, sir. No, you can make the payment of this even through DRC3 also. There is something called as DRC3 na. So through DRC3 also we can make the payment. Okay. So that the 20 days interest also we can avoid. Then rule 43, manner of reversal or availment of ITC with respect to capital goods. So in case of capital goods, rule 43 will be applicable. So what we need to check is that whether the capital goods are used for taxable or business purpose. Yes, then we can enjoy the ITC with respect to that capital goods. If the capital goods are used for exempted or non-business purpose, then you cannot take ITC on that capital goods. If the capital goods are partly used for taxable or business purpose and partly used for exempted or non-business purpose, then we can take the ITC, but this ITC will be called as common ITC. Over the next 60 months, we need to do the proportionate reversal. So what is the treatment in case of capital goods 2? Avail 100% ITC in the month in which we have purchased the capital goods. Say for example, capital goods is purchased in the month of April on 10 lakhs, GST paid is 1,80,000 rupees. So therefore, entire 1,80,000 we will avail as ITC in the month of April itself in which it is purchased. And thereafter, we need to compute the monthly ITC. How to compute the monthly ITC? Total ITC is how much? 1,80,000 divided by 60 months. So here, life of the capital goods is considered as 60 months. Can there be a lower life also given in the question? Yes. They can give 48 months also, you take 48 months, you don't take 60 months because the words used in the law is up to 60 months. So therefore, divided by 60 months. If nothing is given in the question, you take divided by 60. So 1,80,000 divided by 60. What is the monthly ITC? 3,000 rupees. That monthly ITC, you need to reverse every month proportionate to exempted to total of that month. So 3,000 into say exempted turnover of that month is 10 lakhs and total turnover of that month is 50 lakhs. So 10 divided by 50. Next month 20 divided by 80, like that. So every month we need to do the proportionate reversal, and that amount will be added to liability or reverse along with interest at 18%. But here still it is given as from the date of availment of ITC till the date of addition to liability. Okay. So they have not changed it to from the date of reversal, that is utilization of ITC till the date of addition to liability, that is not given. Okay. And therefore this provision only you remember. And when this capital goods E by F computation we need to stop, that is this we need to do for how many months? 60 months. 60 months we need to do. Up to the date when the capital goods is in your possession. Means suppose if you are selling the capital goods after 36 months, again are you required to do this E by F computation? No. So therefore the above procedure is not required from the month when capital goods are sold. Why? Why? Because whenever capital goods are sold, in that case there is one section 18 subsection 6 that will come into the picture due to that reason. What does section 18 subsection 6 says? If you purchase any capital goods, on that capital goods if ITC is availed, then we need to take GST payable as total ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of disposal, or GST payable on sale value of that capital goods, whichever is higher. For example, we purchased capital goods on 5th April 2021 and sold it on 28th October 2023, okay, for 8 lakhs, it is purchased for 10 lakhs excluding GST at 12%. Now, what is the ITC availed? 1,20,000. 1,20,000 minus 5% for every quarter or part thereof from 5th April 2021 to 28th October 2023. How many quarters? So, April, May, June, July, August, September, October, November, December. So, 2021 3 quarters. 2022 4 quarters. And 2023, so again 4 quarters, 28th October, part of the quarter. So 4 plus 4 plus 3, so therefore 11 quarters. 11 quarters into 5%, that is 55%. So therefore 1,20,000 minus 55%, that is 54,000. 54,000 or GST on sale value, 8 lakhs into 12%. 8 lakhs into 12%, 96,000, whichever is higher. So therefore 96,000 will be taken as the GST payable. Is it clear? So as anyhow we are paying the GST on that, that's the reason why from that moment onwards we don't have to do the E by F computation. Then whenever it is refractory bricks, molds and dies, jigs and fixtures are sold as scrap. In that case, what we need to do is that we don't have to take A or B, whichever is higher, just we will take B, that is GST on sale value. Means this section is not applicable in case of refractory bricks, molds and dies, jigs and fixtures supplied as scrap. Then in that case what we need to do? GST payable on what? GST payable on transaction value. GST payable on transaction value. Now, there are two special situations in this case, that is initial purchase CG1. CG1 is what? Used for taxable, and at a later point of time it is used for both taxable and exempted. Say this. So, life of the capital goods is 5 years and 3 years we are using it for taxable. 3 years we are using it for taxable, and thereafter it has become common. Okay. Now, common means used for both taxable and exempted. So, at the time of purchase, say April 1st, 2021. So, what is the life of the capital goods? March 31st, 2026. Correct? So, life of the capital goods is 5 years. April 1, 2021 itself. So, whether we will avail the ITC? Yes. So, we will avail ITC in April 1, 2021 itself. You understood or not? So because we are using it for taxable, so don't avail ITC now. Is it clear? Don't avail ITC now, but now treat it as common ITC. Now treat it as common ITC, and for the next 24 months, we need to do E by F reversal. Got it? Again, I am repeating, initial purchase we are using it for taxable. At that time itself we would have availed the ITC. In the month of conversion, we will recognize it as common ITC and we will do the proportionate reversal E by F for the next 24 months. And what will be taken as monthly ITC? Total ITC divided by 24 or total ITC divided by 60? Total ITC divided by 60 only. But we will do reversal for the next 24 months. That is this. Initial purchase CG1 means used for taxable. And at a later point of time CG2, that is used for both taxable and exempted. ITC already availed at the time of purchase, so no need to avail common credit. Monthly ITC will be original ITC by 60, proportionate reversal from the date of conversion for the balance life. Now, suppose if it is the same, initial purchase, it is used for exempted and thereafter you are using it for common. Okay. Now, whether we would have availed ITC at the time of purchase? No. So, because it was used for exempted, we would not have availed ITC. So, when we need to avail the ITC? So, from the date of conversion, we will avail the ITC, and for the next 24 months, we need to do E by F reversal, plus for the past period also, we need to do ITC reversal. Why? Because for the past period, we are using it for exempted. So, full 3 years, see, for example, we purchased for 10 lakhs. 10 lakhs into 18%, 1 lakh 80. How much we avail as ITC? How much we will avail as ITC? Entire 1 lakh 80 we are availing. So, even though it is used for 3 years for exempted, today you are availing ITC how much? 1 lakh 80,000. But last 3 years it was used for exempted. So, we need to reverse. How much we need to reverse? 1 lakh 80,000 into 5%. 3 years means how many quarters? 12 quarters. So, 12 quarters you need to reverse. So, 1 lakh 80,000 into 12 into 5%, that is 1 lakh 8,000 we will reverse. Is it clear? Now, so what is the E by F reversal? What is a monthly ITC? Monthly ITC is 1 lakh 80 minus 1 lakh 8 divided by 60 or 1 lakh 80 by 60. 1 lakh 80 by 60 only. 1 lakh 80 by 60 only. 1 lakh 80 by 60, 3,000, but you need to do reversal for next 24 months. So, that is this. So, therefore, ITC not availed at the time of purchase, so it should be availed now. How much should be availed now? Original GST paid, okay. And ineligible ITC to be reversed for the period it was used for exempted, past period. How much is that? GST paid into 5% into number of quarters or part thereof from the date of purchase till the date of conversion. And what is the monthly ITC? Original ITC divided by 60. And we need to do the proportionate reversal from the date of conversion for the balance useful life. So, these are the two cases, CG1 to CG2 or CG3 to CG2. So, we completed rule 42 and rule 43. So, what we have seen so far is section 16. So, first we have started with section 41, only matched ITC can be taken. Then section 49 subsection 5, manner of utilization of credit. And then we have seen section 16, conditions for availment of ITC. Then section 17, apportionment of credit we completed, but still we have blocked credits, NBFC related and other points that we will see after a break, okay. So, say this. So, job work provision section 19 read with section 143. So, that is whenever the capital goods or any goods which are sent to the job worker by the principal, say I am the principal, you are the job worker, I am sending the raw material to you and I should ensure that the processed goods are brought back to my premises after completing the process within 1 year, and this 1 year time limit can be extended for a further period of 1 year. And same way capital goods are sent to the job worker. What is the time limit within which it should be returned back to the principal's place? 3 years, and it can be extended for a further period of 2 years. And what if the goods, processed goods and capital goods, are not brought back within the time stipulated under section 143? Then in that case, it will be deemed as supply. But when it will be deemed as supply? After expiry of that 1 year or 3 years, or is it deemed as supply at the time of dispatch to the job worker? At the time of dispatch to the job worker itself, it is deemed as supply, which means after 1 year, after 3 years, you came to know that 1 year before, 3 years before, you have got the liability. Now you need to discharge that along with interest. Here we have interest, okay? Here we have interest. So say this. That is, so we have some inputs, and inputs are sent to the job work, and capital goods are sent to the job work. What is the time limit within which capital goods should be received? Within 3 years. And what is the time limit within which input should be received? Within 1 year. Within 1 year. And so whenever these inputs and capital goods are sent to the job worker, and it should be received within that time, if it is not received within that time, then it is deemed as supply. It is deemed as supply on the date it is dispatched to the job worker, correct, by the principal. And suppose if the goods are directly sent to the job worker from the raw material supplier's place. So I am not receiving, I am directly dispatching it from my raw material supplier to your place. Then in that case, this 1 year or 3 year will be counted from the date of receipt by the job worker. So deemed as supply on the date of receipt by the job worker. Is it clear or not? Then ITC, whether required to be reversed by principal when the goods are sent to the job work? No, no. And such goods should be sent under the cover of a delivery challan and e-way bill. Even if goods are directly received by the job worker, but the principal can take ITC. What is that? Bill to ship to. So whenever the goods are received by the job worker, the principal can take ITC with respect to that. Then some additional points in this regard. So you are using the inputs for making the process. Can you take ITC with respect to that? Your job worker, you are using some inputs for processing. Can you take ITC with respect to the inputs that you have purchased? Yes, there is no restriction. And if processed goods or capital goods are returned by job worker after 1 year or 3 years, as the case may be, now whatever we paid as GST, we can avail as ITC. Whatever principal has paid as GST, they can avail as ITC, or it will be treated as new supply by the job worker. It will be treated as new supply by the job worker. So therefore, what happens here? First of all, I am principal. I am sending the goods to you. I should ensure that I am bringing back the goods within 1 year or 3 years, as the case may be. Processed goods should be brought back within 1 year. Capital goods should be brought back within 3 years. If it is not coming within 1 year or 3 years, on expiry of 1 year or 3 years, for me principal, it will be treated as supply, and I need to pay the GST along with interest, because the time of supply will be taken as date of dispatch to the job worker or the date of receipt by the job worker, as the case may be. When date of dispatch to the job worker? Whenever principal is sending it to the job worker. When it is date of receipt by the job worker? Whenever the goods are directly sent to the job worker's place by the supplier of the principal, Then with that it is over. Now after 1 year or 3 years, the job worker is returning those goods. Now in that case, what is the treatment? It should be treated as new supply of goods made by the job worker to the principal. That is this. And this period of 1 year and 3 years can be extended for a further period of 1 year and 2 years. Means for processed goods, what is the time limit? 1 year plus 1 year. For capital goods, what is the time limit? 3 years plus 2 years. And suppose if the job worker is not registered, the principal should show job worker's place as additional place of business of the principal. What if the job worker is registered? No need to show that as additional place of business. Then jurisdictional officer must be intimated about the job worker contract. And processed goods, that is, I am sending the raw material to you. You are processing. So from there, either it can be brought back to my place, or it can be sold to a buyer from your place, or it can be exported from your place. Any three things should have been done within that 1 year. Okay, what is that? Either it should be brought back to principal's place, or it should be sold to a buyer, or it should be exported. So maybe brought back to principal's place, or can be sold directly from job worker's place. And one statement needs to be furnished by the principal with respect to goods sent on job work and received from job work. What is that statement? ITZ 4. And that ITZ 4, what is the time limit? If aggregate turnover during the previous year exceeds 5 crores, then it is a half yearly statement. Means, so by 25th of the month following every half year, so we need to submit this ITZ 4. That is for the first half year, April to September, it is by 25th October. For the second half year, from October to March, it is by 25th of April. Whereas, in case if the aggregate turnover during the previous year does not exceed 5 crores, then it is an annual statement. That annual statement needs to be submitted by 25th April of the succeeding financial year. Okay. So then, here input service distributor. Input service distributor is given under section 20 and section 21. So who is a input service distributor? There is a head office, and that head office is having branch officers under the same permanent account number. Now this head office will receive the input services, and with respect to that input service they can take ITZ and distribute that ITZ to these branches. And this particular head office should be registered separately as a input service distributor. And here one important point is that CGST and SGST credit will be distributed as CGST, SGST with respect to the branch in the same state. Whereas with respect to branches in the other state, it will be distributed as IGST credit. Whereas IGST credit will always be distributed as IGST credit. So CGST and SGST distributed as CGST, SGST for unit in the same state, and distributed as IGST if the unit is in different state. Now suppose if this invert supply is used only by one unit, then entire credit will be distributed to that unit. If the invert supply is used by 2 units, then the credit will be distributed to these 2 units on what basis? Turnover ratio. On the basis of turnover ratio. Suppose if the invert supplies are used by all the units commonly, then it will be distributed to all the units based on its turnover ratio. But to which units it will be distributed? To units which are operational during the month. All units which are operational based on turnover ratio. Which turnover will be taken? Either previous year turnover will be taken or the last quarter turnover will be taken based on the availability. And whether this ITC will be distributed on a quarterly basis or monthly basis or a yearly basis, monthly basis, and they need to file one return. So this ISD is required to file one return. What is that return? GSTR 6 by 13th of the month following every month. Then excess distributed ITC can be recovered by issuing ISD credit note. Say for example, they have to distribute 20,000 and 20,000 and 30,000 to these 3 units. But what they did is that they have distributed 10,000, 30,000 and 30,000 to these 3 units. This is the first thing is what they should have distributed, and the second is what they have distributed. So now to which unit they have excess distributed? Unit 2. So for that unit 2 they will be giving a ISD credit note to recover this 10,000 rupees, and again ISD invoice for giving back the 10,000 rupees to unit 1. Okay. So this has to be done by ISD. What if this is not done by ISD? Then as per section 21, wrongly distributed credit will be recovered from the unit. So 10,000 will be recovered from the unit 2, and for unit 1 they will not give 10,000 rupees as credit. That is the disadvantage in section 21. If the ISD has distributed excess credit to any recipient, the excess can be recovered from the recipient with interest. Okay. And distributed credit should not exceed the credit available for distribution. For example, they have 1 lakh credit for distribution, means the total of this should be 1 lakh, not more than that. Then ISD should get a compulsory registration in irrespective of aggregate turnover. So therefore, how many registrations they will have? These 3 anyhow will have 3 registrations, plus this head office also should get a separate registration as ISD. So which means total 4 registrations. Then last one point is there, that is while computing this turnover, we have computed turnover in 3 places. Number 1, rule 42. Rule 42, common credit into exempted turnover divided by total turnover. Then again rule 43. Rule 43, monthly ITC, that is common ITC divided by 60 months, monthly ITC into exempted turnover divided by total turnover. Again, in case of input service distributor, we are taking turnover for distribution. In these three places, while computing the turnover, don't include old indirect taxes. Generally, old indirect taxes should be included as per 15(2)(a), because as per 15(2)(a), all taxes, duties and cess by whatever name call other than GST should be included. But in these three places, for computing the turnover, old indirect taxes should not be included, should be excluded. This is exception to section 15(2)(a), clear or not? So while computing turnover under rule 42 or 43 or section 20, old indirect taxes, that is excise duty and central sales tax and value added tax, should be excluded. Okay, that is with respect to this, clear? Then next, so interest related provisions we will see in input tax credit, what all we have come across. Section 16, anywhere interest provision is there? Section 16, yes, 180 days. If the payment is not made to supplier within 180 days from the date of invoice, so much of the ITC avail needs to be reversed along with interest at 18% per annum from the date of utilization till the date of reversal. Then one more interest also is there in section 16 read with section 41, that is, if supplier has not filed 3B within the prescribed period, then whatever ITC that is availed by the recipient based on 2B needs to be reversed along with interest at 18% per annum. Then next, in case of section 17 we have interest, yes, 17 read with rule 42. Rule 42 we have interest na, what is that? Provisional D1 D2 versus final D1 D2. So interest at the rate of 18% on the differential amount from April 1st of the succeeding financial year till the date of payment. Then in rule 43 also we have interest, yes. Rule 43, what is that? Monthly ITC reversal along with interest at 18% from the date of availment till the date of reversal. Okay. Then section 18, we don't have any interest in section 18. Section 19, job work, yes. So what is that? If the goods are not brought back within the time stipulated under section 143, then it is deemed as supply and GST payable along with interest. Okay. So then section 20, ISD. So if not 20, 21 it is there. Wrongly distributed credit, so it will be recovered from the recipient. So excess distributed credit along with interest. Okay. So we completed input tax credit. Okay. One small topic is there, accounts and records, that we will complete. Okay. And then we will leave for today. Remaining we can see tomorrow. So look into segment 12, accounts and records. What are the various accounts and records to be maintained by a registered person? As per section 35, only two sections are there. Section 35, what are the accounts and records to be maintained? 36, what is the period for which accounts and records to be maintained? So remember I formats, I for inward supplies, F for foreign trade, import and export, and then O for outward supplies, R RCM supplies. Out of that inward supplies, what are all covered under RCM should be separated, because on that we need to pay GST under RCM, that's why. And then, so I for MATS, M for manufacturer production related, A for advances received, adjusted and paid, and then T for tax details, S for stock details. These are the various records to be maintained by a registered person, but don't write I formats. You write by explaining this, okay, all records pertaining to inward supply, all records pertaining to outward supplies, like that. And a person opting for composition scheme is not required to maintain the last two, that is TS. So it is only I pharma. So T and S, tax details and stock of goods, is not required for a person opting for composition scheme. And where this record should be maintained? These records should be maintained in principal place of business pertaining to all the place of business. We need to maintain in principal place of business, and records pertaining to additional place of business, we need to maintain in additional place of business. For example, I have 3 places of business, Chennai, Coimbatore and Pondicherry. Okay. So, sorry, Chennai, Coimbatore and Madurai, because Pondicherry means UTGST, that's a separate registration. So, Chennai, Coimbatore and Madurai. So, 3 places I have. Now, in Chennai, I have to maintain the books of accounts and records of all 3 places. And in Madurai, I have to maintain books of accounts related to Madurai. And in Coimbatore, I have to maintain books of accounts related to Coimbatore. You understood or not? So, as per section 35, the above records to be maintained by every registered person in principal place of business and records pertaining to additional place of business in each additional place of business. And as per section 36, for what period we need to maintain the accounts and records? We need to maintain the accounts and records for a period of 72 months from the due date of filing annual return. And so 6 years, you need to remember it as 6 years. Suppose if for a particular financial year you went on an appeal, then in that case 6 years from the due date of filing annual return or 1 year from the date of disposal of appeal, whichever is later, not whichever is earlier, whichever is later. 6 years from the due date of furnishing annual return or 1 year from the outcome of the appeal, whichever is later. And also every transporter and warehouse keeper, even though their aggregate turnover does not exceed threshold limit, but they need to definitely get a unique enrollment number. So means they need to give their details and maintain necessary records, and they need to obtain the unique enrollment number. So these are the points that we have in accounts and records. Then from this segment 13 onwards, we can see in tomorrow's session. Okay. Audit under GST. So this is 65 and 66. We don't have statutory audit under GST. So statutory audit under GST stands omitted. So therefore, GSTR 9C is now not an audit report. So GSTR 9C is a self-certified reconciliation statement. And so 2 audits are there, departmental audit and special audit under section 65 and 66. So departmental audit, who will be conducting? So this departmental audit will be conducted by commissioner or any officer authorized by commissioner to undertake the audit. And who will be conducting the special audit? Chartered accountant or cost accountant nominated by the commissioner, not selected by the registered person. And in case of departmental audit, when that audit will be conducted at such frequency, so but that is not yet notified. So means now at present, whenever they want to conduct the department audit, they can conduct. Every year also they can conduct the department audit with respect to a person. Whereas special audit is during the any search or scrutiny or investigation, etc. So proper officer is of the opinion that the valuation is not done correctly or the input tax credit is not availed properly. So then in that case, during investigation or inquiry or scrutiny, it is found that value is not correctly declared or ITC irregularly availed, then the special audit will be ordered by the proper officer. And what is the time limit for completing the departmental audit? 3 months, and it can be extended for a further period of 6 months. Whereas there it will be 90 days plus it can be extended for a further period of 90 days. So there 90 plus 90 special audit, but departmental audit will be 3 months plus 6 months. And to whom the audit report will be submitted? In case of department audit report is submitted both to department as well as to the registered person within 30 days of conclusion of the audit. So the registered person, based on this audit report, if there is any discrepancies, he can make the payment of tax so that the show cause notice will not be issued. Or that person, if he has, if he is certain that he is not required to pay, then based on audit report, so if at all order, notice and order is passed, he can go for appeal, means he can make the preparation accordingly. So, but he don't have to go for appeal against the audit report. See, audit report is a precursor, and based on audit report, notice will be given. After notice, order will be passed. Okay. So if really there is a genuine tax liability to be paid, we can pay, so that notice and order will not be passed. Or suppose if department initiating notice and order based on the department audit report, so we should be prepared. Okay, either that is to make a reply to that notice, or suppose if order is passed, we need to go for appeal. So that is about this audit report given to the registered person also. Whereas in case of special audit, the special audit report will not be given to the registered person. The special audit report is shared only to the jurisdictional ACDC. And who will bear the expenses of audit? Expense of audit is borne by department, both cases, department audit as well as special audit. And scope of audit in department audit, as they can verify all records, like whatever records that we have seen, I formats, everything they can verify, and even trial balance or even income tax audit report, cost audit report, all records they can verify. Whereas in case of special audit, they can verify the records relating to value of supply or input tax credit, because there the scope of audit is limited to valuation and ITC. Then notice for audit, in case of department audit, a 15 days or 15 working days, 15 working days prior notice will be given. So suppose if the audit is to be conducted today, a 15 working days prior notice will be given. So for the purpose of conducting the audit, which means within this 15 working days, we need to prepare all the records, etc. and all, maintain those records. That is the meaning. And in case of special audit, there is no notice, means it is like a surprise. So one fine morning, so chartered accountant or cost accountant selected by the commissioner will come and knock our door, and we have to give our records for the purpose of audit. So direction to get audited to the CA or CMA will be given, but there is no notice given to the registered person for audit. Whereas in case if the audit is already completed under departmental audit, so or special audit, so again can they order the other audit? For example, department audit over, can they order special audit? Yes. Special audit over, can they order department audit? Yes. Suppose if company's audit is over, stat audit or income tax audit, again can they audit department, etc.? Yes. So audit under this section is mandatory even if the audit is completed under any other law. Then can the audit be conducted for part of the year also? Yes. So department audit can be conducted even for part of the year. For example, I am a newly started business. I started my business in November, and November to March. So can they do the audit? Yes. So not that only for the completed year they will do the audit. So even for the part of the year also they can complete the audit. You understood or not? So that is this. The period of audit to be conducted is for a financial year or multiples thereof. Thus, commissioner or any officer authorized by him by way of general or specific order may now undertake audit of any registered person for part of the financial year also. So we are discussing this customs and FTP revision taxable event under customs. So first of all, when we refer to customs, we need to refer to the Customs Act 1962. And Customs Act 1962, so we have section 12 as the basis of charge or the levy. So as per section 12, if 4 conditions are satisfied, then there will be levy of customs duty. What are those 4 conditions? First, there must be goods, and that goods must be dutiable goods. What is the meaning of dutiable goods? Those goods which are specified in the Customs Tariff Act 1975 are called as dutiable goods. So therefore, Customs Act 1962 and Customs Tariff Act 1975. So these are the 2 acts that we need to understand. Customs Tariff Act contains the list of goods, import and export of which will be chargeable to customs duty. So that list of goods which is there in the Customs Tariff Act is only called as dutiable goods, and the other goods are not called as dutiable goods, which means we don't have to pay customs duty. So what is the first condition? There must be goods, and the goods must be dutiable goods. And such dutiable goods must be imported or exported. So import means what? So bringing goods from outside India to India is known as import, and export means taking goods from India to a place outside India is known as export. And that import must be into India or export must be from India. So therefore, what is the meaning of India for the purpose of customs? For the purpose of customs, India is up to 12 nautical miles from the baseline, but for the purpose of GST, so India is up to 200 nautical miles from the baseline. But for the purpose of customs, India is only up to 12 nautical miles from the baseline. So that is called as territorial waters. So when the goods are said to be imported into India, so whenever goods enter into the territorial waters, so then the goods are said to be imported into India. Whenever the goods cross the territorial waters, then the goods are said to be exported from India. So the meaning of India for the purpose of customs is only 12 nautical miles. However, the provisions of Customs Act will be applicable up to 200 nautical miles for the purpose of the procedures, offences, penalties, and the powers of the customs officers, etc. But for the purpose of import or export, that is only 12 nautical miles. So then whether government goods are also treated on par with normal goods? Yes, because government is also a person under customs. So just like government is a person under GST, so central government, state government is a person under GST, like that government is a person under customs also, which means any import or export by government, so if it is dutiable goods, they are required to pay unless otherwise it is exempted through any notification, etc. So government is also a person under Customs Act, they need to pay customs duty. Then customs duty is irrespective of whether we get a consideration or not, because in case of GST majorly consideration is important. Only in case of 4 activities consideration is not important, that is DRIP. So disposal of business asset on which ITC availed, related party transactions including distinct persons, then import of service from a related person, or a principal agent transaction. Only 4 places consideration is not required, it will become supply. But in case of customs, consideration is not at all required in order to pay the customs duty. So if you are importing the goods for your own purpose, you need to pay customs duty. Same way you are exporting goods, so that goods are exported as samples, etc. means we are not going to get any consideration. Even then we need to pay customs duty if it is dutiable. So therefore here consideration is not at all a criteria. Then we have some important definitions. So these definitions will not be asked in exam, because in new syllabus they have not asked this definition so far, but in old syllabus they used to ask these definitions for like 4 marks, 2 definitions they used to ask for 2 marks each. So therefore it is good to know these definitions, and you don't have to by heart this, just try to understand, that is sufficient. First we need to understand what is the meaning of goods. So goods means vessel, vehicle and aircraft. That is generally how the goods are imported into India. The goods are imported into India or exported from India through either airways or waterways or through roadways or railways. So then imports will be categorized into 3: imports by aircraft, imports by vessel, or imports by vehicle. So the vehicle or the vessel or the aircraft which is bringing the goods, so not only the goods inside that conveyance, but that conveyance itself is also treated as goods for the purpose of customs. So which means we need to pay GST, customs duty on that conveyance also. Yes, provided that conveyance is imported for using it in India. If that conveyance is a foreign going vessel or foreign going aircraft, we don't have to pay. For example, definitely we are not manufacturing aircrafts in India. So suppose if there is an Indian airline company is importing an aircraft for passenger transportation, on the aircraft are they required to pay customs duty or not? Yes, they need to pay customs duty on the aircraft. Same way, we are not manufacturing ships. Suppose if we import a ship for transportation in India, definitely we need to pay customs duty on the ship. So therefore, that ship or the aircraft and vehicle is also goods. And then stores. Stores refers to passengers like consumption or for the consumption by the vehicle or conveyance during the journey will come under stores, like water or beverages or food items, spare parts, fuel. These are all called as stores, which are for consumption during the journey, whether or not for immediate fitting. So then it will be called as stores. So the stores is defined below. Stores means goods for use in a vessel or aircraft and includes fuel, spare parts and other articles, whether or not for immediate fitting, then it will be called as stores, and stores will also be treated as goods. Then baggage refers to passengers' luggage. Passenger or crew luggage is known as baggage. In the form of baggage also goods can be imported into India. Like a person who purchases some articles outside India, so in his regular bag he may bring those articles like jewelry, or it can be like electronic gadgets, etc. Even those goods are also dutiable. So we have baggage duty, and the rate of baggage duty is 38.5% is taken as a baggage duty rate. So therefore we have to pay customs duty on baggage, and baggage is also considered as goods. Then currency and negotiable instruments is treated as goods for the purpose of customs, but actually currency and negotiable instruments is not goods for the purpose of GST, because money is excluded from the meaning of both goods and services. But for the purpose of customs, currency and negotiable instruments are treated as goods. So which means that whenever I am importing any currency, there is a prescribed limit as per FEMA. So that much only I can import as currency. If I am importing more than that as currency, so then I need to pay customs duty on the currency that I have imported. So which means that I have to pay only the customs duty, but I don't have to pay GST. Why I don't have to pay GST? Because currency is not covered under goods for the purpose of GST. Say for example, I'm bringing some $10,000, $10,000 and all is not permitted under FEMA, but in my bag I'm bringing some $10,000 into India. So then in that case, whatever is permitted under FEMA, say $2,000 is permitted under FEMA, so remaining $8,000 I need to pay customs duty, and along with customs duty should I pay IGST? No, I don't have to pay IGST because money is not goods for the purpose of GST. So just the customs duty I need to pay. And whenever I am importing, why I need to pay IGST also along with import? Because we had something called as CVD and SAD, countervailing duty and special additional duty in the past. So that was to counterbalance excise duty and sales tax. As excise duty and sales tax got subsumed into GST, so therefore the CVD and SAD also got subsumed into GST. So in the place of that CVD SAD, we are paying IGST. So on import we need to pay even IGST also. Then goods includes any other kind of movable property. So whether it is tangible or intangible, every kind of movable property will be coming under goods. Then stores already we have seen. Import and export. Import means what? Bringing goods into India from outside India. Export means what? Taking goods from India to a place outside India is known as export. And what is the meaning of India? India for the purpose of customs includes only territorial waters of India. So territorial waters is up to 12 nautical miles from the baseline. So all provisions of Customs Act will be applicable. There is something called as exclusive economic zone. Exclusive economic zone is up to 200 nautical miles from the baseline. So but this exclusive economic zone is not considered as India. That exclusive economic zone is only for the purpose of powers of the customs officer to arrest or search a vessel or vehicle, etc. So for that purpose only we have this exclusive economic zone. Then high seas is beyond 200 nautical miles from the baseline is known as high seas. That is not at all considered as India, and the provisions of Customs Act will not be applicable there, and these are considered as international waters. Now we have something called as customs area and even Indian customs waters if you see. So as the meaning of India is only up to 12 nautical miles, but the provisions of Customs Act is applicable up to 200 nautical miles. Due to that reason, Indian customs waters means it is not 12 nautical miles. Indian customs waters means up to 200 nautical miles, that is exclusive economic zone will be considered under Indian customs waters. Then what is that beyond 200 nautical miles known as high seas? Customs area means in every customs port or airport, not entire area belongs to customs authorities. There will be some selected area or a notified area where the customs authorities will operate. That area where they operate is known as customs area. The area under customs station includes any area in which the import or export goods are ordinarily kept before clearance. Then dutiable goods. What is the meaning of dutiable goods? On which we need to pay duty and we have not yet paid duty is known as dutiable goods. Upon payment of duty, it will become duty paid goods. So on goods which are chargeable to duty, when we know that it is chargeable to duty, if they are covered under Customs Tariff Act, then it will be called as dutiable goods. So only those goods which are covered under Customs Tariff Act are called as dutiable goods. So therefore only when those goods are covered under this Tariff Act, then we call this as dutiable goods, and then only it will be chargeable to duty, and on which duty has not yet been paid. So upon payment of duty, it will become duty paid goods. Until that point of time, it is dutiable goods. Then export goods means the goods which are to be taken outside India, and who will be called as exporter? Exporter will be owner or beneficial owner or any person holding himself to be exporters. For example, if I am manufacturing the goods and I am exporting the goods, I will be called as owner of the goods, and I am manufacturer exporter. If I am manufacturing but I don't have the license to export, but you are exporting it, so then you are called as merchant exporter. You are holding yourself to be exporter, but you are not the actual exporter. You are holding yourself to be exporter. I am only the owner of the goods and you are exporting the goods. So you are also treated as exporter for the purpose of customs. I am the beneficial owner of the goods. I am also treated as exporter for the purpose of customs. If I am manufacturing, I am exporting, I will be called as manufacturer exporter. If I am manufacturing and you are exporting, I will be called as supporting manufacturer, means I am the beneficial owner. I am also exporter. And suppose if I am manufacturing and you are exporting, you are the beneficial owner of that, I am the beneficial owner and you are holding yourself to be exporter, that is merchant exporter. So literally, who will be treated as exporter? Manufacturer exporter, beneficial owner, or merchant exporter. All these three will be treated as exporter. Beneficial owner means who? On whose behalf the goods are imported or exported is known as beneficial owner. I am the owner of the goods, but I am not exporting, I am not importing. You are doing it on behalf of me. Then on behalf of whom you are doing import or export, so that person will be called as beneficial owner. Then imported goods means any goods brought into India from a place outside India. Then importer, same way like exporter, how exporter is owner, beneficial owner, or any person holding himself to be exporter, same way importer is owner or beneficial owner or any person holding himself out to be importer. Then baggage, baggage includes unaccompanied baggage also. So baggage generally is what? Passengers luggage, and baggage includes unaccompanied baggage. Unaccompanied baggage means the bag which is coming either before passengers arrival or after passengers arrival is known as unaccompanied baggage. So that is sometimes the bag will come first and thereafter the passenger will come. So that is unaccompanied baggage. Sometimes the passenger will come and the bag will not come. The bag will be stuck somewhere. So then thereafter, so after arrival of the passenger, the bag is coming. So that is known as unaccompanied baggage. Then, but does not include motor vehicle. So no one will bring a motor vehicle as a baggage. But if they bring that motor vehicle, so that will never be considered as baggage. So that will be treated as normal commercial goods which are being imported. Then coastal goods. Coastal goods means, so goods which are transported between a port in India to a port out in India, that is between port in India to another port in India, which means these are not imported goods or exported goods. Coastal goods are those goods which are being sold in India. So between one port in India to another port in India. So like say for example Mumbai port to Surat port, or Mumbai port to Chennai port. So these are some situations. Within India only the goods are transported, but it is not transported in inland waters, it is transported in coastal waters. Then it will be coastal goods. Foreign going vessel or aircraft. Any vessel or aircraft which is going from India to a place outside India, so carrying the goods or passengers, that is called as a foreign going vessel or aircraft. Not only that, even a navy vessel which is belonging to foreign government but taking part in any navy exercises will also come under foreign going vessel or aircraft. And any vessel or aircraft which is engaged in fishing operations, not carrying goods or passengers, but is going for fishing operations beyond the territorial waters, that is also called as a foreign going vessel or aircraft. Then vessel or aircraft proceeding to a place outside India for any purpose, means not carrying goods or people, so but for any purpose, means like army aircrafts or navy vessels, etc. So which are taken outside India for whatsoever purpose it may be. So jet flights, etc., that will be called as foreign going vessel or aircraft. So why we need to understand this? Because so till the time it is a foreign going vessel or aircraft, so whenever we are making supply of goods to a foreign going vessel or aircraft, it will be treated as exports for the purpose of duty drawback. There is something called as duty drawback. Duty drawback means whatever customs duty we paid on import, we will get as a refund. When we will get that as a refund? Whenever we are making sale, that is export, we will get the refund of customs duty paid on import. I am importing some goods and I am exporting those goods. Upon import, whatever customs duty I paid, I will get it as a refund upon export. So therefore, export not necessarily physically export. Even if I sell goods to a foreign going vessel or aircraft, it will be treated as export. So that's why we need to know this definition. Then next, what are the various options available to the importer for import of goods? There are two options available to the importer. Once the goods are brought into India, the goods will be unloaded in the customs area. After the goods are unloaded into the customs area, so importer is having two options. Option one, the goods can be taken directly for his home consumption by filing a bill of entry called as bill of entry for home consumption, and he need to pay the customs duty. So the goods are imported in port or airport. So now I wanted those goods, so I can file a bill of entry for home consumption, pay the customs duty and take those goods to my place. That is known as clearance for home consumption upon payment of customs duty and by filing bill of entry for home consumption. Option 2 is I can import the goods and deposit the goods in the warehouse without payment of customs duty. And only upon payment of customs duty I will clear the goods from the warehouse. For import of goods and depositing into the warehouse without payment of customs duty, I need to file into bond bill of entry. And again, for clearance from the warehouse, at that time I need to pay customs duty. I don't have to pay customs duty at the time of deposit, only at the time of clearance I need to pay customs duty. So then it will be called as ex bond bill of entry. Without filing bill of entry, the unloaded goods can neither be cleared for home consumption nor cleared for warehousing. Means the goods will be under the control of a custodian till the time we file, importer files the bill of entry. So there are three bill of entries: bill of entry for home consumption, bill of entry into bond bill of entry, or ex bond bill of entry. Bill of entry for home consumption is for clearance of the goods directly to the importer's place upon payment of customs duty. Bill of entry into bond bill of entry is for depositing the goods in the customs warehouse without payment of customs duty. Ex bond bill of entry is for clearance of goods from the warehouse upon payment of customs duty. Now I have to file either bill of entry for home consumption or into bond bill of entry. Then only the goods can be taken outside the customs port or customs airport. Until that point of time, the goods will be under the control of a person called as custodian of goods. So goods can be cleared to warehouse without payment of customs duty, but thereafter for clearance we need to pay customs duty. And bill of entry can be filed before arrival or after arrival, but the time limit prescribed is before the date of arrival. So which means if today the vessel or aircraft arrives, I need to file the bill of entry by yesterday. So let it be holiday or not, public holiday, Sunday, whatever it may be. So if the vessel or aircraft arrives today, I should have filed the bill of entry by yesterday. So before the date of arrival. Otherwise, there is a late fee that is payable for delay in filing bill of entry. Then, as clearance of goods from the warehouse is the taxable event here. So only when the goods are cleared from warehouse, at that time whatever is the rate that is there, that should be taken even for the purpose of levy. For example, goods are imported. At the time when we are importing, we don't have to pay customs duty because they are non-dutiable goods, not covered under Customs Tariff Act. But at the time when we clear the goods from the warehouse, so at the time of deposit, the goods are exempted or non-dutiable. But at the time of clearance from the warehouse, the goods became dutiable. Should we pay the duty or not? Yes, we need to pay the duty. Same way, at the time of import and deposit of goods into the warehouse, the goods are dutiable. But at the time of clearance from the warehouse, the goods are exempted. So we don't have to pay customs duty, which means clearance of goods from the warehouse is the taxable event. And therefore, at that time, whatever is the rate or whatever is the levy, that is only relevant. Then customs warehouse means it is not a warehouse which is owned by the customs department, because long back customs department stopped owning the warehouses. So then these warehouses are licensed by the customs department. So therefore, customs officer will give license to the warehouse, and any person who is satisfying the eligibility criteria can take a license to operate a warehouse. So which means, can an importer convert his own warehouse into a customs warehouse? Yes, he can do that. What is the advantage that an importer will get? So that the goods can be imported and it can be kept in his warehouse without payment of customs duty. And only when he clears that goods from his warehouse for production, at that time only he will pay customs duty. That advantage is there, and many importers will take a license for their own warehouse as customs warehouse, so they can defer the customs duty payable. They don't have to pay customs duty now. Only when they are actually utilizing the goods from the warehouse, they will pay customs duty. If importer has a warehouse for which license is obtained, then he can defer the customs duty payable till the time he uses such goods, as clearance from warehouse is only the taxable event due to that reason. Then what are the various documents involved in case of import and export? In case of import, so the import can be by airways or by waterways or by vehicle, and same way export can be by these three modes. So import, there are two parties, that is person in charge and the importer. Person in charge means the person who is person in charge of the conveyance. For example, vessel, the person in charge will be master of the vessel or the captain of the ship. In case of aircraft, the pilot. In case of vehicle, the driver or guard, etc. will be person in charge. So that person in charge of the conveyance is required to file one document with the customs officer. So in case of import, the document name is import manifest in case of vessel, arrival manifest in case of aircraft, and import report in case of vehicle. These are the three documents. So depending upon the mode of conveyance, they need to file. And this document contains what? This document contains the details of the goods which they are bringing into India. So that conveyance, in that conveyance they are bringing some goods. So that details will be mentioned in this import manifest, arrival manifest or import report. Now the customs officer, after verifying these goods, will allow these goods to be unloaded. Until that point of time, customs officer will not allow these goods to be unloaded. Then importer parallelly has to file one document called as bill of entry. Bill of entry is a document which will be filed by the importer for claiming the ownership of the goods and for payment of customs duty. So therefore, in case of import, the document to be filed by person in charge is import manifest in case of vessel, then arrival manifest in case of aircraft, and import report in case of vehicle. But all these three cases, the document to be filed by the importer is bill of entry. Then in case of export, the document to be filed by person in charge is export manifest in case of vessel, departure manifest in case of aircraft, and export report in case of vehicle. So these are the three documents parallelly. So therefore, at the time of export also, person in charge should tell what goods they are taking outside India. So therefore, that detail should be mentioned in these documents: export manifest, departure manifest, and export report. Then what is the document to be filed by the exporter? In case of vessel and aircraft, the name of the document is shipping bill, and in case of vehicle, the name of the document is bill of export. So to claim that this is my goods and to pay the customs duty at the time of export, they need to file this document. Then person in charge means master of the vessel, pilot of the aircraft, conductor or guard of the vehicle. And only after filing import manifest, grant of entry inwards is given for the vessel to enter into India. So until that point of time, the vessel cannot enter into India. So person in charge of the vessel has to file one document called as import manifest. So that import manifest, when he files with the customs officer, so customs officer will grant entry inwards. Only then the vessel can enter into India and the goods can be unloaded. Until that point of time, the vessel cannot enter. But the concept of grant of entry inwards is not applicable in case of aircraft. In case of aircraft, because till the time they give grant of entry inwards, the aircraft cannot be staying there because we don't have parking space in the sky, so to park the aircraft. So therefore, the aircraft will come here, and thereafter, after filing arrival manifest, so they will be giving grant of entry inwards not to come into the airport but to unload the goods. So the concept of grant of entry inwards is not applicable in case of aircraft and vehicle, but arrival manifest or import report should be filed before arrival. Along with bill of entry. Bill of entry is a document to be filed by importer. So along with bill of entry, the importer should prove that he is the owner of the goods. How to prove that he is the owner of the goods? For that, he need to present one document of title to the goods. What is the document of title to the goods? Airway bill in case of aircraft, bill of lading in case of vessel, and lorry receipt or railway receipt in case of vehicle. Who will give these documents? The shipping company or the conveyance operator or the transporter will be giving this document to the exporter at the time the goods are handed over to the shipping company, and now the exporter should send that document, email that document to the importer, and the importer only when he submits the document, bill of lading or airway bill or lorry receipt or railway receipt, the goods will be handed over to him. Otherwise, he cannot be treated as owner of the goods. Then, so these are required to claim the ownership of the goods. An invoice raised by him by the supplier outside India should also be filed. So at the time of import, the importer has to file three documents: bill of entry to pay the customs duty, or bill of entry for warehousing, either in home consumption or for warehousing, that is into-bound bill of entry. Second document will be document of title to the goods to claim the ownership of the goods, and third document will be, so that is, invoice which is raised by the exporter to importer. That document also should be filed. Then what is the taxable event and relevant date for determination of rate of duty? So the taxable event in case of import is as and when goods are coming into India. So that will be called as and when goods are coming into India. That is, what is the meaning of India here? Territorial waters. But date of crossing the customs barrier will be called as taxable event. That is, whenever the goods are imported into India, so that is, it crosses the territorial waters, but that is not the taxable event. So whenever it crosses the customs barrier, that will be called as taxable event. So as per Kiran Spinning Mills case and Garden Silk Mills case. So as per these two cases, it is given that, So only when goods cross the customs barrier, the goods are said to be imported. What is the meaning of customs barrier? Customs control. That's the reason why when the goods are imported and kept in warehouse, we are not required to pay customs duty, because still the goods are under the control of customs. So which means only when you cross the customs gate, or in case of warehouse goods, whenever you are taking the goods out of the warehouse, at that time only we need to pay customs duty. So because the taxable event is at the time of crossing the customs barrier, but not at the time when it is imported into India. Then, which means when the goods are imported into India and kept in the port or airport, but we did not take it out of the port or airport, from there it is exported to other country. Is the goods said to be imported? No, because the goods did not cross the customs gate, so it is still inside the customs only. So from there itself, when you are taking outside India, it is not treated as import. Only when you cross it and it enters into the landmass of India, then only it will be called as goods said to be imported, as per Kiran Spinning Mills and Garden Silk Mills case. Then, what is the relevant date for determination of rate of duty? In case of option 1, option 1 is what? Import for home consumption. Option 2 is import and depositing it in the warehouse. In case of import of goods for home consumption, the relevant date for determination of rate of duty is date of presentation of bill of entry or grant of entry inwards, whichever is later. So that is whenever we present the bill of entry or whenever the grant of entry inwards is given. So grant of entry inwards is given by whom? Customs officer will give grant of entry inwards to the vessel, and importer will be filing bill of entry. Whichever is later will be taken as the relevant date for determination of rate of duty. So here, which will be later usually? Usually when we need to file bill of entry, before the date of arrival itself, we need to file bill of entry. So definitely whichever is later is grant of entry inwards. Suppose if you file a bill of entry late, then already vessel has arrived and thereafter we file a bill of entry. So whichever is later will be the date of filing bill of entry. So therefore whichever is the later date, that should be taken as relevant date for determination of rate of duty, that is date of presentation of bill of entry or grant of entry inwards, whichever is later. Whereas in case of aircraft and vehicle, as grant of entry inwards is irrelevant there, that's why we are taking instead of grant of entry inwards date of arrival. So date of presentation of bill of entry or date of arrival, whichever is later. Now you may get a doubt here, that is in case of presentation of bill of entry is before the date of arrival, but the rate of duty is whichever is later. In the bill of entry I selected one rate, that is say 10%, but whichever is later, so on the date of arrival it became 12%. Then how much I need to pay? 12% I need to pay. At the time of presenting bill of entry the rate was 10%. At the time of arrival it is 12%. So whichever is later will be 12%. So therefore I have to pay 12%. But already in bill of entry I paid 10%. Then that extra 2%, how I can pay? So we need to amend the bill of entry. Already whatever bill of entry that has been filed, if there is a change in rate, we need to amend the bill of entry and we need to file the amended bill of entry, so that the relevant rate will be whichever is later. So now we need to amend the bill of entry for 12% and we need to pay 12% as the rate of duty. That is this. Then in case of option 2, option 2 is depositing the goods in warehouse. So and clearance of goods from the warehouse at a later point of time. Here what should be taken as the relevant date for determination of rate of duty? It is ex-bond bill of entry. That is, at the time when we actually clear the goods from the warehouse, we will file one bill of entry called as ex-bond bill of entry. At the time of filing ex-bond bill of entry, whatever is the rate that should be taken for rate of duty. At the time of depositing the goods in the warehouse, 10%. At the time of clearance from the warehouse, it is 12%. So therefore the relevant rate is 12%, because at the time of clearance, whatever is the rate that should only be taken. Then in case of exchange rate, so because usually in case of import, the goods will be invoiced in foreign currency. Then we need to convert it into Indian rupees. For converting it to Indian rupees, what should be taken as the relevant date for determination of exchange rate? In case of option 1, we file bill of entry. That bill of entry only will be taken. Only one bill of entry we file. In case of import of goods for home consumption, only one bill of entry we file, that is bill of entry for home consumption. So on that date bill of entry, whatever is the exchange rate, that should be taken. Whereas in case of warehousing, we file two bill of entries, one for depositing the goods in warehouse, another for taking the goods from the warehouse. So which bill of entry is relevant? For depositing the goods in warehouse, we file one into-bond bill of entry. That into-bond bill of entry will be relevant for determination of exchange rate. So for rate of duty in case of vessel, so option 1, date of presentation of bill of entry or grant of entry inwards, whichever is later. In case of aircraft and vehicle, date of presentation of bill of entry or arrival of the aircraft or vehicle, whichever is later. In case of option 2, a relevant rate for rate of duty is ex-bond bill of entry. For exchange rate, in case of option 1, date of presentation of bill of entry for home consumption. Whereas in case of option 2, it is date of presentation of into bond bill of entry. Then export, in case of export, what is the taxable event? Date of crossing the territorial waters is considered as taxable event as per Rajendra Dyeing and Printing Mills case and Sun Exports case. That is, whenever the goods are crossing the territorial waters. So territorial waters is up to 12 nautical miles from the baseline. In Rajendra Dyeing and Printing Mills case, a ship is going and within the territorial waters, the ship has sunk within the territorial waters. Now the goods are not said to be exported because it did not cross the territorial waters. Suppose if the ship has sunk after territorial waters, will the goods are said to be exported? Yes, the goods are said to be exported. So remember, ship sinking, Rajendra Dyeing. So that is Rajendra Dyeing and Printing Mills case is related to that ship getting sunk in the territorial waters. Then Sun Exports case. In Sun Exports case, what has happened? The goods cross the territorial waters, but because of the engine trouble, the goods return. So then whether the goods are said to be exported? Yes. As it crossed the territorial waters, it may return due to engine trouble, but still it will be treated as export as and when it crossed the territorial waters. So therefore, that is the meaning of export as per these two cases, date of crossing the territorial waters. Then relevant date for determination of rate of duty as per section 16. For import, the rate of duty and exchange rate is section 15, just like time of supply in case of GST. So therefore, section 15 is for import and section 16 is for export. Then what is the relevant date for determination of rate of duty in case of export? Let export order. That is, as and when we present the shipping bill or bill of export with the customs officer, the customs officer will pass a let export order. So that let export order will be taken as the relevant date for rate of duty in case of export. Then for exchange rate, exporter will be filing one document. What is the document to be filed by the exporter? Shipping bill or bill of export. You can see various documents to be filed by the exporter. Shipping bill or bill of export will be filed. So on the date of shipping bill or bill of export, whatever is the exchange rate that is there, that should be taken. So in case of export, just 2 points we need to remember. That is, rate of duty is on let export order and exchange rate is on the date of submission of shipping bill. Then exchange rate determined by whom should be taken? Exchange rate determined by CBIC should be considered. And in case of improper import or improper export, relevant date is the date of payment of duty. That is, we are not filing any bill of entry or shipping bill. The goods are improperly imported, exported, means smuggled goods. In case of smuggled goods, as and when it is caught, at that time they will be collecting duty. So on that day, whatever is the rate, that is only relevant for payment of customs duty. So these are the basic points that we have. So 3 sections we have in this introduction or taxable event. That is section 12, levy, section 15, that is relevant date for rate of duty and exchange rate in case of import, section 16, relevant rate for rate of duty and exchange rate in case of export. Now we are moving on to the next segment, that is classification of goods under customs. So here, so we have in the classification of goods under customs, so tariff we need to understand. So for the purpose of interpretation of tariff, they have given some rules. So whatever imported goods and exported goods will be specified in a tariff called as Customs Tariff Act 1975. The tariff will not be arranged in a simple manner. The tariff is divided into sections. So like group of items will be grouped into one particular section. Thereafter the section is divided into chapters, and thereafter in each and every chapter we have the headings, different headings with rate of duty. So now So general interpretative rules, they have given something to understand the tariff. So first rule number 1 says the titles of the sections and chapters and subchapters are for reference only, and classification is based on headings read with relevant section notes and chapter notes. For example, for every section and chapter there will be some notes. So just based on heading itself we should not classify. We need to read the section note or chapter note. If the section note or chapter note says that this product will not come in this chapter, then it will not come in that chapter. So therefore just based on headings itself we cannot classify. We need to read the section notes and chapter notes. Right now you remember that, that is enough. So therefore classification is based on section notes and chapter notes along with headings. Then number 2, any reference to goods includes so incomplete or unfinished goods. For example, I am importing a car. Car is having a heading. So car, motor car, and there is a rate. Now I am importing a car without wheels. So car without wheels is nowhere in the heading. So now car without wheels should also be treated as car only, and car without seats should also be treated as car. So any reference to completed goods includes incomplete or unfinished goods. So when we are importing some incomplete or unfinished goods, so where it should be classified? It should be classified as completed goods, and whatever is the rate applicable to the completed goods, the same rate should be taken for that incomplete or unfinished goods also. Means WIP. When we are importing some goods in WIP stage, so then its finished goods will have a rate na, the same rate will be applicable for WIP also. That is the meaning of rule 2A. Rule 2B is any reference to a material includes combination of that material with other material. For example, we are importing so coffee, we have coffee separate heading, and chicory separate heading we have. Suppose if you are importing coffee with chicory, so usually filter coffees and all, so they will be mixing so chicory, which is a plant extract. So that plant extract will be mixed along with the coffee in order to reduce the caffeine content in the coffee. So this usually 80-20 ratio the coffee will be there. So 80% will be coffee powder and 20% will be chicory. So we have coffee separate heading, chicory separate heading, but coffee with chicory, so we don't have any separate heading. So therefore any reference to coffee includes coffee mixed with other material. So therefore this coffee with chicory will be coming under so this coffee only. So any reference to material includes combination of that material with other material. Another example, we have natural rubber, so which is taken from the plant, and synthetic rubber which is taken from this HDPE granules, that is plastic granules. So that is synthetic rubber. So therefore when we are importing natural rubber mixed with synthetic rubber, it should be classified as natural rubber only. Same way, article of gold partly with gold and partly with copper will also be classified under articles of gold only. Like that, any reference to a material includes combination of that material with the other material. Then rule 3A says that when there is a specific heading and there is a general heading, we need to always prefer specific heading over general heading. Say for example, we are importing electric shavers. Electric shavers can come under two headings. Heading number 1 is electromechanical domestic appliances with self-contained electric motor. So which means, so there is a domestic appliance with motor. So that's a general heading, not just shaver. Any domestic appliance will come under that heading. Whereas another heading is there, which is a specific heading, shavers and hair clippers. So the shavers and hair clippers is a specific heading for electric shaver than electromechanical domestic appliances. So when there is a specific heading and a general heading, we need to always prefer specific heading over general heading. Then next rule 3B says classification shall be as per essential character. If a particular product is mixture or composite of goods containing different materials. Say for example, we are importing a geometry box, and that geometry box will have one steel box, then drawing instruments, pencil, eraser, etc. So but what is the essential character there? Pencil, eraser is essential character, or the steel box is essential character, or the drawing instruments is essential character? Drawing instruments is essential character. So this entire geometry box will be classified under drawing instruments. Like that, whenever we are importing article which is composite of multiple articles, we need to classify based on the essential character. Then rule 3C, if both the goods are, both the headings are specific, so then we need to select that heading which comes last in the numerical order. For example, so we are importing a motor vehicle for carrying people, so we have one heading, and we are importing motor vehicle for carrying goods, we have another heading. 8302 is motor vehicles for transportation of people. 8304, like that, another heading is there, that is motor vehicle for transportation of goods. Now we are importing a motor vehicle which is used for both the purposes, like it can be used for transporting people as well as goods. For example, if you see in India and all, Tata Ace you take, so they carry goods also, they carry people also in that. So like that, lorry and all, so they carry, you know, buffaloes, they carry animals, and they carry human beings also. For marriage function and all, in one goods carriage, they will carry human beings also in that lorries. So therefore, it can be used for both goods as well as passengers. Then how will you classify? So which comes last in the numerical order? What is last in the numerical order? 8304, or 8704, like that. Which comes last in the numerical order, there it should be classified. The latter the better. So if both the headings are specific, then the latter the better. Which comes last in the numerical order, under that heading it should be classified. Then next, akin goods. Akin goods refers to similar goods. Similar goods means we are importing this car sun glare films. So sun protector film will be there now for the car windows, we will be importing that, and for that we don't have any heading. So this will be classified under curtains and blinds. So because curtains and blinds we use in the house for the purpose of that sunlight protection only. So therefore, under that curtains and blinds, this car sun protector film will be classified. So that is akin goods. Ultimately you need to pay customs duty. So if that product is not there, under similar goods it will be classified. That is rule 4. Rule 5, packing materials and packing containers will be classified along with the main articles which are sold. For example, we are importing a violin. Violin is having 15% rate of basic customs duty. We are importing a violin box. To keep the violin, we are importing a violin box. So that violin box is not anywhere in the heading. So then in that case, whatever is the rate applicable to violin, violin box is used for what? Only to keep violin. So therefore, we need to take the rate applicable to the violin. Like that, jewelry box. Jewelry box is only to keep the jewelry. So we cannot carry tomatoes and potatoes in jewelry box. So only for carrying jewelry only. So therefore, whatever is the rate applicable to jewelry, that will be applicable for the jewelry box also. That is this. Packing containers and packing materials can be classified along with the main articles which are sold. Rule 6 says goods can be compared for classification at the same level only, which means we have one heading and one subheading. So we cannot compare. So we can compare heading and heading, subheading and subheading, tariff heading and tariff heading. So at the same level, equal level only we can do the comparison. That is rule 6. So these are the rules that we need to just understand it once. So far they have not asked this. Maybe in MCQ they can ask this, but rule numbers are not important. But what is the provision inside that rules, that you need to remember. Then next we are moving on to the practical area, that is segment 23, types of customs duties. So we need to understand first the customs duty computation. So this computation of customs duty will be made in 3 steps. So we are now discussing computation of customs duty. So how to compute customs duty payable? Computation of customs duty payable. Computation of customs duty payable. We are trying to understand the format with respect to this. First, we need to see step 1, which contains 3 things. So that is basic customs duty. Basic customs duty at given rate. So that rate will be given in the question itself. So we don't have to bother anything about it. So basic customs duty is the first one, and basic customs duty at the given rate in the question. But which rate should be taken? We need to apply date of presentation of bill of entry or grant of entry inwards, whichever is later, or date of presentation of bill of entry or arrival, whichever is later, like that we need to take. So this is computation of customs duty payable in case of import. In case of import, not in case of export. So in case of import. So first, basic customs duty at the rate given on what? On assessable value. we need to arrive at the value. So on that value, we need to compute this basic customs duty. So that is the first thing. Then to this basic customs duty, we need to add social welfare surcharge. This social welfare surcharge will be always at the rate of 10% on basic customs duty. So whether it is given in the question or not, we need to take social welfare surcharge in the answer. So question may be silent. Sometimes they will give social welfare surcharge as applicable. Sometimes they will give social welfare surcharge 10%. Sometimes there won't be any reference to social welfare surcharge. Even then, for the basic customs duty, we need to add social welfare surcharge at always 10% on basic customs duty. So that is the second thing. Then we have something called as CVD. So CVD is countervailing duty. So this countervailing duty at the rate, again it will be given in the question itself. So we need to take that on assessable value plus basic customs duty plus social welfare surcharge. Assessable value plus basic customs duty plus social welfare surcharge. On that we need to compute CVD, and CVD is counterbalance of excise duty. At present we are having excise duty only on 3 articles. Excise duty is applicable only on 3 articles at present. What are those 3 articles on which excise duty is present at present? So that is alcoholic liquor for human consumption. Alcoholic liquor for human consumption. And then we have petroleum products. So for example, on import of alcohol, we need to pay CVD. Then on import of petroleum products, that is ATF, aviation turbine fuel or any crude oil, etc., we need to pay CVD. Then right now we have excise duty on tobacco and tobacco products. So on tobacco and tobacco products also, when we are importing, we need to pay CVD. So CVD is not applicable on all goods, applicable only on these 3 goods. So therefore, if the question has these 3 goods and the rate is given in the question, we need to take that rate and we need to multiply only on assessable value, basic customs duty and social welfare surcharge. So then we get step 1. So this step 1 total is known as customs duties excluding additional customs duties. Customs duties excluding additional customs duties. This is step number 1. Then step number 2. In step number 2, what will happen is that, so we need to take in step number 2, so first we have safeguard duty. So safeguard duty is levied under section 8B of Customs Tariff Act, and this will be at the rate. So at the rate given. So that rate will be given in the question itself. So we don't have to do anything with respect to this. Just take the rate given in the question and it should be multiplied on. Sometimes it will be taken on assessable value or sometimes it is on the landed value. Sometimes it is on assessable value, sometimes it is on landed value. So what is this landed value? Landed value means that is assessable value plus basic customs duty plus social welfare surcharge is known as landed value. How we know we need to take assessable value or landed value? That will be given in the question itself. So we don't have to worry. So rate also will be given and that rate should be multiplied on assessable value or landed value also will be given in the question. So just we need to take that and we need to multiply. So we get the safeguard duty. So then we need to take anti-subsidy duty. There is the next thing that is called as ASD, anti-subsidy duty. This anti-subsidy duty under section 9. So all these sections are of Customs Tariff Act. So 1975, it is not of Customs Act, it is Customs Tariff Act 1975. Again, here also it is given in the question itself. So it will be given in the question itself. We need to take the given rate and it should be computed on same assessable value or landed value. So that fact that we need to take it on assessable value or landed value will also be given in the question. So just take the rate given in the question and you need to. So whether on safeguard duty and anti-subsidy duty, we need to add social welfare surcharge? No, because social welfare surcharge will come in step 1, but the safeguard duty and anti-subsidy duty will come in step 2. So therefore, on this safeguard duty, anti-subsidy duty, should we calculate any social welfare surcharge? Not required, because social welfare surcharge already we have computed above. So then third one, we call it as anti-dumping duty. So this anti-dumping duty, so will be under section 9A, anti-dumping duty under section 9A. So this will be computed not at the given rate. So we have a different computation for anti-dumping duty. Anti-dumping duty will be A, dumping margin, or B, injury margin. A, dumping margin, or B, injury margin. Whichever is lower will be taken as anti-dumping duty, and we need to compute that. So then we will be getting step number 2 total. So what is dumping margin? So anti-dumping duty is applicable when goods are being exported by the exporter to India at a cheaper rate. So they are dumping the goods into India, then there will be anti-dumping duty. So dumping margin. So who is dumping? Exporter is dumping. So then we need to see the dumping margin from the exporter point of view. Then injury margin. Who is getting injured? The domestic manufacturer is getting injured. So we need to see the injury margin from the importer point of view. So now dumping margin means, say for example, they are selling in their country, exporter is selling in their country for $100 and they are exporting to India at $75, which means they are selling at a price less than their selling price to India. So therefore, what is the dumping margin? $25. Then this article which is imported into India, so is at $80 but is being sold in India for $120. Then what is the injury margin? Here in India the normal selling price is $120, but we are importing in India for $80. Then the difference is what? Injury margin. To that extent the domestic manufacturer is injured. I am selling at $120, you are importing for $80. Then who will buy from me? Definitely people will buy from you only. So then I am getting injured. So to what extent it is injury margin? $40. So therefore $25 or $40, whichever is lower, will be taken as the anti-dumping duty. So dumping margin or injury margin, whichever is lower. So this three when we add, we get customs duty excluding IGST and GST compensation cess. So the second step total is known as customs duties excluding IGST. Customs duties excluding IGST. Then last step. In step number 3, we need to take again 3 duties. That is IGST. IGST will be computed at, it will be given in the question itself. Rate will be given in the question itself because it is the GST rate. So at the given rate, but IGST is computed on what? While computing IGST, as per section 15(2)(a), all taxes, duties and cess by whatever name called should be included. So therefore we need to take step 1 plus step 2, means assessable value plus step 1 plus step 2. Assessable value plus step 1 plus step 2 should be taken for the purpose of computing IGST. Means we need to take everything so far, assessable value plus all these 3, basic customs duty, social welfare surcharge and CVD, then safeguard duty, anti-dumping duty and anti-subsidy duty, and on that we need to compute IGST. And then we have compensation cess, GST compensation cess, but GST compensation cess is not applicable on all goods. So therefore definitely that should also be given in the question itself. So given on what? This will be computed on same assessable value plus step 1 plus step 2. So on that we need to take, so this is GST compensation cess. Then finally we need to take SAD, special additional duty. This special additional duty is at the rate of, so again this will also be given in the question itself, special additional duty. So this will be computed on what? Just like IGST, GST compensation cess, it should be also computed on assessable value plus step 1 plus step 2. So on that we need to compute SAD, but SAD is to counterbalance sales tax. At present SAD is applicable only on one product, that is on import of petroleum products. On import of petroleum products, we need to pay SAD. On alcohol, no. On alcohol, we don't have to pay SAD. So only on import of petroleum products, we need to pay SAD, which means IGST, GST compensation cess and SAD are mutually exclusive, because SAD is applicable on petroleum products. At present on petroleum products, we don't have GST. So which means wherever SAD comes, IGST, GST compensation cess will not come. Wherever IGST, GST compensation cess comes, SAD will not come. So now if you total this, step 1, step 2, step 3, so then the total will be called as total customs duties payable. So total customs duties payable is this. So this is the template that we need to remember for the purpose of arriving at the customs duty payable. Okay. Now, so that's what I have given here. First we will have basic customs duty. So basic customs duty will be at the applicable rate given in the question, compute on assessable value. And we have two types of basic customs duty, standard rate and preferential rate. Standard rate means what? Standard rate means, so that will be like import from any country, the standard rate will be applicable. Whereas preferential rate means if you are importing from a country with which India is having a trade agreement, then the preferential rate will be applicable. So at the applicable rate on assessable value we need to take. Then social welfare surcharge at the rate of 10% of basic customs duty. Right now education cess and secondary and higher education cess is not there, it is only social welfare surcharge. Then integrated tax and GST compensation cess at the rate given in the question, compute on assessable value plus all customs duties above. Then note 1, in the past imports, countervailing duty under 3.1 was levied to counterbalance excise duty, and special additional duty under 3.5 was levied to counterbalance sales tax. However, now on account of GST, its applicability is limited only to few goods. What are those few goods? Already we have seen. So in case of CVD, it is 3 goods: alcoholic liquor for human consumption, then next we have petroleum products, and then tobacco and tobacco products. Whereas in case of SAD, only petroleum products. Then note 2, in case of exports, we have to pay only basic customs duty. Even social welfare surcharge is not required to be paid. Only the basic customs duty we need to pay. Social welfare surcharge is not payable. Then note 3, in case of warehoused goods sold by way of transfer of warehouse receipt, then IGST under customs shall be computed on assessable value plus basic customs duty plus social welfare surcharge, or sale value of such warehouse receipt, whichever is higher. That is, say for example, I am importing the goods. I am importing the goods and I am keeping the goods in the warehouse. So now what I am doing, I am not clearing the goods from the warehouse, but I transferred the document of title to you. Now you will be called as importer and you will go and clear the goods from the customs. When you go and clear the goods from the customs, so the customs duty will be payable on the original import price, but IGST will be computed on A or B, whichever is higher. This already we discussed, maybe you forgot. So we discussed that A or B, whichever is higher. A will be assessable value plus basic customs duty plus social welfare surcharge, because generally IGST we need to compute on that, or we need to take, so transaction value. Say for example, I am selling to you for $11,000. I am importing for $10,000. I am selling to you for $11,000. So in that case, customs duty will be payable on $10,000 only by you, but IGST will be computed on customs duty, assessable value plus social welfare surcharge, or the price at which you purchase from me, that is $11,000, whichever is higher should be taken for the purpose of computation of IGST. So this is only in case of warehoused goods which are imported and which are cleared before import, that is before warehouse. Means a person who is importing the goods is not clearing the goods, but they are selling the document of title to the other person. Okay, so this we discussed in the first segment, that is introduction, taxable event under GST. So their sale on high seas basis or sale of warehoused goods, so there we have discussed this. Then additional customs duties on import, we have protective duty, safeguard duty, anti-subsidy duty and anti-dumping duty. These are the 4 additional duties we have. But protective duty is literally not an additional duty, because protective duty is just enhancement of the basic customs duty, which means in this list where protective duty will not come anywhere but instead of regular basic customs duty, if protective duty is there, there will be higher basic customs duty. For example, on import of wheat flour, that is atta, so there is a basic customs duty of 40%. Generally, the basic customs duty on all articles will be 10%, but on atta they are taking it as 40%. Why? Because to protect the domestic industry. Like that, the basic customs duty rate itself will be increased, that is known as protective duty. Whereas the safeguard duty, anti-subsidy duty and anti-dumping duty, these are additional customs duties, so which will be in the step 2. So safeguard duty is levied on account of fair exports, but we are importing it in large quantities. So exporter is exporting it fairly, but we are dependent too much on that particular product, so then there will be safeguard duty. For example, toys market if you take, so China, we are importing on toys market from China, so therefore this to discourage that import of toys from China, so what they will do, they will be levying something called a safeguard duty. Then anti-subsidy duty and anti-dumping duty is unfair export. Anti-subsidy duty is the exporting country is giving a subsidy to the exporter outside India if they are selling the goods to India. So which means because of the goods are being sold in India, the exporting country is giving the subsidy to exporter, which is means it is like a trade war which the other country is doing on India. So therefore the article naturally will be coming to India at a cheaper rate. So that is known as subsidy given by the exporting country to the exporter. To avoid that, we are levying anti-subsidy duty and increasing the price of the imported goods. Then anti-dumping duty. Anti-dumping duty is whenever the exporter is making the goods in large scale and they dump those goods into India, so at a cheaper rate, then in that case we have anti-dumping duty. So these two cases, it is unfair export, means exporter wantedly trying to spoil the domestic market. So but in case of anti-subsidy duty, it is not the mistake of the exporter, it is a mistake of the exporting country. But in case of anti-dumping duty, it is a mistake of the exporter. But in case of safeguard duty, there is no mistake of exporter. So normally they are sending the goods to India, but we are dependent on them in excess. So we are importing in large quantities. So that is this. Then protective duty is under section 6, safeguard duty is under section 8B, anti-dumping duty is under section 9, and anti-subsidy duty section 9, and anti-dumping duty section 9A. All these sections are of Customs Tariff Act. Now, who will levy protective duty? Protective duty is levied by the central government on the recommendations of Tariff Commission, which means importer will not make any complaint to the central government for the purpose of levy of this duty. So this will be based on recommendations of Tariff Commission. From time to time, government will revise the customs duty rates, that is known as protective duty. Whereas safeguard duty, anti-subsidy duty and anti-dumping duty is levied by central government upon receipt of complaint or information from the domestic industry. So domestic industry will make a complaint. So upon that, they will carry out the investigation to central government, and then they will be levying this safeguard duty, anti-subsidy duty or anti-dumping duty. Then relief against what? So mainly, so all these duties are to give relief to the domestic industry. So protective duty is to protect the interest of domestic industry against imports. But this safeguard duty is to protect the domestic industry on account of serious injury because of imports in large quantities. Reason will differ. All these are to protect the domestic industry. Generally protective duty. But suppose if the goods are imported in large quantities, because of that if the domestic industry is getting injured, then safeguard duty. If goods are imported into India and at a cheaper rate, so because the subsidy is given by the exporting country, so then if the domestic industry is injured, to protect the domestic industry they will levy anti-subsidy duty. If goods are imported at a cheaper rate, so then if the domestic industry is injured, so to protect the domestic industry they will be levying anti-dumping duty. So therefore all these four are to protect the domestic industry only, but the reason will differ. If it is as per the recommendations of Tariff Commission, protective duty. If it is because of import in large quantities, safeguard duty. If it is import of goods at a cheaper rate because exporting country has given a subsidy to the exporter, anti-subsidy duty. Because we are importing at a cheaper rate, as exporter is dumping it into India, anti-dumping duty. Then what is the extent of relief? So in case of protective duty, as I already told you, it is not a new duty but an enhancement to the basic customs duty. So regular basic customs duty 10% means protective duty will go to 40% or 50% like that. Then in case of safeguard duty and anti-subsidy duty, this will be at a notified percentage. So therefore we need to take the notified percentage given. So that notified percentage will be taken, rate will be specified in the question. Then next, in case of anti-dumping duty, it will be dumping margin or injury margin, whichever is lower. What is dumping margin? Dumping margin means sale price in the exporting country. That is the price at which they are normally selling in their country minus the price at which they are exporting to India is known as dumping margin. In our example we discussed, so they are selling in their country for 100 rupees, but they are exporting to India for $75. So then the difference $25 is the dumping margin. Then injury margin means, so normal selling price in India, say in India that product is being sold at $120 and the landed value of the imported goods, landed value means assessable value, basic customs duty, social welfare surcharge, say that is some $80. So 120 minus 80, $40 is the injury margin. So whichever is lower will be $25 that will be taken. So that is in case of anti-dumping duty. Investigation, in case of protective duty, investigation not required. Why? Because based on the recommendations of the Tariff Commission it is being levied, so there is no need of any investigation. Whereas in case of other three, safeguard duty, anti-subsidy and anti-dumping duty, so investigation is required because so it will be acted upon by the central government based on complaint from the domestic industry. So therefore they need to carry out the investigation and then only they will be levying these three additional customs duties. So that's the reason why till they complete the investigation, so there will be a provisional safeguard duty, provisional anti-subsidy duty and provisional anti-dumping duty. For how many days this provisional duty will be levied? Till the time of completion of investigation. What is the time limit by which the investigation should be completed? So in case of anti-dumping duty 6 months, anti-subsidy duty 4 months, and in case of the safeguard duty it will be 200 days. This is the time limit by which they need to complete the investigation. Until that point of time provisional duty will be levied. Suppose upon finalization, say if the provisional duty is levied and upon finalization it is more than the provisional duty, then the differential amount we need to pay. Suppose if it is less than the provisional amount, then they will give the refund. So refund allowed or differential duty payable on account of finalization. Now once this safeguard duty or anti-subsidy or anti-dumping duty is levied, for how many years it will be levied? So safeguard duty you can see 4 years it will be levied and it can be extended, but the extended period cannot be beyond 6 years, which means what is the total number of years for which safeguard duty can be levied? 10 years. 4 years and they can extend it for a further period not exceeding 6 years, which means total 10 years. But in case of anti-dumping duty and anti-subsidy duty, these two if you see, it will be levied for a period of 5 years and it can be extended for a further period of 5 years at a time, which means there is no unlimited, there is no limited time, unlimited time, there is no end date. So means they can levy it for 200, 300 years also, but only thing for every 5 years they need to check. So 5 years, so whether they need to continue this anti-subsidy and anti-dumping, yes, then further 5 years. Again for every 5 years the review needs to be done. So that is this. So 5 years plus 5 years at a time after review, maximum is unlimited time. Then what will happen if they are not reviewing it within 5 years? Then there is automatic extension for 1 year. So see the note below, automatic extension of 1 year if not decided whether to extend or not within the expiry of 5 years. Say 5 years over, so they have not decided, then automatically there will be extension for 1 year. Means in that 1 year they need to decide to extend or not. Suppose in that 1 year they have not decided to extend it, then it will not be extended. If they have decided to extend it, it will be extended. So by default 1 year extra time limit will be there. If the 5 years is over, so therefore automatic extension for 1 year will be there. Then in that 1 year they need to decide. What if they have not decided to extend? Then the notification will terminate, which means there won't be any anti-subsidy duty or anti-dumping duty thereafter, after that 1 year. That is the meaning of that. Then exemption from levy in case of safeguard duty, anti-subsidy duty and anti-dumping duty. Common, we have one exemption, that is a product imported attracts safeguard duty, or a product imported attracts anti-dumping duty, or a product imported attracts anti-subsidy duty. If this product is imported by a 100% EOU or a SCZ, then they don't have to pay this anti-dumping duty, safeguard duty or anti-subsidy duty. Generally, say one product I am importing here. So this product attracts safeguard duty, but I am importing into EOU or SCZ. No need to pay safeguard duty. Normal basic customs duty if I pay, okay. But if I do this as to escape safeguard duty, like I am importing into a EOU, thereafter it is cleared to DTA, means to avoid the safeguard duty I am trying to do this way, then I have to pay safeguard duty. See this. Imports by 100% EOU or unit in SCZ, no safeguard duty, no anti-subsidy duty, no anti-dumping duty. However, if imported and cleared to DTA, domestic tariff area, then it will be applicable. Then retrospective levy. So today, can they give a notification to levy this retrospectively? Safeguard duty cannot be levied retrospectively. Only two additional duties can be levied retrospectively, that is anti-subsidy duty and anti-dumping duty can be levied retrospectively. That too how many days prior? So up to 90 days prior, which means today they can give a notification to levy it retrospectively within 90 days prior. Say, so 60 days prior or 80 days prior, they can give effective date of this notification, but the notification is given today. So retrospective levy can be done, but not before 90 days from the date of notification. Then see the notes. In case of imports in large quantities, government can resort to tariff rate quota. Tariff rate quota means, so like they will be fixing a particular quota. So like this much quantity if you are importing, no need to pay any duty. So beyond this quantity if you are importing, you need to pay additional duty, like that. Instead of levying safeguard duty flat on all quantity imported, so they can fix a tariff rate quota like a slab rate model. If you are importing 10,000 units, no need to pay additional duty. If you are importing beyond 10,000 units, you need to pay additional 20% duty. Like that, a tariff rate quota can also be fixed as a safeguard measure instead of safeguard duty. Then anti-subsidy duty under section 9 and anti-dumping duty under section 9A are mutually exclusive. So which means if anti-subsidy duty is there, anti-dumping duty will not come, because the moment they levy anti-subsidy duty, they are taking care of that cheaper price. So because both are for cheaper price only, and anti-subsidy duty is cheaper price because exporting country has given subsidy. Anti-dumping duty is because exporter is dumping to India. So if the goods are imported at cheaper price, either anti-subsidy duty will come or anti-dumping duty will come, but not both. So that's why these two are mutually exclusive. Then special points on above. Non-applicability of safeguard duty. So safeguard duty already we discussed one non-applicability. What is that? If imports by 100% EOU or SCZ and cleared to DTA, so not cleared to DTA, then safeguard duty not applicable. If they are clearing it to DTA, then only safeguard duty will be applicable. That is one point already we know. Apart from that, there are two more cases where safeguard duty is not applicable. For example, first we are importing a product. That product attracts safeguard duty. Now we are importing that product from a developing country. A developing country means only one developing country we are importing that product, and that import from a developing country does not exceed 3% of the total imports of that article into India. Say we are importing product X. Product X is being imported from developing country, one developing country, say Korea, we are importing developing country. So we are importing one product X, and developed country we are importing, say from Japan we are importing, and from Korea we are importing for 300 lakhs rupees, 300 lakhs. And then what is the import from Japan? From Japan we are importing for 6,000 lakhs. We are importing for 6,000 lakhs. Okay, 9,000 lakhs from Japan, 9,000 lakhs from Japan. Now what is the total? The total is 9,300 lakhs. 9,300 lakhs. Now we are importing only from one developing country. What is the percentage of imports of developing country to total imports? So 300 divided by 9,300, that will be 3.22%. So which exceeds 3%. Therefore on Korea, imports from Korea, there will be safeguard duty. We can't do anything with respect to that. What about imports from Japan? Always there will be safeguard duty, because the product X attracts safeguard duty. Whether you are importing it from Korea or Japan or any country, there will be safeguard duty. But they gave a relaxation. That relaxation is if you import from one developing country, and imports from one developing country does not exceed 3% of the total, so then there is no safeguard duty. That is relaxation. But import from developed country, always there will be safeguard duty. Now slight change in this. What if it is, instead of 9,000, it is 11,000 lakhs. 11,000 lakhs imports from Japan. So total will be 11,300. Then when it is 11,300, the percentage will be 300 divided by 11,300, that is 2.65%. 2.65% does not exceed 3%. So therefore on import from Korea, there is no safeguard duty, but on import from Japan, there will be safeguard duty. That is this relaxation, first relaxation. Second relaxation, if you see, suppose if you are importing from more than one developing country, so long as the aggregate import from developing country with less than 3%, take less than 3% as a cumulative, taken together does not exceed 9% of the total imports of that article into India. Say for example, we are importing product Y, and that product Y attracts safeguard duty. Product Y attracts safeguard duty, and this product Y we are importing from, so developing countries, we are importing from developing countries. So 4 developing countries, A, B, C, D, and then developed countries also we are importing, and then total we need to take. So say developing country A, so 300, B 200, C 100, and D 150, and developed countries is 11,000, and total if you see 11,000 lakhs plus 150 plus 100 plus 200 plus 300, that will be 11,750. Now 11,750, so percentage, so 300 divided by 11,750, so will be 2.55%. 2.55%. Then again 200 divided by 11,750, that is 1.7%. Then 100 divided by 11,750, that is 0.85%. Then same way 150 divided by 11,750, that is 1.27%. So therefore we are importing from developing country, and each developing country with less than 3%, taken together, you take it together, how much it comes to? 1.27 plus 0.85 plus 1.7 plus 2.55, so that will be 6.37, which does not exceed 9%. So therefore on import from developing country A, B, C, D, there is no safeguard duty, but on developed countries only there will be safeguard duty. So these are the 2 points that we have. Then next one, so therefore whenever you get a question that when safeguard duty is not applicable, you need to write number 1, if in the notification they have not given a particular country, then import from that country, safeguard duty not applicable. Number 2, suppose if it is imported by 100% EOU or a unit in SEZ but not cleared to DTA, then also safeguard duty not applicable. Number 3, we are importing an article from a single developing country, and import from that developing country does not exceed 3% of the total import of that article into India. And number 4, we are importing an article from more than one developing country, and import from each developing country with less than 3% taken together does not exceed 9%. So then also there is no safeguard duty. Then circumvention of anti-subsidy duty and anti-dumping duty. Circumvention will arise whenever you try to change the description of the product. Say on import of one product attracts safeguard duty. So now you are changing the description of the product. Say you are importing toys, you need to pay safeguard duty. Now you change the description as toys to plastic articles. So then in that case, so there may not be safe like anti-subsidy duty or anti-dumping duty like that. So what you will do, so you will try to alter the description or name of the article to avoid this ASD and ADD. Or for example, if you are importing an article, so say car you are importing, so car attracts anti-subsidy duty. So then in that case, you will import it in unassembled or disassembled form, so that you will assemble it here, okay. Then by changing the country of origin, if import from Korea attracts anti-subsidy duty, now you are changing the origin as Korea to Australia like that. You change the country of origin of the export, or in any other manner you try to escape from payment of anti-subsidy duty or anti-dumping duty. Then in that case, whatever notification already given by the government can be extended for these goods also for which you change the description, these goods also for which you change the country of origin, these goods also which are imported in unassembled or disassembled form. So actually notification is not for these goods, but they can extend that notification for these goods, where the government on such inquiry as it considers necessary is of the opinion that circumvention has taken place either by following ways. It may extend the anti-subsidy duty or anti-dumping duties to such other article also from such date not earlier than the date of initiation of inquiry, as the central government may by notification official gazette specify. The next, absorption of anti-dumping duty and anti-subsidy duty. So whenever they are trying to absorb the anti-dumping duty or anti-subsidy duty, then Indian government can increase the anti-dumping duty or anti-subsidy duty to the extent it is absorbed by the exporter. Say for example, so exporting country, so there is something called as dumping margin, and importers country or importing country, there is something called as injury margin. So dumping margin is based on, one second here. Dumping margin is based on selling price in the exporter's country. Say selling price in exporter's country is $150 and export price is say $100, and then in importing country, so when export is for $100, definitely the landed value will be somewhere like $125 more than the export price. And here the normal selling price in India is say $160. So now if you see what is the dumping margin, 100 minus, that is 150 minus 100, $50, and here it is 160 minus 125, so that will be so $35. So therefore what will be the anti-dumping duty? Therefore anti-dumping duty will be $35. So therefore what will be the cost of import? So the cost of import, if you see, the cost of import is so 125 plus 35, 125 plus 35. So 125 plus 35, which will come to $160. So therefore it is equal to the selling price in India. So that is not a problem. So cost of import is 160. This is why anti-dumping duty will be levied, for the purpose of increasing the cost of import. Okay. Now what has happened is that, so here exporter is trying to reduce his price. Now anti-dumping duty notification has been issued, and in that anti-dumping duty notification they are telling $160 So that is $35 is the anti-dumping duty. Anti-dumping duty is $35, which is fixed as the notification. But what has happened? So this exporter is trying to reduce the price. He is trying to reduce the price by $35 because they wanted the person in India to enjoy the benefit. So therefore, export price has been reduced from $100 to say $65. Then the landed value will not be $125. The landed value also will come down to $90. Then what is the revised cost of import? The revised cost of import will be $90 plus government has given a notification for anti-dumping duty for how much? $35. So which will be $125, and in India the selling price is 160. So definitely people will import. So this is known as absorption of anti-dumping duty. So whenever exporter tries to absorb this anti-dumping duty by reducing his export price, now what Indian government will do? So they will revise this notification and they will enhance the anti-dumping duty by $35. Now the revised anti-dumping duty will be $70. So therefore you are importing for 90, you import, no issue. So you pay now $70, then the price will be taken as $160. Okay, this is known as absorption of anti-dumping duty and anti-subsidy duty, where central government on such inquiry, as it may consider necessary, is of the opinion that absorption of anti-subsidy duty or anti-dumping duty has taken place, whereby the anti-dumping duty so imposed is rendered ineffective. It may modify such duty. It may modify, that is already notification is given, but they can modify that duty to counter the effect of such absorption from a date not earlier than the date of initiation of inquiry. So when absorption is said to taken place, absorption of anti-dumping duty is said to have taken place if there is a decrease in the export price of an article without commensurate change in the cost of production. So just like that, so exporter has reduced the price from 100 to 65, so without any change in the quality, etc. So then definitely, so there will be an absorption that has taken place, that is this. Then next, so 1 second here, battery went off, I'm just changing it. Yes. So there is one query here, I am just checking this query. Sir, is this 3% seen for each importer or whole of India product wise? It is whole of India product wise. So therefore, this 3% we should not see for the importer. This 3% what I am telling is total imports of that article into India, not importer wise we see it product wise. So that product imported into India in total we will be taking it. So this computation is not done by the importer. This computation is done by Indian government, customs department, and they will be specifying that safeguard duty is not applicable if imported from this country, like that. Okay, so this should be total import of that article into India. Product wise we need to see. So then next, so this is old customs duties relevant in the current scenario. So already I told you, right now CVD is applicable for which goods? CVD, alcoholic liquor for human consumption, then petroleum products, and then tobacco and tobacco products. These three cases only CVD is applicable at present. Then SAD is applicable at present on what? Only on petroleum products. Then computation of customs duty in case of import, already we have seen. Now we are moving on to the next area, that is section 19 of Customs Act 1962, that is import of goods as set of articles. which means I am bringing some group of articles in a single package, but it is not composite articles. These are not like the geometry box example case, not like that. So these are like some articles as a group I am bringing it into India. Now in that case, say for example, I am ordering for one DSLR camera, one tripod and one lens and one SD card. Like that I am importing group of articles frequently brought together, like that they say na. So it will be combo, like a combo I am importing. Now here we need to apply the concept of that composite supply and mixed supply, and we need to arrive at the value. So see this, what should be taken as the rate of customs duty? Suppose if articles are liable to ad valorem duty. Ad valorem duty means, so when customs duty is payable as a percentage of some value, it is known as ad valorem duty. We have two methods of payment of customs duty, that is specific duty method and ad valorem method. Specific duty method means when we pay customs duty irrespective of its value but based on some units of measurement, then it will be called as specific duty method. For example, in case of cigarettes imported, we will not pay customs duty based on the value of the cigarette but based on the length of the cigarette. We pay customs duty. Like that, when we are importing LED TVs, we will not pay based on the value of the TV customs duty but on the screen size, 40 inch, 55 inch, 50 inch, like that based on inches we pay customs duty. That is known as specific duty method. Whereas ad valorem method means we need to arrive at the value, on that value when we need to multiply a percentage, that is known as ad valorem method. So now here we are importing goods which are chargeable to duty at ad valorem, and we are liable to duty at the same rate. Means these 4 articles which we are importing, all 4 articles are chargeable to duty at the same rate. Then the question of this section 19 will not come, because all goods are at the same rate. Then we will take it and multiply it on the value. So confusion will not be there. Where the confusion will be, if they are liable to duty at different rates. For example, camera one rate, then lens one rate, tripod one rate, SD card one rate. Like that, when we have different rates and we are importing it in one package, so then which rate should be taken is the confusion. So for that reason only we have section 19. Suppose separate value can be ascertained, means we know how much is the value of camera, how much is the value of SD card, how much is the value of lens, and how much is the value of the tripod, like that separately ascertainable. Now respective rate you will take on the respective value and multiply, and you will pay the customs duty, no issue at all. So chargeable to customs duty accordingly based on separate value. Suppose if it is compulsorily supplied along with the main article and separate price not available, if it is a compulsory accessory like a composite supply, so which means naturally bundled in the ordinary course of business, you buy the camera, you get tripod always free, then in that case what we need to do, so we need to take the rate of principal supply. What is the rate of principal supply? Camera, and that should be applied on the entire value. So entire consignment chargeable to duty at the rate applicable to the main article, like a composite supply. Understood or not? So but here we need to see what single price. A separate price means neither composite supply nor mixed supply. Separate price means always it will be treated like separate values and chargeable to GST accordingly. But only when there is a single price and it is compulsorily supplied, means what? Naturally bundled. So then we need to take the rate of main article, it is treated like composite supply. What if it is not a compulsory article? So price also single. All these 4 imported for a single price, and these are not compulsorily supplied along with the main article. You have to pay for it, but the entire price is like a combo price, single price is there. Then in that case you need to treat it like a mixed supply, and highest rate should be taken. So entire consignment chargeable to duty at the highest of such rate. So what you need to remember, 4 points. Suppose if the rate is same, no worry. So we will take the same rate and apply it on the entire value. Suppose if the rates differ, and we need to check whether the prices are separately ascertainable or not. If price is separately ascertainable, respective value for respective rate. If the price is not ascertainable separately, then is it compulsorily supplied along with the main article or not compulsorily supplied along with the main article? If compulsorily supplied along with the main article, then treat it like a composite supply and take the rate of main article. If compulsorily not supplied along with the main article, then treat it like a mixed supply and take the highest rate. Now in this process what will happen? Even those articles which are not chargeable to duty will also get charged to duty at the highest rate or at the rate of main article. Say for example, camera 12%, SD card is nil rate. So now when we take single price for both camera and SD card, so therefore the camera rate will be applied on SD card also. Even non-dutiable articles also will get dutiable in this process. So that's why what we should do, whenever we are importing articles at different rates of duty, we should ensure that the separate values are ascertained. When the separate values are ascertained, so SD card in our example may not be chargeable to duty because it is non-dutiable article. But when you go for this main article or highest rate, even non-dutiable articles also will be chargeable to duty. That is this. So with this, we completed types of customs duties. Then we have valuation under customs. So this valuation under customs, in case of import, what should be taken as the value of supply? So transaction value. The transaction value is CIF price in case of import and FOB price in case of export. What is the link between these prices? We need to have a clarity here. So this clarity is very much required so that we will not get confused. So first we need to know the price prevailing at the exporter's factory. The price prevailing at the exporter's factory gate, so is known as, this is exporter's factory. Exporter's factory. From exporter's factory, the goods will come to the exporter's port. The goods will come to exporter's port. This is port or airport of exporter. Then thereafter, the goods will be transported from port or airport of the exporter to the port of airport of the importer, import port or airport. Thereafter, the goods will be taken to the importer's place. So then the goods will be taken to importer's place. So the importer's factory or importer's place of business. So importer's place. Importer's place. Now, so the price prevailing at the exporter's factory means if the goods are sold at the exporter's factory gate, then it is known as X factory price. X factory price. So what is this X factory price? The price prevailing at exporter's factory. If it is X factory price, then importer only should take care of all the transportation from the factory gate of the exporter to the importer's place. So now from exporter's factory, the goods will be transported to exporter's port. For transport of these goods to the exporter's port, so there will be some cost, that is freight, from where to where, exporter's factory to the exporter's port. So this freight and for loading the goods in the port, so these goods needs to be loaded now. So loading cost, loading in the ship or aircraft, so loading charges. So therefore what and all if you add, you will get FOB price. So FOB price is the price prevailing at the exporter's port. So therefore FOB price, when we will get X factory price plus freight from exporter's factory to the exporter's port or airport plus loading charges in the exporter's port or airport will be called as FOB price. Then once we get the FOB price, thereafter for transporting the goods from the exporter's port to importer's port, so there will be some freight and insurance. So this freight and insurance for transporting the goods from exporter's port or airport to importer's port or airport, if you add this freight and insurance, then it will be called as CIF price. So this will be taken as CIF price. Okay. So then thereafter from import, port of import, thereafter to importer's place, there will be some freight and insurance, or from freight cost, unloading charges, etc. So therefore the goods will be transported to importer's place. For this, first there will be some unloading charges, and thereafter so some freight will be there. Okay. Now this freight and unloading charges will not come in CIF price, because CIF price is the price prevailing at the importer's port. So thereafter unloading charges and freight paid by the importer to take it to his place will not come in CIF price. Okay. So then what should be taken as the assessable value in case of import? In case of import, the assessable value in case of import is CIF price. So therefore, what and all should be taken in CIF price? FOB price is given. Then FOB price plus freight plus insurance, you will get CIF price. Suppose in the question if X factory price is given, then how to arrive at CIF price? X factory price plus freight from exporter's factory to exporter's port, loading charges in exporter's port or airport, then exporter's port to importer's port freight and insurance. If we add everything to X factory price, we will get CIF price. That will be taken as the assessable value in case of import. Then what should be taken as the assessable value in case of export? Assessable value in case of export, assessable value in case of export is FOB price that should be taken. So this clarity of these three prices if you have, that is sufficient. So accordingly in question any type of price is given, you will be able to arrive at the answer. Now what should be taken as the assessable value in case of import? The assessable value in case of import is CIF price. So CIF price will be taken as the assessable value in case of import. So take the CIF price, and how do you get the CIF price? FOB price plus insurance plus freight, we will get the CIF price, and FOB price will be given. FOB price will be given, but for this FOB price given, we need to make some adjustments. Just like in value of supply, we will make some adjustments, inclusions to the assessable value, transaction value, like taxes, duties and cess by whatever name called other than GST, any expenditure which the supplier is liable to pay but which is paid by the recipient, like that some inclusions we make. Like that for FOB price also we need to make some inclusions. Then we get the revised FOB price. Then we need to add to this insurance and freight. Insurance and freight when you are adding, we will get CIF price. So insurance, we ascertainable, not ascertainable. What is the meaning of ascertainable? If goods are being imported in one consignment itself, so then the importer will pay the freight and insurance for that consignment, for that container. So then importer will know how much is the charges for that container. So therefore ascertainable. Whenever the container contains the goods belonging to multiple importers, so like in a container 30% belongs to importer A, 40% belongs to importer B, remaining 30% belongs to importer C, which means none of these three importers know how much is the freight, because the freight charges will be apportioned between them by the logistics operators. So therefore the importer don't know what is the freight cost, what is the insurance cost. That is the meaning of ascertainable, not ascertainable. Suppose if insurance is ascertainable, we take it as actuals. If insurance is not ascertainable, we need to take 1.125% of FOB. Got it? So then freight. If freight is ascertainable, then again divide into two. Air freight or other freight. If it is air freight, compare it with 20% of FOB, because air freight will be usually high. The maximum air freight should be taken as 20% of FOB. So actuals are 20% of FOB, whichever is lower. Suppose if it is other freight, we will take actuals. And if it is not ascertainable, definitely we will take 20% of FOB. So insurance ascertainable, actuals, not ascertainable 1.125% of FOB. Same way freight. Ascertainable, not ascertainable, not ascertainable 20% of FOB. Ascertainable again we need to see air freight or other freight. Other freight we will take actuals. Air freight we will compare it with 20% of FOB. Actuals or 20% of FOB, whichever is lower. But when you take FOB, which FOB should be taken? We need to take the revised FOB, that is FOB price after making the adjustments. So that revised FOB should be taken for computation. And then this freight shall include handling charges. This freight whatever is there, this freight shall include handling charges, but not at the place of import. So which means which charges will be included in the freight? Loading charges, but not unloading charges. Unloading charges will not come in this freight. Ship demurrage charges. Whenever we anchor the ship at the outer space, so then for anchoring the ship at the outer space and with not bringing it to the port, we need to pay, that is the captain of the ship needs to pay something called as ship demurrage charges. But whatever ship demurrage charges that is paid by the captain of the ship will in turn be recovered from the importer. So therefore that should also be part of freight. Then lighterage and barge charges. When the ship is anchored at the outer space, because the ship is so big that it cannot come into the port, then from the ship to the shore, they will be transporting the goods through boats. So therefore, for transporting the goods through boats, some extra charges is payable to the boat operators, that is known as lighterage and bar charges. That is also part of freight. That is charges incurred for transportation of goods from the ship to the shore. So these are all should be taken as part of freight. So in the freight, what should be taken? In this freight, what should be taken? So not only the freight, actual freight, but also loading charges, etc. And then ship demurrage charges, lighterage and bar charges for bringing the goods from ship to the shore of importer. So that should be taken. That is about the CIF price. Then what are the adjustments to be done for this FOB price to arrive at the revised FOB? So there are some adjustments. Number one, commission. Commission we need to adjust, that is we need to add. Which commission we need to add? Buying commission or selling commission? Selling commission. So buying commission and selling commission difference we need to know. So buying commission is a commission paid to buy. Selling commission is a commission paid to sell. So who is selling? Exporter is selling. So therefore exporter's agent commission paid is known as selling commission. Who is buying? Importer. So therefore commission paid to importer's agent is known as buying commission. Again I am repeating, the one who is selling, his agent commission is known as selling commission. The one who is buying, his agent commission is known as buying commission. Now who is selling? Exporter is selling. So commission paid to exporter's agent is known as selling commission. Who is buying is importer. So commission paid to importer's agent is known as buying commission. So buying commission is paid by importer to his agent. So his expenditure, it will not be included in the value. But if exporter is paying exporting commission, that is selling commission to his agent, then also it will not be included. But exporter has to pay commission to his agent, which is paid by the importer, which is an indirect consideration to the exporter. So that should be included in the value. So which commission should be included in the value? Selling commission, which is paid to the exporter's agent, paid by the importer, that should be included in the value. The other name for the selling commission is local agent's commission, because exporter's agent will be in India representing the exporter, whereas importer's agent will be outside India representing the importer. So therefore, who is local agent? Exporter's agent. So the other name of selling commission is local agent's commission. Then second inclusion is importer is sending some material to the exporter. Using that material, exporter is making the product and sending it to the importer. Now whatever free of cost material sent by the importer to the exporter is included in the value of the imported goods, because exporter will not charge for this material, because this material is free of cost sent by the importer. So therefore it is like any amount that the supplier is liable to pay, but which is paid by the recipient, is an indirect consideration to the supplier. So therefore any material or any molds and dies or any capital goods which are sent by the importer to the exporter used in the manufacture of imported goods, we need to include that value of the material, either actual cost or apportioned cost. Then other expenses incurred by the exporter and recovered from the importer. Is it before import or after import? We need to check. If it is before import, definitely it should be included in the value. For example, design and development charges, drawing charges, etc. and all, or any other expenditure incurred by the exporter before import of the goods should definitely be included. Suppose if expenses are incurred by the exporter after import, but as a condition of sale of imported goods, so then it should be included. For example, installation charges. Installation charges, so exporter will be collecting it from the importer after the product is imported, when it is installed. So then this installation charges is payable as a condition of sale of imported goods, even though it is charged by the exporter after import, that will be included in the value because it is specified in the contract itself. Whereas if there is any customization charges or any extra charges which is paid by the importer after import, not as per contract of sale but separately, then that will not be included in the value. So importer is paying that as per the importer's request, that is to be excluded from the value. These are the three adjustments we need to make to the FOB price to arrive at the revised FOB price. On that revised FOB price only, this 1.125% of FOB or 20% of FOB should be computed. So that is about valuation in case of import and export. In case of export, we will be taking normal FOB price. Should we make any adjustments? No, no adjustments. Whatever is the FOB price, that only should be taken as the value in case of export. So look into Customs Valuation Rules 2007. Whenever we take assessable value as CIF price or FOB price, in case of import it is CIF price. But Rule 3 of Customs Valuation Rule says, we will take assessable value as transaction value. What is the transaction value in case of import? CIF price. And we will make some adjustments as per Rule 10. That's what we have seen so far, that freight, insurance, and thereafter we make some adjustments, etc. Suppose if customs officer has doubt about the truth and accuracy of the declared value, or if these 4 conditions, any of these 4 conditions are not satisfied, then the transaction value is not applicable. Suppose if the customs officer should not have any doubt about the truth and accuracy of declared value, and it should be unrestricted sale, unconditional sale, unrelated parties, and price must be the sole consideration. Total 5 conditions. Condition number 1, price must be the sole consideration. Condition number 2, supplier and recipient are not related. Condition number 3, it should be unconditional sale, it should be unrestricted sale. Condition number 4, and condition number 5, the customs officer is not having any doubts about the truth and accuracy of the value. If any of these conditions not satisfied, then we will not take transaction value and we will determine the value as per rules, that is TISDCR. T for transaction value. If transaction value fails, then we will take identical goods. If identical goods also fails, then we will take similar value. If similar value also fails, then we will take deductive value. If deductive value also fails, computed value. If computed value also fails, then it will be residual value. So TISDCR. T for transaction value, I for identical goods, S for similar value. So then D for deductive value, C for computed value, and R for residual value. So what does identical value says? It says that you are importing some article, and for that imported article, you see the identical imported goods. Identical imported goods. What is the meaning of identical goods? Identical goods means that goods also should be imported. Say you are importing some washing machines with front end, like front load washing machines, you are importing. Now the other washing machine should also be imported and having the same physical characteristics, quality and reputation. So you are importing washing machines with front load, and top load washing machine cannot be a comparable. So again, that also should be having the same physical features, quality and reputation, and produced in the same country. Say you are importing from Korea, that washing machine should also be imported from Korea, produced by the same person, preferably, not compulsory. So you are importing Whirlpool washing machine and the other one is LG. Can we compare it? Yes, because produced by the same person is not a mandatory condition, it can be preferable. Then that comparable washing machines will be taken as the identical goods. So identical goods means 4 conditions should be satisfied. Identical goods should also be imported goods, having same physical features and quality and reputation, produced in the same country and produced by the same manufacturer preferably. So then in that case, we will take that as identical goods. But we will make 3 adjustments to this identical goods. Why? For example, we are importing 2000 units, but the other person is importing 1000 units. If that person imports 2000 units, what will be the price? Like that adjustment we will be making, because we need to have an equal footing. So we are importing 2000 units, the other person is importing 1000. What if he imports 2000? He may get a discount of 10%. So then deduct the 10% so that you will get the price if he is importing 2000. So if there is any difference in the quantity, you need to make adjustment with respect to the difference. Then if there is any difference in the transportation cost, for example, you are importing it to say Chennai port, and the comparable is being imported into Surat port. Now if that person is importing into Chennai port, what will be the extra freight cost? You add that, so you will get the comparable. That is, you are importing to Chennai port, identical means it should also be to Chennai port, but the identical goods we have to Surat port. Now add the freight cost from Surat port to Chennai port, you will get the comparison perfectly. So adjustment with respect to the transportation cost we need to make, and difference in the commercial level of importation. Say you are importing from manufacturer, that person is importing from wholesaler. If that person imports from manufacturer, means whatever is the wholesaler's margin you reduce. So therefore you will know if that person is importing from manufacturer, what will be the price? So first, identical goods means total 4 conditions that should also be imported, same physical features, quality, same country, same producer preferably, and thereafter we need to make 3 adjustments. Adjustment number 1, difference in the quantity. Adjustment number 2, difference in the transportation cost. Adjustment number 3, difference in the commercial level of importation. Now you get the identical goods, but you may have more than one identical goods. Then in that case, we need to take whichever is lowest. If multiple comparable transactions are found, then the lowest of such value shall be considered. Then suppose if you don't have identical goods, means same goods you did not find, then you go for similar goods value. Assessable value will be taken as the value of similar goods. So what will be taken as similar goods value? That is, that similar goods also will be imported goods, commercially interchangeable. For example, you are importing a front load washing machine, a top load washing machine will be comparable, commercially interchangeable. So therefore, imported goods commercially interchangeable. The difference between identical goods and similar goods is that identical goods should be same physical characteristics, quality and reputation, but similar goods will be commercially interchangeable, produced in the same country and produced by the same person preferably. So produced in the same country and produced by the same person preferably. So then these points are same. Now you will get similar goods. For that similar goods, again you need to make adjustments. 3 adjustments common: difference in the quantity, difference in the transportation cost, difference in the commercial level. But extra one more also is there, difference in the material and engineering cost. For example, you are importing a front load washing machine, top load washing machine is comparable. Now for top load washing machine and front load washing machine, usually there is a difference in the engineering work. What is the usual price difference? Say some 15,000 rupees difference will be there. Top load washing machine could be 20,000. Front load washing machine could be 35,000. So therefore that 15,000 if you add to the top load washing machine, you will get the value of the front load washing machine. So therefore we need to take the difference in material and engineering work. This is the extra point. Now you will get the value of similar goods. When you get the value of similar goods, if you get more than one value, so we need to take whichever is lower. If multiple comparable transactions are found, then the lowest of such value should be considered, that is this similar goods. So identical goods and similar goods are more or less like the same. Then suppose if you are unable to determine the value as per identical goods or similar goods, then we have rule 7, deductive value, and then rule 8, computed value, then best judged value. So deductive value is like, so that is we need to decide between either deductive value or computed value. It is interchangeable. Not necessary that we need to first go for deductive value and then computed value, not necessary. Either we can go for computed value first and then go for deductive value. What is the link between this deductive value and computed value? Deductive value is like bottom up approach and computed value is like top down approach. That is, whenever we take the value, that is, first we have material cost. So there will be material cost, and to this material cost we will be having conversion cost, conversion of material into raw material into finished goods, then conversion cost. Thereafter some profit margin will be added. Now you will get X factory price, the price prevailing at the exporter's factory, and thereafter you need to add freight and insurance. So freight and insurance, if you are adding, you will get price prevailing at the importer's port. Okay, so then after price prevailing at the importer's port, so thereafter we pay the customs duty, and after payment of customs duty, then there will be transportation cost to importer's port or importer's place. Transport to importer's place, transport to importer's place. Then we will have importer's margin, importer's margin, and after importer's margin there will be selling price of importer, selling price of importer. Okay, this is how we will be arriving at the selling price of the importer. So first cost, then profit margin, freight, insurance. So now if you see, the cutoff point is this, the cutoff point is this. So therefore if you take the material cost and you add the conversion cost and profit margin of exporter, then freight and insurance, this is known as computed value, top down approach, computed value. So therefore we need to take material cost, add all the cost up to the place of importation, that is called as computed value method. Okay, then suppose if you don't have this data, then go to the deductive value method. So take the selling price of the importer in India minus all post-import expenses. Post-import expense means what? Customs duty, transport to importer's place, importer's margin, etc. and all. If you reduce from the selling price of the importer, then you will be getting deductive value. That is the logic between computed value and deductive value. So you take cost and you add everything. So till the time of importation, you get computed value. You take the selling price in India, you deduct everything up to the importation, that is post-importation expenses, you will get deductive value. So see this, computed value, cost of production plus profit and general expenses and freight and insurance. So cost of production, profit and general expenses, then freight and insurance, you will get computed value. Deductive value, selling price of the imported goods. So selling price of the imported goods, first level after importation, minus post-importation expenses including customs duty. So all these things if you deduct, you will be getting deductive value. Then residual value, when you are unable to determine, when all these values is not determined by the importer, all these values are determined by the customs officer. So therefore when customs officer is unable to determine identical goods, similar goods, deductive value, computed value, then residual value, customs officer following the principles of valuation will be determining the value on which we need to pay customs duty. So this will be taken as the assessable value in case of importation when you are unable to determine the value which is CIF price. Then valuation in case of export. In case of export always we will take assessable value as the FOB price and we don't have to make any adjustments. Adjustments not required. Suppose if proper officer is not satisfied that the value declared is genuine, means FOB value declared is genuine, then in that case the value will be rejected and we need to go for rule 4, again identical goods, that is like, kind and quality. If rule 4 fails, then computed value, otherwise best judged value. Here we have only 3, that is like, kind and quality, computed value, residual value. What is this like, kind and quality? Just like identical goods. There we are comparing with other imported goods. Here we are comparing with other exported goods. Other exported goods having the same physical features and quality, produced in the same country, that is in India, produced by the same person preferably. And for this we need to make 3 adjustments. What are the 3 adjustments? Difference in quantity, difference in transportation cost, difference in commercial level of exportation. After making this, if we get more than one value, we need to take whichever is lowest. This is just like identical goods. Then suppose if this we are not able to get, then we need to go for computed value method. Computed value method means we need to take cost of production plus profit and general expenses. So why we should not take freight and insurance? Because we need to take FOB price. What is FOB price? Price prevailing at the exporter's port. So cost of production plus profit and general expenses, we get the price prevailing at exporter's port, that is computed value. Then best judged value is like residual value. Customs officer will determine the value by using the principles of valuation. So this is in case of export. Export we have less information only. Then valuation in case of import of second hand goods. Suppose if you are importing second hand goods, what is the value to be taken? First we need to get a certificate from a overseas chartered engineer. So overseas chartered engineer should give a certificate as to what could be the value of the second hand goods. If that overseas chartered engineer certificate is submitted in form A, that itself will be taken as the value. Suppose if we fail to produce a certificate of overseas chartered engineer, then in that case we need to produce the certificate of a chartered engineer in India. Then in that case, whatever is the chartered engineer certificate that is submitted in form B in India versus the declared value by the importer versus the depreciated value of those goods will be compared by the customs officer. So comparison between the value declared by the importer and value as per the report of chartered engineer and depreciated value of the goods. If there is no much differences, between the value, then whatever value declared by the importer will be taken. If there are huge differences between this value, customs officer will seek explanation from the importer. Then if importer gives explanation and officer is satisfied, then also the declared value by the importer will be taken. Otherwise, the officer proceed to determine the value as per rule 4 to rule 9, that is identical goods, similar goods, deductive value, computed value, residual value. This is in case of import of second hand goods. So it can be asked as a theory question. So what is the procedure to be followed in case of import of second hand goods and how to determine the value? You need to just convert this chart into theory and you need to write. Then next one, we are moving on to customs procedures. We have import and export procedures. So first we will start with import procedures. So you can see that chart there. So import procedures, first we are discussing from the point of view of imports by vessel. So total 11 points to be followed. So what will happen? The import procedure will be revolving around exporter, then importer, master of the vessel and the customs officer. First what will happen? You have to just look into the steps involved. Exporter will hand over the cargo to the shipping company. Then the shipping company will give a document of title to the exporter called as bill of lading. That bill of lading will be sent by the exporter to the importer. Now importer is having bill of lading, which means that he is the owner of the goods. So now the goods are loaded into the vessel and the vessel is coming into India. When the vessel is coming into India, the master of the vessel, step number 4, needs to submit one document called as import manifest. When master of the vessel submits import manifest, the customs officer will grant the entry inwards. So when the customs officer grant entry inwards, the master of the vessel can unload the goods. So this unloading of goods will be under the control of a person called as custodian, port trust authorities. There will be delivery of cargo. Now the master of the vessel job is done. Now step number 7 you see. So importer will be filing one bill of entry with the customs officer. Now customs officer will be verifying the bill of entry and upon payment of customs duty, the customs officer will pass one order called as out of customs charge order. So whenever out of customs charge order is passed by the customs officer to the importer, which means that importer paid the customs duty and he can take those goods. Then parallelly importer, step number 9 you see, needs to submit that bill of lading to the master of the vessel and the master of the vessel will give the delivery order. So now importer is having two orders. Delivery order, which means he is the owner of the goods, then out of customs charge order, which means that he paid the customs duty. So this delivery order and out of customs charge order he will submit to the port trust authorities, then the port trust authorities, that is custodian, will release the goods. So these are the 12 steps that we have with respect to import procedure. Now in this case, so for aircraft what will change? So this point number 2, point number 3 and point number 9. So this will be called as airway bill in case of aircraft, because so the document name is called as airway bill instead of bill of lading. So wherever bill of lading comes, that will be called as airway bill in case of aircraft, and in case of vehicle that will be called as lorry receipt or railway receipt. So then you can see that in the next page. So all the import and export procedures under customs are through customs common portal, that is icegate.gov.in, means where importer will file bill of entry in this portal, where person in charge will file import manifest same in this portal. Then in case of import by aircraft, step number 2, step number 3 and step number 9 will be changed to airway bill. Same way in case of import by vehicle, the 239 will be replaced with lorry receipt or railway receipt. Then in case of aircraft and vehicle, grant of entry inwards is not required for arrival but required for unloading of goods. And what is the name of the document to be filed by person in charge with the customs officer in case of aircraft and vehicle? Already we discussed. In case of aircraft, the name of the document will be arrival manifest, import manifest, arrival manifest, import report. In case of vessel, it is import manifest. In case of aircraft, it is arrival manifest. In case of vehicle, it will be import report. Then compliance to be followed by person in charge. Who is a person in charge? Master of the vessel in case of vessel, pilot in case of aircraft and driver in case of vehicle. So this person in charge should bring the aircraft or vessel or vehicle to the customs port or airport or land customs station, because not all ports are customs port. Only some ports in India are notified as customs port for import or export. Same way, not all airports will be notified as customs airport for import and export. So therefore, only those ports and airports which are notified for import and export are called as customs port and customs airport. Like how port is for import by vessel, airport is for import by aircraft, like that. If the goods are imported by vehicle, the check post will be called as land customs station. So in those places only the person in charge should bring the conveyance, and the person in charge should be filing import manifest, arrival manifest and import report. In case of vessel, the document name is import manifest, and in case of aircraft it is arrival manifest. In case of vehicle it will be import report. And when the arrival manifest and import manifest should be filed before the date of arrival, this import manifest and arrival manifest should be filed, whereas import report should be filed within 12 hours after its arrival. Okay. And what is the mode of presentation? The mode of presentation is electronic in case of import manifest, arrival manifest, but import report we don't have electronic, so it should be manual. And when import report should be submitted? Within 12 hours after arrival, but the other two should be submitted before arrival. What if there is a late, that is belated filing of this document? For belated filing, penalty will be payable up to 50,000 rupees. Then this person in charge is required to file one passenger name record information, that is whichever passenger is coming along with the goods, so that passengers and crew information should also be submitted. Then in case of imports by vessel, goods will be unloaded only after obtaining grant of entry inwards, and these goods will be unloaded under the custody of a person called as custodian. So this custodian should provide the safe custody of the goods. Suppose if the goods are lost, that is pilfered. Pilfered means the goods are lost, stolen. Petty theft is known as pilferage. Then the custodian is responsible for payment of customs duty on that goods, but importer is not required to pay customs duty. Then what about the value of the goods? Importer will get that value of the goods from the insurance company, but customs duty importer will not pay, the custodian will pay the customs duty. Then only those goods specified in import manifest, arrival manifest or import report should be unloaded. Other goods should not be unloaded, and goods should be unloaded at the approved place only, and goods should be unloaded under the supervision of a proper officer. Suppose if that unloading requires small boats, that is from the ship to the shore, the goods will be coming by boats, then these goods should accompany a document called as boat note, and that boat note should be obtained from customs officer. If unloading happens after office hours or during holidays, some extra charges is payable to the customs officer. That extra charges is known as merchant overtime charges. So that is this, if unloading is on holidays or after office hours, so then importer shall pay merchant overtime charges to the customs officer. So that is the person in charge usually pays, and in turn it will be recovered from the importer. So these are the various compliance to be followed by the person in charge. Now these points will be tested as true or false statements. In MCQs mainly they will test which of the following statements are not correct in terms of import procedure. So they will give few points, A, B, C, like 1, 2, 3, 4, A 1 and 2, 3 like B 2 and 3, like that they will be giving. So therefore for that purpose this will be useful. Then next, what is the compliance to be followed by importer? Imported goods unloaded shall remain in the control of the custodian, who shall be responsible of the imported goods till clearance. If such goods are pilfered, such custodian shall pay duty. But to clear that goods, importer has to file a bill of entry. So what is that bill of entry? Three bill of entries we have. Bill of entry for home consumption, for taking the imported goods directly to importer's place. Then bill of entry for warehousing or into bond bill of entry, for depositing the goods in the warehouse without payment of customs duty. Then ex bond bill of entry for home consumption, for taking the goods from the warehouse upon payment of customs duty. So then what is the time limit for filing the bill of entry? Bill of entry should be filed before the date of arrival. So suppose if today the arrival happens, before that date, that is by yesterday it should be filed. And can we file it even before that? Yes, even before that we can file, but not 30 days prior to the expected date of arrival. So minimum before the date of arrival, maximum 30 days prior to the date of arrival. So this bill of entry should be filed. If this vehicle does not arrive within 30 days, for example, we filed a prior bill of entry, so that then the aircraft did not come within 30 days, then the prior bill of entry is expired. Again we need to file a fresh bill of entry, because the validity of a prior bill of entry is only 30 days. So after the 30 days, so we need to file a fresh bill of entry if there is no arrival of the aircraft or vessel. What is the late fee for delay in filing bill of entry? If it is exempted goods or dutiable goods, whatever it may be, so for delay up to 3 days, 5,000 rupees per day. For delay beyond 3 days, 10,000 rupees per day. If it is exempted goods, the maximum late fee will be 50,000. If it is dutiable goods, the maximum late fee will be 100% of duty payable. For example, I need to file bill of entry by yesterday. I filed bill of entry 3 days late. So which means, so today arrived. So today also should be counted for late fee because the due date is before the date of arrival. So arrival date and after 3 days from arrival I filed means total is 4 days. So therefore for first 3 days what is the late fee? 5,000 rupees into 3 days 15,000. For the fourth day what is the late fee? It will be 10,000. So that is 25,000 will be taken as the late fee in this case. If the delay is 7 days, first 3 days it will be 15,000. Next 4 days it will be 10,000. So 40 plus 15, 55,000 will be taken as the late fee. But for exempted goods the maximum will be only 50,000. But for dutiable goods 100% of duty payable. Then this person should pay customs duty, that is the importer should pay the customs duty along with bill of entry for home consumption. And once the importer pays a customs duty, customs officer will pass one order. What is the name of the order? Out of customs charge order. What is the time limit within which we need to file the bill of entry after arrival? Say we missed, before arrival we missed. We could not file the bill of entry before arrival. So after arrival also can we file bill of entry? Yes. But if you are not filing the bill of entry after arrival within 30 days, then customs officer will either dispose of those goods by way of auction or he can keep the goods in the warehouse. So pending clearance. Okay. So therefore first 30 days the goods will be under whose control? Custodian control. After the 30 days from the date of unloading, if you are not filing any bill of entry as an importer, then the customs officer has two options. Option number one, either he will dispose it off or he will keep the goods in warehouse for a further period of 30 days. Like that, again for every 30 days, they need to do a review whether to dispose it off or to keep the goods in the warehouse. So if goods are not cleared for home consumption or warehousing within 30 days after unloading, such goods may be disposed of by the custodian or officer may deposit such goods in warehouse. For how many days they will deposit the goods in warehouse? For a 30-day period. And beyond 30 days, for a further period of 30 days by the commissioner should approve. Then until that point of time, so we can file the bill of entry and we can clear the goods. But if you delay filing bill of entry, we are continuing the late fee. Plus as the goods are deposited by the customs office in the warehouse, they will be collecting warehousing charges also from us. And next, this warehousing is not just always the case, but this is just an option. Means what is the other option? They can even dispose of the goods by way of auction. Then export procedures. These export procedures to be followed by exporter, person in charge and customs officer. So exporter will be filing one document with the customs officer for the purpose of export. What is the name of the document? The document name is known as shipping bill or bill of export. So whenever the shipping bill or bill of export is submitted to the customs officer will verify the shipping bill and collect the customs duty if any, and will be passing a let export order, which means the goods can be exported. Now exporter should hand over that shipping bill or bill of export with the person in charge, and the person in charge will be obtaining grant of entry outwards to leave the country. Now person in charge will be loading the goods into the ship, and in case of baggage it can be loaded without any permission. Then the person in charge will be submitting the export manifest that contains the details of the goods which are loaded into the ship. And then, so in case of aircraft, the document name is known as export manifest will be replaced with departure manifest and export report. Already we saw the documents. So in case of aircraft it is departure manifest, in case of vehicle it is export report. Then what are the compliances to be followed by person in charge? There unloading of goods only at approved place. Here loading of goods only at the approved place. And there unloading under the supervision of proper officer. Here loading under the supervision of proper officer. There unloading with the help of small boats, boat not required. Here loading with the help of small boats, boat not required, shipping bill itself is sufficient. Then loading on holidays and after office hours. There unloading after office hours, merchant overtime charges. Here loading on holidays or after office hours, merchant overtime charges payable. Then person in charge should obtain entry outwards from the customs officer before loading of the goods, and they will be filing export manifest, departure manifest or export report before departure, and they will be filing a passenger name record information before departure and shall obtain permission to leave India from the customs officer. These are the compliances to be followed by person in charge. Whereas compliance to be followed by exporter, what are the compliances? They need to file shipping bill in case of SLR aircraft and bill of export in case of vehicle, and shall assess the value and pay customs duty, and thereafter should obtain let export order for the purpose of export. So these are the points to be followed by exporter. Then we have something called as transit and transshipment. Transit means the same vehicle or conveyance which is bringing the goods to India will be taking the remaining goods from one port or airport in India to another port or airport in India. Then the goods are said to be as goods in transit. Say for example, a ship is bringing some goods to a port in India. Say the ship is bringing some goods to Gujarat port. And in this port in Gujarat, say the ship is bringing 10,000 containers. In this 10,000 containers, they are unloading say 6,000 containers in Gujarat port, and the same ship, say it is ship A, the same ship is taking the goods to another port, say Chennai port. It is taking, the same ship is taken to Chennai port, and in that ship, so the remaining 4,000 containers are unloaded. So then these 4,000 containers are said to be goods in transit. The same conveyance, it can be aircraft or ship, the same conveyance is bringing the remaining goods from one port or airport to another port or airport, then the goods are said to be in transit. Important point here is that this transit freight will be there na, some transit freight will be there. So for taking the goods from Gujarat port to Chennai port, some transit freight will be there. This transit freight will be included in the value of 4,000 containers, because this transit freight is for bringing the goods from Gujarat port to Chennai port. So therefore this transit freight will be included in 4,000 containers. Whereas transshipment means what will happen? Say one ship is coming to India, ship A, and this ship A, so in Gujarat port, they are unloading 6,000 containers, and then this remaining 4,000 is unloaded in another ship, ship B. So in ship B, they are unloading 4,000 containers, and total 10,000 containers are brought in ship A. And now from Gujarat port to Chennai port, which ship is going? So ship B is taken to Chennai port, and there they are unloading 4,000 containers. So now this is known as goods in transshipment, because they are transporting the goods from one ship to another ship or one aircraft to another aircraft, means this is known as transshipment. And remember, transshipment freight will not be included in this 4,000 containers. So which freight should be included? Transit freight should be included, and transit freight will not be included in the value. You can see the last line. So transit freight shall be part of CAF value, but transshipment freight shall not be part of freight in CAF. Then transit means the same conveyance is taking the goods to another port or airport. Transshipment means any other conveyance is taking. Bill or declaration, in case of transit, bill or declaration not required, but in case of transshipment, a bill of transshipment or declaration of transshipment is required, because we are changing the vehicle. So continuity in records and control. In case of transit, there is continuity of records and control, but in case of transshipment, as the vessel changes, there is no continuity of records. In the first port or airport, that is, say in both the cases, so in ship A, 10,000 containers are brought. Now in Gujarat port, they will submit import manifest. In that import manifest, should they give the details of entire 10,000 containers or not? Yes. So here also in Gujarat port, let it be transit or transshipment, entire 10,000 containers details should be made available in the Gujarat port. In the first port, IMRAM contains the details of normal cargo as well as transit cargo. Here also same, IMRAM contains the details of normal cargo as well as transshipment cargo. Again, when they take, so this ship to Chennai port, again they need to file import manifest. So yes or no? Yes, every time they need to file import manifest, but here in this import manifest, they need to file import manifest only for 4,000 containers. And here also they need to file import manifest for 4,000 containers. In the subsequent port or airport, IM or AM to be filed, and it contains the details of transit cargo and transshipment cargo. So this is about transit and transshipment, which can be asked as a theory question, or in a practical question they will just give the freight information. But be careful, transit freight to be included in the value, transshipment freight not to be included in the value. Then in case of import or export by post, so in case of import or export by post, what is considered as the relevant date for determination of rate of duty? So this is only in case of post. So generally in case of normal case, so normal cargo, in case of import, so it is like vessel means date of presentation of bill of entry or grant of entry inwards, whichever is later. In case of aircraft or vehicle, date of presentation of bill of entry or arrival, whichever is later, like that we learnt. But it is in case of import by post, it is imports by vessel. So here we need to take date on which, so postal authority hand over the list, parcel list to the proper officer, or date of arrival of the vessel, whichever is later. Whereas if it is imports by aircraft or vehicle, date on which postal authority hand over the parcel list to the proper officer, that's it. We don't have whichever is later. Then in case of exports by post, whenever we hand over the parcel to the postal authority, the date on which we hand over the parcel to the postal authority, that date will be taken as relevant date for determination of rate of duty in case of exports by post. Now whatever we are learning here for import or export by post, the same thing will be applicable for courier also, except that wherever postal authority comes, that should be replaced with courier agency. Goods imported or exported through courier are treated on par with goods imported or exported by post. Then we have faceless assessment under customs. Faceless assessment means whenever we are filing a bill of entry in the portal, so that bill of entry may not be verified by our jurisdictional customs officer. Say you are located in Kochi, and in Kochi one port is there, no? So Kochi one port is there. So now you are filing a bill of entry in Kochi, but this bill of entry need not be scrutinized by a Kochi port officer. So it may be scrutinized by a port customs officer in Mumbai also, or it may be done by a Chennai port customs officer also, because now there is nothing like jurisdictional officer only will do. So any officer can do the verification of bill of entry. Bill of entry that is identified for scrutiny is assigned to an assessing officer who is physically located in a customs station, which is not the port of import in the customs automated system. So it may not be the port of import, any place they can assign. It separates the assessment process from the physical location of the port of import using technology platform. From importer perspective, there is no change in the process of filing bill of entry, but only thing, so which officer will scrutinize will be different. So therefore here you cannot meet the officer, you cannot pay any bribe, etc. So therefore it is like all the documentations, everything will be communicated in the portal itself. So an importer will file a bill of entry, and in which portal? IC Gate portal. Then there is something called as risk management system. That risk management system will assign it to any customs officer. So thereafter, so this customs officer will upload the customs verification, customs compliance verification. Yes, the bill of entry is proper. So then it will be sent to the importer, and therefore electronic clearance will be given to the importer, which is like out of customs charge order will be given electronically. Suppose if the proper officer has identified some issues with respect to assessment, etc. So then the bill of entry will be rejected. So thereafter again importer has to recheck the missing information, and again he need to file the bill of entry. So this is known as faceless assessment under customs. So it can be asked as a short note question. Then powers of customs officer. As per section 37, customs officer at any time board any conveyance carrying imported or exported goods and may remain in such conveyance for such period as he considers necessary. So but the person in charge cannot question the customs officer. Then customs officer may require person in charge of any conveyance to produce any document and answer any questions, for which the person in charge has to cooperate. So these are the two powers of customs officer. Then next section 51A and 51B, like how in GST we have electronic cash ledger and electronic credit ledger, like that in customs also they brought electronic cash ledger and electronic credit ledger. So in electronic cash ledger, what is the purpose of this is that generally whenever we are importing the goods, we need to file a bill of entry. Once a bill of entry is acknowledged, then we need to pay the customs duty the same day. For example, today you filed a bill of entry. Now bill of entry is acknowledged. Today itself you need to pay the customs duty. If you pay the customs duty tomorrow, then you have to pay interest for 1 day delay. So to avoid this interest only, they brought in the system of electronic cash ledger. That is, you deposit the money into the electronic cash ledger and you file the bill of entry. The moment the bill of entry is approved, automatically debit will happen from the electronic cash ledger and money will be paid. So that is the advantage of this cash ledger. So electronic cash ledger, any amount deposited for duty payment is credited to this ledger, and balance in this ledger can be used for payment of customs duty, interest, penalty, just like GST. So balance in electronic cash ledger can be used for payment of tax, interest, penalty, fee and others, like that. So we can use the balance in electronic cash ledger under customs for payment of duty, interest, penalty, etc. Suppose if we have deposited some excess amount, there is some excess amount in the cash ledger. That excess amount in the cash ledger, we can get it as a refund. So these points are common between GST and customs. Then electronic duty credit ledger. Electronic duty credit ledger, so is not the same way, because in case of GST, we have input tax credit concept. But in case of customs, we don't have input tax credit. So, but we will have some incentives under customs. For example, whenever you are exporting goods using the imported goods, on imported goods, whatever customs duty you paid, you will get as a refund called as duty drawback. So whenever you are exporting the goods, the customs duty paid on import, we will get as a refund. What is the name of the refund? Duty drawback. Same way, under foreign trade policy, we have some incentives like RODTEP. Previously, we had MEIS and SEIS. Now, MEIS and SEIS is omitted. In that place, we have RODTEP, rebate of duties and taxes on exported goods. So, a percentage of our export value, we will get as an incentive. So, this particular incentives previously was given into the bank account of the person. So, but now it will be credited to the electronic credit ledger. So, now the balance that is there in the electronic credit ledger can be used for payment of customs duty. What is the advantage of this? There is no cash outflow for the government. So, previously they were giving that refund into bank account. Now, they will put it into electronic duty credit ledger. Now, the importer will use that electronic duty credit ledger balance for payment of customs duty. That too, basic customs duty only he can use, okay. So, refund payable upon export or incentives under FTP are credited to this ledger. Balance in this ledger can be used for payment of customs duty only. Unutilized balance cannot be claimed as refund. Then what we can do? We can transfer that to another person, okay. So, that we will see, we have regulations in that regard. Electronic cash ledger regulations and electronic duty credit ledger regulations. So, up to November attempt, they have not asked any question on this because it was an amendment for November exam, but they have not asked this for November exam. So, therefore, definitely for May 23 exam, you can expect questions on electronic cash ledger and electronic duty credit ledger regulations. First, electronic cash ledger regulations. There are total 5 forms. ECL 1, that is electronic cash ledger. ECL 2, challan for deposit under section 51A of Customs Act. ECL 3, challan for payment of any sum under Customs Act. So, ECL 1 is the cash ledger format. ECL 2 is the challan for deposit of money into the cash ledger. ECL 3 is for payment of sum under Customs Act. Then whatever liability that you have, that will be reflected in ECL 4, electronic duty payment ledger. Then if there is some excess balance in the cash ledger, we can get it as a refund. To get the refund, we need to make application in ECL 5, application for refund of deposit under electronic cash ledger. So, deposit that we are making in electronic cash ledger, whether we get any interest like savings deposit or fixed deposit, no, the balance will be there in cash ledger. And what are the modes of deposit in cash ledger? So, in case of GST, we have net banking, NEFT, RTGS, even credit card, debit card we have in GST, then UPI, IMPS also is there. So, but in case of customs, we have net banking, NEFT RTGS over the counter. Over the counter only up to 10,000 rupees in a day. Then once the challan is generated in ECL2, it will be valid for a period of 15 days. This point is same even under GST. So this OTC limit, how much they can deposit in the form of cash in a day? 10,000 rupees. But that 10,000 rupees in a day, so relaxation is there for government department or any person authorized by the customs officer. So they can deposit more than 10,000 rupees also in cash. Then suppose if we make any NEFT RTGS transfer, for that some charges will be payable, NEFT RTGS charges. Who will bear that charges? Portal will bear or the importer should bear? Importer should bear. Commission or charges payable for deposit shall be borne by the person making deposit. Upon successful payment, one challan identification number will be generated and amount in the ledger can be used for payment of duty, interest, penalty, fee and other amount under Customs Act or under Customs Tariff Act. And still there is some balance that can be claimed as refund. Once we claim refund, that will go into that person's bank account, importer or exporter's bank account. Now, this is a very important area, that is this electronic cash ledger regulations is not applicable to whom? That is the provisions of section 51A. This electronic cash ledger concept is not applicable to whom? In those ports or airports where customs automated system is not in place. So there are some ports or airports in India wherein customs automated system, that is ICE gate, is not active there. So there electronic cash ledger regulations not applicable. Then baggage, that is a passenger is bringing a bag. So he need to pay some duty with respect to dutiable articles. For payment of customs duty on those dutiable articles, again cash ledger regulations not applicable. Normally he can pay the customs duty. Then making payment other than duties under customs, IGST, compensations as interest or any amount payable under customs or customs tariff act. What are the other amounts? What are the other amounts? Example, we have something called as demurrage charges. So this demurrage charges is not payable under Customs Act or Customs Tariff Act, but payable under Port Trust Authority or Airport Authority of India. So that charges we cannot use cash ledger. Then custodian charges. So to custodian we need to pay some charges. That custodian charges will also not be coming under Customs Act or Customs Tariff Act. So these are some charges which will be payable, not payable under Customs Act or Customs Tariff Act. For payment of these charges, including warehousing charges, we cannot use the cash ledger. So only for payment of amounts under Customs Act or Customs Tariff Act, we can use cash ledger balance. Then these are the 3 points that you need to remember. That is when cash ledger regulations not applicable. Number 1, if the customs automated system is not in place, or accompanied baggage, or payment of amount other than those specified in Customs Act and Customs Tariff Act. Then we have electronic duty credit ledger regulations. Electronic duty credit ledger regulation says that whenever you file a shipping bill or bill of export and you are eligible for some incentive, that incentive will be credited in the duty credit ledger as a e-script, electronic script. Now use that script for the purpose of e-script means one number, license number will be given, one code will be given. At the time when you are importing, you will be required to pay basic customs duty now. At that time, rather than paying the basic customs duty, the script number if you enter, no need to pay the basic customs duty. So a shipping bill or bill of export presented and having a claim of duty credit under this scheme shall be processed in the customs automated system and the claim shall be allowed by the customs as per the conditions and restrictions. Once the claim is allowed, a scroll for duty credit will be generated by the proper officer in the system and this will be generated for each scheme. Now the duty credit available in the e-script in the ledger, so you can use it for what purpose? You can use it for payment of basic customs duty only, not for social welfare surcharge, not for payment of additional customs duties. And once this e-script is generated, means given in the duty credit ledger, that will be valid for a period of 2 years. This is an amendment. Previously it was valid for a period of 1 year. Now it will be valid for a period of 2 years from the date of its creation. Further, duty credit in the e-script that has been lapsed shall not be regenerated. Say for example, duty credit script is generated for 2,50,000 and you used some 1 lakh. Still 1,50,000 is there. 2 years over. So now the script will be lapsed. which means that 1,50,000 cannot be regenerated and it is gone. So which means we have to use it within 2 years. And suppose if I am not able to use it, why I am not able to use it? Maybe I don't have import. So then I cannot use it for payment of anything else now. Only for payment of customs duty on import, that too basic customs duty, I can use this. But what they are telling, we can transfer it to any other person. So transfer of duty credit in e-script shall be allowed within customs automated system from the ledger of another person who is holding IEC. That is, import export code will be given to an importer. So therefore, from one importer or exporter to another importer or exporter, they can transfer the duty credit script. Understood? Then suppose if the duty credit script has been transferred and say the transferor has got this duty credit wrongly and it has been transferred to the transferee, from whom it shall be recovered? It shall be recovered only from the transferor. Okay. And then one more point, the duty credit available in a script shall be transferred at any time, underline, for the entire amount in the said script. For example, there are total 4 scripts, script 1, 2, 3, 4. First script, we have 20,000 rupees balance. Can we transfer? No. The script is generated for 2,50,000. We used 2,30,000. Still 20,000 is there. Can the part of the script be transferred? No. So we can transfer entirely to the other person, and transfer of duty credit in part shall not be permitted. So these are the points that we have for electronic duty credit ledger regulations. So these 2 areas are untapped. Definitely they can create some case study based questions on this. Then next we have import of goods at concessional rate of duty rules 2022. So these rules, so again these are 2022 rules which are applicable only from May 23 exam onwards. So therefore definitely there is a possibility of asking questions on this. So previously also we had these rules, but these got amended completely. So first, to whom these rules are applicable? Import of goods at concessional rate of duty. Concentrate. I am an importer. I am eligible for import of goods without payment of customs duty or at concessional rate of duty. Why am I eligible? Because I am eligible to import it at without payment of customs duty or concessional rate under a notification wherein I am a manufacturer of some notified goods, or I am supplier of some notified services, or I am importing these goods for supply to a notified end use recipient. For example, I am engaged in manufacture of COVID vaccine. So this is manufacture of notified goods. For making this COVID vaccine, I can import the goods without payment of customs duty or at concessional rate of duty. For me, these rules will be applicable. Then I am providing some EdTech software services. EdTech software services I am providing. I am developing a EdTech software. So therefore, that is a notified service. For developing that EdTech software, so I can import some goods or services, import some goods without payment of customs duty or at concessional rate of duty. Then you are one person. So you wanted to import some petrochemicals. So when you want to import some petrochemicals, you cannot directly import. So I have to import. Say I am IOC or ONGC. I only can import. So therefore, I am importing these goods for supply to specified end use recipient, and I can import it without payment of customs duty or at concessional rate of duty. Now I need to follow these rules. See that a manufacturer or a service provider is eligible for a exemption notification. Understood? And that particular manufacturer or service provider, as per the notification, can import goods without payment of customs duty or at concessional rate. Clear? Now such imported goods can be used for what? Manufacture of any notified goods or provision of notified service or supply to specified end use recipient. Got it? So that goods are for what purpose? Imported goods are what purpose? Either manufacture of notified goods or provision of notified services or supply to a end use, specified end use recipient. Now, if suppose they are manufacturing notified goods, that goods can be manufactured by them, by the importer, or they can get it manufactured on a job work basis. However, job work in relation to gold, jewelry, precious stones and metals have been excluded from job work basis. That cannot be done. So, only the one who is importing the goods should do the manufacture. In case of which goods? Gold, jewelry, precious stones and metals. Now, this is the background of these rules, to whom these rules are applicable. Now, we understood the applicability of these rules. Now, we need to proceed to the procedure. Say, I am an importer. I am located in Coimbatore, Tamil Nadu, and I am eligible for import of goods without payment of customs duty or at concessional rate of duty. Now, what is the first step I need to do? I need to submit the information in the customs common portal in ICGR1 that I am eligible I am eligible for import of goods at concessional rate or without payment of customs duty under so and so notification. I am importing this much quantity of goods and this much customs duty I need to pay, but I am not paying, and what goods I will be manufacturing, every detail I need to submit the information. Plus, I need to execute a bond also, continuity bond with surety or security. Once I submit this information to the portal along with bond, the portal will verify the information, and if it is correct and I am eligible for the notification, they will be generating one IIN, that is import of goods at concessional rate identification number. So, they will give one number. So, import of goods at concessional rate identification number. Now, this number I need to quote at the time of import. So, when I am importing the goods, say I am importing goods in Chennai port. When I am importing goods in Chennai port, there I will file one bill of entry na. So, that Chennai port customs officer don't know I am eligible for this benefit or not. That's the reason why whatever IIN I got, I have to quote in the bill of entry at the time of import in Chennai port. So, the customs officer in Chennai port will not be collecting any customs duty from me. So, import and clearance without payment of customs duty or at concessional rate by furnishing bill of entry with IIN and bond number. So, bond gets debited to the extent of such concession. Then next, the importer, step number 4, the importer has to submit an intimation in ICGR2 regarding any non-receipt or short receipt of the goods, because in ICGR1 they will say that they are importing 10,000 kgs, but actual import is only 9,000 kgs. So, why? Because the exporter has sent only 9,000 kgs. Then in that case, portal will be of the opinion that we imported 10,000 kgs. That's the reason why any short receipt done in ICGR1 we need to submit in ICGR2. Then step number 5, whatever imported goods under this notification, that is import of goods at concessional rate or without payment of customs duty, if we have any unutilized or defective goods, that should be either exported or it should be sold in India upon payment of customs duty along with interest. Why? First of all, you did not pay customs duty, you got the benefit. So, now those goods you are not using for the purpose for which you are importing, you are selling it in India. So, pay the customs duty, how much benefit you enjoyed along with interest. Why interest payable? Had you imported at that time you have to pay customs duty. Now you are paying customs duty, so there is a delay. You pay the interest at 15% per annum. In customs, the rate of interest is 15% per annum, not like GST. GST it is 18% per annum. In customs, always the interest rate will be 15% per annum. So here we need to pay from the date of import till the date of payment of customs duty. Understood? Suppose if you don't want to pay customs duty on these unutilized or defective goods, send it back to the exporter and you ensure that you are receiving the money for that. Means whatever money you paid for those goods, that money you are receiving for those goods. So, value of such goods should be greater than the value of said goods at the time of import. That is the meaning. Then ICGR1 is prior information to be provided by the importer to get this notification benefit, and ICGR2 is intimation regarding non-receipt or short receipt. ICGR3 is a monthly statement. So, in that monthly statement they need to submit what goods imported, what goods they manufactured, or what services they provided using these imported goods. Like that monthly statement they need to submit. So, depending upon that monthly statement, if they have achieved the purpose, means they are manufacturing the notified goods, they are providing the notified services, then whatever value that the bond got debited will be recredited. Means you have achieved the purpose. When you achieve the purpose, the bond will be cancelled. That is the meaning of that. But if you want that to be done immediately, so then you have to give ICGR 3A, details of goods consumed for immediate recredit of the bond. These are the 4 forms we have. Now some FAQs. What is the information to be submitted? This is one not important one. So simply we can understand. So what are the information to be submitted? So which place, name and address of the importer and his job worker, what are the goods that we are producing or process undertaken, or what is the service that we provide, and what is the description of the goods that we need, then what is the exemption notification under which we can import, and which port we wanted to import, and which place we will manufacture or transfer the goods, or who is the specified end use recipient for whose purpose we are importing. Like this, all those details we need to. So you remember the background now. So based on this background, you create the points. That is, what are the goods notified for manufacture, what are the services notified for providing service, and who is the specified end use recipient, and which exemption notification you are eligible for, and thereafter what quantity of goods you want to import, which port you want to import, which place you want to manufacture, and your job worker details, like that. So any 5 points if you write, that is sufficient. What is the procedure for sending goods for job work? So when we are importing the goods and sending it for job work, because we have a pointer, either the importer who is importing the goods at concessional rate, or they can send it to the job worker for processing, correct? If I am importing the goods, I can manufacture, or I can get it done on a job work basis. So if I am sending the goods for job work, then I need to mention these details in that monthly statement ICGR 3, plus whatever goods I am sending on job work, that should be under the cover of a delivery challan plus e-way bill. And the time limit within which that good should be received back to my place after job work is within 6 months. And job worker also shall maintain necessary records. Then, can the imported goods be transferred from one unit to another unit? Yes. So one unit to another unit we can transfer, but that will become transaction between distinct persons. So therefore, that goods should be transferred under the cover of an invoice plus e-way bill, and all these goods which are transferred from one unit to another unit should be mentioned in ICGR 3. Then, what is the procedure for supplying imported goods to the specified end use recipient? So all those imported goods which are supplied to specified end use recipient should be mentioned in ICGR 3, and these goods should be sold under the cover of an invoice plus e-way bill, and even the person end use recipient should maintain the necessary records for the same. Then, can the capital goods be imported under these rules? Yes. Not only raw material, even capital goods also can be imported under these rules. What are capital goods? Capital goods means those goods which are imported by the importer and capitalized in the books of the importer is known as capital goods. And so these capital goods, once we achieve the objective, that is once we manufactured the notified goods or once we provided the notified service, so then these capital goods can be sold in India upon payment of customs duty along with interest. Why customs duty we need to pay? Because originally when we imported capital goods, we did not pay customs duty na. So that we need to pay now along with applicable interest on the depreciated value. Then what is the type of bond to be executed? We need to execute a continuity bond with surety or security with the ACDC of customs. What is the interest rate? Already I told you, we need to pay interest at the rate of 15% per annum. From when to when we need to pay? From the date of import of goods till the date of payment. What will be considered as the date of import of goods? That is whenever out of customs charge order is passed by the customs officer, from the date till the date you pay, because at that time you did not pay concessional rate or you did not pay. Now you are paying, so pay that along with interest. What are the accounts and records to be maintained by the importer? So like what are the quantity and value of the goods imported, how much it is consumed, how much it is sent on job work, so how much it is remaining, that details. And how to compute the depreciated value of capital goods. This is important because we are importing the capital goods. When we import the capital goods, we either imported without payment of customs duty or at concessional rate of customs duty. Now these capital goods are sold in India after import, after utilizing it for the purpose. And say for example, capital goods we use for 2 years, then how much should be taken as the depreciated value of the capital goods? Please check the depreciation schedule. Suppose if we are using for every quarter or part thereof in the first year and second year, we need to give depreciation of 4%. If we are using it for every quarter or part thereof in the third year and fourth year, sorry, first year it will be 4%, second and third year it will be 3%, then fourth and fifth year it will be 2.5%, and thereafter it will be 2%. So you have to remember 4%, 3%, 2.5% and 2%. 4, 3, 2.5, 2. So 4 will be for every quarter or part thereof in the first year. 3% is for every quarter or part thereof in the second and third year. And 2.5% for every quarter or part thereof in fourth and fifth year, and thereafter it will be 2%. Now, customs duty on above shall be equal to difference between the duty leviable on such goods but for the exemption availed and that already paid. So if any at the time of importation, as depreciated value is allowed on straight line basis, the quarter should be based on period specified above and not based on calendar quarter. But actually ICI has taken it as calendar quarter only. So therefore not based on calendar quarter, you please remove. So ICI is doing the computation based on calendar quarter. This is for ICI view. Generally as per rules, if you see, we need to take it as 3 months as 1 quarter. But ICI is taking it as calendar quarter only. So therefore we need to take calendar quarter for the purpose of computation. And this particular question has been given in the recent exam. So that is in the last attempt, November 22. So this question has been asked. So you can see that question here. So this is November 22 exam question. So say this, Mr. X, a chemical manufacturer, imports a machine from Germany on 12 January 2019 for rupees 20 lakhs. Mr. X is eligible for concessional rate of customs duty on capital goods imported by him, subject to the condition that he follows customs import of goods at concessional rate of duty rules 2017, because at that time it was 2017 rules. Machinery was put to use on 1st February 2019. On 5th April 2022, Mr. X wants to clear the machine for home consumption after having used the machine for this specified purpose for which it was imported. So therefore, machinery was put to use from 1st February. So 1st February 2019 to 5th April 2022, we need to do the depreciation. So we need to take it like calendar quarter only. So 1st February 2019 means, so in the first year, so February 2019. So therefore it will be Jan, Feb, March, April, May, June, July, August, September, October, November, December. That full year we will take. So first year 4 quarters. So first year 4 quarters. Then again, so the first year got over. 2019 got over. 2020 again second year full 4 quarters. 2021 again full 4 quarters. 2022, so April, which means 2 quarters. So January, February, March and April, few days is there. So 2 quarters will be taken. So therefore, see how the depreciation is computed here. So they took for 2019 full 4 quarters, understood? Then 2020 4 quarters, 2021 4 quarters and 2022 2 quarters. For every quarter or part thereof in the first year it will be 4%. So 4 into 4, 16. For every quarter or part thereof in the second year and third year it will be 3%. So therefore 4 into 3, 4 into 3, 12 and 12. For every quarter or part thereof in the, so fourth year will be 2.5%. That will be 2 quarters into 2.5, 5%. So total depreciation will be 45%. And what is the value of the imported goods? The value of the imported goods here is, so 20 lakhs. So on 12 January 2019 for 20 lakhs. So 20 lakhs, then what will be taken as the depreciated value of the goods? So 20 lakhs minus 45%. So which means the depreciated value of the goods is 11 lakhs. You understood? 20 lakhs minus 45% will be 11 lakhs. On that 11 lakhs, we need to see how much is the customs duty. Now, if we are importing the goods and we need to pay normal customs duty, so we need to pay 20%. So see this carefully. Mr. X requires you to compute. So import of goods at concessional rate is 5%. Normal rate of basic customs duty is 20%. So now you completed the usage. Now you are selling. What is the depreciated value? 11 lakhs. 11 lakhs into 20%. 11 lakhs into 20%. That will be 2,20,000. But at the time of import, how much you paid? 20 lakhs. You imported for 20 lakhs and you paid 5%. So 20 lakhs into 5%. 1 lakh. So 2,20,000 minus 1 lakh. 1,20,000 is what you need to pay. 1,20,000 is what you need to pay. That's it. Now they may ask a question on interest computation if possible. So therefore, now interest computation we need to do from when to when? From the date you have imported till the date you are making the payment. When you are importing, so imported on 12th January 2019. From that date till the date you are paying the customs duty. So say you are paying the customs duty on 5th April 2022. So then from that date to 5th April 2022, we need to compute the interest. Interest will be computed at the rate of 15% per annum. That is not asked. Ignore interest calculation. So they asked only the customs duty payable on depreciated value for 5 marks, but they can ask even interest computation. Accordingly we need to do. So therefore, actually speaking, they should have taken 3 months as 1 quarter, but they have taken calendar quarter. So that's why we are following calendar quarter only should be followed for exam purpose. Then when the unutilized or defective goods should be exported or sold in India within 6 months from the date of import, but that is not applicable in case of capital goods. What are the other compliances to be followed? They need to file a monthly statement. That monthly statement is to be filed in ICGR 3 and it is to be filed by 10th of the month following every month. So this is about import of goods at concessional rate of duty rules. Then the next area that we have is exemptions under customs. So we completed segment 25, that is procedures under customs. So look into segment 26, exemptions under customs. In these exemptions under customs, we have totally 6 exemptions, but first 4 exemptions you can see section 13, section 22, section 23 subsection 1 and section 23 subsection 2. What are these 4 exemptions? Section 13 says that you don't have to pay duty on pilfered goods. What is pilfered goods? Those goods which are petty thefts is known as pilfered goods. You imported some goods and say you imported 500 iPhones. In that 500 iPhones, 1 or 2 iPhones are missing. That is known as petty theft. In that case, section 13 will be applicable. Section 23. Section 23 is relinquishment of title to the goods. When is it applicable? So relinquishment means what? You are leaving the title to the goods. That is known as relinquishment of title. So means you are not the owner of the goods. When you are not the owner of the goods, you don't have to pay customs duty. But when relinquishment will be applicable? If goods are not conforming to the specifications, you imported the goods and you ordered for some goods, but they sent some quality of goods. So the goods are not as per specifications. Then relinquishment of title to the goods. Then goods lost, destroyed or abandoned. When the goods are lost or destroyed or abandoned, then it will be remission of duty. So remission of duty means first you will pay duty and you prove that the goods are destroyed, then they will give refund of the duty. That is known as remission of duty. Then damage or deterioration. Damage or deterioration. What is the difference between destruction and damage? Destruction means completely the goods are destroyed. Damage means the goods will function but not as desired. The goods got damaged but it will work. So now in that case, you don't have to pay full duty or you have to pay duty. You have to pay duty but lesser duty, that is abatement. So in case of 23 subsection 1, fully you don't have to pay. Whatever you paid, that you will get as a refund. But in case of 22, there will be reduction in the customs duty that is payable. So section 13 when applicable, pilferage, petty theft. Section 22 when applicable, damage or deterioration. And section 23 subsection 1 when applicable, goods are destroyed. lost, destroyed or abandoned. And when 23 subsection 2 relinquishment of title will be applicable? If the imported goods are not according to the specifications. Then what is the benefit that we get in case of section 13? In case of section 13, as the goods are lost, we are not required to pay the customs duty, and customs duty will be payable by the custodian. And in case of section 23 subsection 2 also, as you relinquish the title, you are not required to pay the customs duty. In 23 subsection 1, remission of duty, first you pay customs duty and prove to the officer that the goods are destroyed, and then get the refund of customs duty paid. Then in case of abatement, you pay the customs duty proportionately based on the value of damaged goods. Say for example, if the value of goods before damage, so if the value of goods before damage is 180 lakhs, for this we have paid, say we are required to pay, so 39.5 lakhs as customs duty. For this 180 lakhs, you need to pay 39.5 lakhs as customs duty. This 180 lakhs is when before damage. Now the goods got damaged. Now the value of those damaged goods is 110 lakhs. Now for 110 lakhs, you need to pay the proportionate customs duty. So 110 lakhs into 39.5 divided by 180. So 110 into 39.5 divided by 180 will be 24.138 lakhs you need to pay as customs duty. So which means instead of 39.5, you need to pay 24.138. So this reduction is known as abatement. Okay. So therefore, proportionate customs duty payable at discount in proportion to the value of damaged goods. So that is, customs duty payable is value after damage. What is the value after damage? 110 into original customs duty divided by value of goods before damage. That is how we need to pay customs duty in case of abatement. Then see the remarks in case of pilferage. If goods are restored, customs duty is payable by the importer. First, the goods are imported and kept under the control of a custodian, and the goods got pilfered. So therefore, importer not required to pay customs duty, custodian will pay customs duty. Now the goods are identified. So those missing mobiles got identified. Now in that case, the importer has to pay customs duty on those 2 mobiles. Then relinquishment is not possible in case of prohibited goods. First of all, you are importing cocaine, weed, etc. and all, and they are prohibited goods. So then you are importing it, and when you are importing it, customs officer identified. Now you cannot say, I will relinquish the title, I will not pay customs duty. Here it is not about payment of customs duty, it is about the offense that we have committed. So therefore, in case of prohibited goods, relinquishment of title is not possible. Then whether these sections are applicable in case of warehoused goods. In case of pilferage, not applicable, which means where the pilferage should have happened before clearance into warehouse, means before order for clearance, means where the pilferage should have happened at the port or airport. So then we will be getting benefit under section 13. Whereas whether relinquishment of title is applicable in case of warehoused goods, no. So again, relinquishment of title should be before order for clearance, which means at the port or airport we should relinquish the title. Suppose if you want to relinquish the title with respect to warehoused goods, it is not possible under 23 subsection 2, but it is possible under a different section, that is proviso to section 68. Under that place it is possible. Total in customs, in 3 places we can relinquish the title. Relinquishment of title. Relinquishment of title. In customs, relinquishment of title, when you do, are you required to pay customs duty? You are not required to pay customs duty. You are leaving the title to the goods. So this relinquishment of title is possible in 3 places. That is, unloading of goods. Unloading of goods. After unloading goods, and before order for clearance. Before order for clearance. At this stage, if you want to relinquish the title, it is possible under section 23 subsection 2. It is possible under 23 subsection 2. That is after unloading of goods and before order for clearance. Whether we need to pay customs duty or customs duty not payable. Customs duty not payable. customs duty not payable. Suppose if it is order for clearance and we deposit the goods in warehouse and thereafter, so warehoused goods, so we are clearing from warehouse, clearance from warehouse, before clearance from warehouse, before clearance from warehouse. So suppose in warehouse, if you need to relinquish the title, yes, it is possible under section 68. Section 68, with respect to warehoused goods also we can relinquish the title, and whether customs duty payable or customs duty not payable, customs duty not payable. Now we cleared it, that is order for clearance, so or cleared from the warehouse, okay. So clearance is done. So after clearance, that is either clearance for home consumption or after clearance from the warehouse for home consumption. So clearance for home consumption, clearance for home consumption. When you clear it for home consumption and thereafter, can you relinquish the title? Yes. Thereafter also we can relinquish the title. Thereafter, that is after clearance. At the time of clearance for home consumption, customs duty paid. Customs duty paid. Even at this stage also relinquishment is possible. At this stage also relinquishment is possible. But when you relinquish the title at this stage, relinquishment of title at this stage, that is as per section 26A. That is as per section 26A, the relinquishment of title is possible, and here you already paid the customs duty, so you will get refund of customs duty paid. You will get refund of customs duty paid. So therefore relinquishment of title is possible in 3 places. Section 23 subsection 1, when it should be after unloading and before order for clearance. At that time if you do relinquishment of title, no need to pay customs duty. Suppose if you are depositing the goods in warehouse, can you relinquish the title? Yes, but not under this 23 subsection 2, it will be under a different section, that is proviso to section 68. At that time, whether you need to pay customs duty, no need to pay customs duty. Now you actually cleared for home consumption, means when you cleared for home consumption, means you would have already paid the customs duty. Even after clearance from home consumption, you can relinquish the title, but if you relinquish the title, you will get the refund of customs duty paid because customs duty is already paid. So these are, that is under section 26A. These are the 3 places where we get relinquishment of title. Then in case of remission of duty, whether with respect to warehoused goods, whether we get remission of duty, yes. Imported goods is kept in the warehouse without payment of customs duty, and now the goods got destroyed. Now are you required to pay customs duty? No. So remission will be available. Then in case of abatement, damage, so damaged goods in warehouse, whether we get the abatement? Yes. But deterioration in the warehouse, we will not get any abatement. So only in case of damage in the warehouse we get abatement. Then section 21. Section 21 refers to derelict, jetsam and flotsam. Derelict refers to imported goods in a ship. That ship got derailed, so in the sea. So then it is called as derelict. Jetsam means sometimes the goods will be thrown into the sea in order to save the ship from the sinking. So that is known as jettisoned goods, jetsam. Flotsam, those goods which are thrown into the sea will continue to float, that is known as flotsam. Now if these goods which are derailed in the sea or thrown into the sea or floating in the sea, if you are bringing into India, you have to pay customs duty as if you have imported the goods, unless those goods are exempted from payment of customs duty. All goods derelict, jetsam, flotsam and wreck brought or coming into India shall be dealt with as if they were imported into India, unless proved to the satisfaction of the officer that they are entitled to be admitted duty free. Then section 20 talks about re-importation of goods. That is, first you have imported the goods. So as per notification 45/2017, so when you have imported the goods, you will pay normal customs duty, and you are exporting those goods. When you are exporting those goods, so again on re-import, you don't have to pay full customs duty, you need to pay the concessional customs duty. Again I am repeating, originally imported you paid normal customs duty. Those goods got exported. After export, you are re-importing those goods. When you are re-importing those goods, you don't have to pay full customs duty, you need to pay customs duty at concessional rate. What is that concessional rate? at the time of export whether you claimed any incentive like refund or duty drawback, etc. Yes. Then upon re-import, just that incentive you claimed you pay, that is sufficient. If incentive is claimed at the time of export, upon re-import, customs duty payable is incentive that you have claimed. You don't have to pay full customs duty. So therefore, at the time of export, you got a duty drawback of 30,000. At the time of import, just pay back the 30,000 enough. Suppose you are exporting it for repairs abroad. So you are importing the car and you are exporting the car for repairs. And after repairs, when the car is re-imported, so you don't have to pay again customs duty on the car, but you need to pay customs duty on fair value of repairs plus freight and insurance both ways. You don't have to pay customs duty on full value of the car. So whatever is the fair value of repairs, means materials and labor cost plus freight and insurance both ways, on that we need to pay customs duty. Provided from the export to re-import, the time limit is within 3 years plus 2 years. So then we have to pay beyond this 3 years plus 2 years, means we need to pay normal customs duty as if these goods are originally imported into India. Only if you are bringing within 3 years plus 2 years from the date of export, then this concessional rate will be applicable. Then note, even IGST is payable on fair cost of repairs including material, labor, freight and insurance both ways, means the total customs duty will be payable on this only. If export is subject to export duty, means at the time of export we paid export duty, then upon re-import, so you will get refund of the customs duty paid on export. So at the time of export you did not claim any incentive, or you are not exporting it for repairs, normally you exported. Upon re-import, you will get refund of the customs duty paid on export. If goods are exported under duty exemption scheme, that is advance authorization, duty free import authorization, EPCG under FTP, then the time limit will not be 3 years plus 2 years, the time limit will be 1 year plus 1 year. And if goods exported are not subject to any incentive or exemption and not exported for repairs, then upon re-import customs duty is not at all payable. But the time limit should be what? That 3 years plus 2 years and 1 year plus 1 year should be maintained. Exported and imported goods should be same and the ownership should not have changed. And this is not applicable to 100% EOU or unit in FTZ or public or private warehouse or tobacco and petroleum products, because in that case, so anyhow customs duty is not at all payable. So therefore this concessional customs duty is not applicable. In case goods taken outside India for exhibition, suppose if the goods are taken outside India for exhibition, you are importing the goods and you are taking it outside India for exhibition. What is the time limit within which the goods should be brought back to India? Within 6 months. So in that case it should be 6 months. So then if you are bringing back within 6 months, customs duty is not payable. Then this is another notification, that is notification 60/2018. What you are doing in this notification is that first you are exporting the goods. You are manufacturing some goods in India and you are exporting those goods. But these exported goods has got some defects. So you will recall the goods. You will recall the goods to India and you will do refining, reprocessing or remaking. What is the time limit within which you need to recall the goods to India? Within 1 year. See there. For reprocessing, refining, remaking, from the date of export, you need to bring back the goods within 1 year. Suppose if you want to repair those goods, you can bring it back to India within 7 years in case of notified goods, and other goods 3 years, and if it is from Nepal and Bhutan within 10 years. If you are bringing back those goods for reprocessing, refining or remaking within 1 year, or for repairs etc. within that time limit, at the time of import, no need to pay customs duty. Understood? At the time of import, we don't have to pay customs duty. Generally on import, we need to pay customs duty, but no need to pay customs duty. Why no need to pay customs duty? Whatever goods you are exporting, the same goods are coming back to India. No need to pay customs duty. But you need to ensure one thing, that is, these imported goods, for what purpose you are importing, refining, remaking, reprocessing or repair, complete that repair or reprocessing and export it within 6 months, and it can be extended for a further period of 6 months. Then no need to pay customs duty at the time of import. Understood? Then suppose if there is any process loss, it's okay. That is from export to import, if there is any process loss, import to re-export any process loss, So no need to pay any customs duty on that process loss. Then section 21 already we discussed. Section 24. Section 24 is denaturing and mutilation of goods. That is, you are importing some chemicals. So these chemicals are actually having twin purpose. For example, you are importing H2SO4, sulfuric acid. This sulfuric acid can be used for laboratories as well as for manufacturing. If you are using it in laboratories, then you need to pay nil rate. If you are using it for manufacturing, you need to pay 10% rate of duty. Now, you don't want to use it in manufacture, you want to use it in laboratory. Then dilute the H2SO4, and so that at the time of import, it will not be used for manufacture, it can be used only in laboratory. So then you are making it unfit for the other purpose, and accordingly you pay the customs duty. That is, owner of the goods will make request for denaturing, that is diluting the chemicals. And mutilation, for example, if you are importing a second hand car, for second hand car the basic customs duty is 100%. So 100% of the value of the car you need to pay as customs duty if it is a second hand car. But you don't need second hand car, you need the parts of that car. Say you have a vintage car, you are importing a second hand vintage car because you need the parts of that vintage car. Then in that case you import the second hand car and you demolish the car, you take only the parts, remaining parts, remaining body of the car and all you demolish, so that you will pay customs duty only on the parts of the car. That is known as mutilation, breaking the machinery. Now central government may make rules regarding the same. Duty is payable as if goods are imported in denatured or mutilated form. Then section 25A and 25B are not applicable at present. So this is inward processing of goods, not insured, inward processing of goods and outward processing of goods. But these two sections are not applicable, which is given in study material, but it is not applicable because notification for 25A and 25B are yet to be released by CBIC. So with this, we completed exemptions under customs.